Hello CA final students. I am Umasankar Maganti, a chartered accountant and also a faculty for direct taxation at inter and final level for both CA and CMA. Now, I have done revision marathon for CA final direct taxation. It is in 100% English. Whatever this revision marathon is there, this is applicable for September 25 attempt as well as for January 2026 attempt. Okay, so like in part 1, I have done it in two parts. In part 1, I have covered 4 chapters. Transfer pricing, you can easily expect 8 to 12 marks from transfer pricing. From trust taxation, you can easily expect 8 to 10 marks. From MAT and AMT, you can easily expect 8 marks. From non-resident taxation, I have discussed very clearly and I have done revision of taxation of non-resident Indian as well as taxation of non-resident. From this easily you can expect 8 to 12 marks. So overall this revision marathon will benefit you 35 to 40 marks. Okay, and this revision marathon is spanned over 9 hours. So I welcome you all for this revision marathon. These 4 chapters, which are very important for CA final direct taxation, thoroughly, clearly revised from point to point, end to end. So please watch this revision marathon. Overall, you can spend 9 hours and you can benefit easily 35 to 40 marks. As it is in 100% English, your friends, those who wanted to listen to CA final direct taxation in 100% English, please share this video to them also so that it will be useful. Thank you very much. Now let's begin the journey. So I welcome you all for this beautiful concept, transfer pricing. It's very interesting topic. In examination also, it is very important. Easily you can expect 8 to 10 marks from this chapter. So I request you all to listen revision series of transfer pricing very interestingly and with very focusedly. Okay. First of all, charging section for transfer pricing is section 92. What section 92 says? First of all, section 92 says that there should be transaction between two associated enterprises. Only when there is transaction between two associated enterprises, then only transfer pricing provisions are applicable. So when transfer pricing provisions are applicable, first condition, like there should be transaction between two or more associated enterprises. Then only transfer pricing provisions are applicable. Sir, what do you mean by associated enterprise? It is given in section 92A. I will discuss with you. When transfer pricing provisions are applicable, whenever there is a transaction between two or more associated enterprises, then transfer pricing provisions are applicable. Second, whatever the transaction that is happening, the transaction should be either international transaction or it should be specified domestic transaction. Then only transfer pricing provisions are applicable. Otherwise, transfer pricing provisions are not applicable. Sir, what do you mean by international transaction? International transaction definition was given in section 92B. I will discuss little later with you. So, to get transfer pricing provisions applicable, first condition is transaction should be there in between two associated enterprises, and whatever the transaction is there, the transaction should be either international transaction or specified domestic transaction. Condition 3. Such a transaction should happen at arm's length price. Should happen arm's length. Sir, what do you mean by arm's length price? How to compute arm's length price? What are various methods to compute arm's length price that we are going to discuss in section 92. So prima facie, we need to discuss three sections: 92A, 92B, 92. First, I will start with section 92B. Sir, what do you mean by international transaction? 92B, international transaction. International transaction means transaction between two or more associated enterprises. Out of them, one should be NR. Out of them, one should be NR in India. Then that transaction we call as international. What I said, let's say there is A limited, this is and there is also B limited. A limited is resident in India, B limited is also resident in India. Whatever the transaction, A limited and B limited are associated enterprises. Whatever the transaction that happens between A limited and B limited, is it international transaction? No, because to qualify as international transaction, one of the associated enterprises should be non-resident in India. Then only the transaction we call as international transaction. Another example, A limited, B limited. A limited is resident in India, B limited is non-resident in India. Both A limited and B limited are associated enterprises. Whatever the transaction between A limited and B limited is there, can we call this transaction as international transaction? Answer is, you can call this transaction as international transaction because one of the associated enterprise is non-resident in India. So transfer pricing processes are up. There is C limited, D limited. C limited is non-resident in India. D limited is also non-resident in India. C limited, D limited, both are associated enterprises. Now, C limited has done transaction with D limited. Now, can we call this as international transaction? Yes. See, out of associated enterprises, both are non-residents, but condition is if one company or if one person is non-resident sufficient, it will be termed as international transaction. Are you able to understand? Why? See, there are two non-residents. Out of two non-residents, one non-resident may be taxable in India. That is why. So even if both are non-residents, one of the non-resident can be taxable in India. That's why this transaction will be treated as international transaction. Are you able to understand? So we will come to the beginning. What I said, three conditions. When transfer pricing provisions are applicable, they are applicable only if transaction is there in between two associated enterprises. Next, such a transaction should be international transaction or specified domestic transaction. Specified domestic transaction I will discuss later. Next, if transaction is happening between associated enterprises and transaction is international transaction, then the transaction should be computed at arm's price. Okay. Now, I discussed the section 92B international transaction. What do you mean by international transaction? If transaction is happening between two or more associated enterprises, out of them one should be non-resident in India. Then the transaction we call as international transaction. We will discuss associated enterprise. 92A, associated enterprise. Sir, when can we call two entities as associated enterprises? For example, A limited is there, B limited is there. A limited holds greater than or equal to 26% shareholding in B limited. Now we can call A limited and B limited as associated enterprises. Are you able to understand? So if one company holds 26% shareholding or more than 26% shareholding in another company, then both companies will be treated as associated enterprises. Are you able to understand? Sir, this 26% shareholding, is it required to be held for the whole year? No. Even for one day, 26% shareholding is there in that particular previous year. For that year, both the companies will be treated as associated enterprises. So, this 26% shareholding at any time during the previous year. So, 26% shareholding is not required to be maintained for the whole year. This can be at any time during the previous year. Now, this 26% shareholding, whatever is there, this can be either directly or indirectly. Sir, what do you mean by this? Directly or indirectly? I will tell one example. A limited is there. Next, D limited is there. S limited is there. A Limited is having 80% shareholding in D Limited. D Limited is having 90% shareholding in S Limited. That means indirectly A Limited 90 into 80%. 90 into 80%, how much? 72%. So A Limited is having 72% shareholding in S Limited. So we can tell A Limited and S Limited also as associated entities. Are you able to understand? So if one company holds 26% or more shareholding in another company, then both companies we will call as associated enterprises. The shareholding is required to be maintained not for the whole year but any time during the previous year, and this 26% stake can be held either directly or indirectly. So did you understand first case of associated enterprise? Second case, there is R Limited, there is S Limited, there is M Limited. R Limited is holding greater than or equal to 26% shareholding in S Limited. So, can we tell R Limited and S Limited as associated enterprises? Because R Limited is holding more than 26% shareholding. Same, R Limited is also holding greater than 26% shareholding in M Limited. So, we can tell R Limited and M Limited as associated enterprises. In this case, like whatever S Limited and M Limited are there, these are also treated as associated enterprises. That means if one company holds 26% or more shareholding in company 1, 26% or more shareholding in company 2, then these company 1 and company 2 are also treated as associated enterprises. Case 3. There is Kim Limited, there is Trump Limited. Kim Limited appoints more than half of board of directors of Trump, or Kim Limited appoints one executive director of Trump Limited. Then we can tell Kim Limited and Trump Limited as associated enterprises. That means if one company appoints board of directors of another company, how many board of directors? More than half of the board of directors. That means if majority of the board of directors are appointed by one company in another company, and or if one company appoints one executive director of another company, then we can call both the companies as associated. And are you able to understand? So this is case 3. I hope you understood case 3. Now we will move to case 4. Now AA Limited is there, BB Limited is there, CC Limited is there. Now AA Limited is like appointing more than half of board of directors of BB Limited, or AA Limited is appointing one executive director of BB. Now can we call AA Limited and BB Limited as associated enterprises? Perfect. Next. AA Limited is also appointing more than half of board of directors of CC Limited or one executive director of CC Limited. Now we can tell AA Limited and CC Limited as associated enterprises. In this case, BB Limited and CC Limited, they are also treated as associated enterprises. Able to understand? Case 5. There is Rama Limited, there is Lakshman Limited. Lakshman Limited total borrowings are 90 crores. Rama Limited, Lakshman Limited total assets are 90 crores. Rama Limited gave 70 crores loan to Lakshman Limited. In this case, total assets of Lakshman Limited are 90 crores. Loan given by Rama Limited is 70 crore rupees. That means whatever the loan that is given is there, loan given is more than 51%. Na? So if amount of loan given is more than 51% of total assets, then also we can treat both the entities as associated enterprise. Very simple. One company gives loan to another company. Amount of loan given should be more than 51% of total assets of another company. Then we can call both the entities as associated enterprise. Are you able to understand? Sixth case. There is Veer Limited. There is Sur Limited. Veer Limited, Sur Limited total borrowings are 200 crores. Veer Limited gave guarantee for 60 crore rupees. 60 crores means what? More than 10%. Na? 60 crores divided by 200 crores means how much percentage was guaranteed? 60 by 200 into 100. 30%. Correct? So 30% of borrowing. 30% borrowing is guaranteed by Veer Limited. So if percentage of guarantee given to another company is more than 10%, then also we can consider both the entities as associated entities. Are you able to understand? Case number 7. I hope you are following. Till case 6, I have explained you different cases of associated enterprises. Till case 6, if you are clear, give one like symbol or give that you have understood. Leave the comment. If you have any doubt, you can ask. Seventh case. There is Hero Limited. There is Honda Limited. Now, whatever the technical know-how that is required for Hero Limited, entire technical know-how is provided by Honda Limited. Simply intangibles, whatever the intangibles required for one company are provided by another company. That means Hero Limited is 100% dependent on Honda Limited for the purpose of technical know-how, for the purpose of manufacturing bikes. Entire to manufacture bikes, whatever the information that is required, entire information will be given by Honda Limited. That means entire business of one company is dependent upon technical know-how or copyright, franchise, design of another company. In this case also, we can term both the enterprises as associated enterprises. Be able to understand? Case number 8. There is AHA Limited. There is Kaka Limited. AHA Limited, Kaka Limited. Now, AHA Limited manufactures cars. For manufacturing cars, entire raw material, whatever tires, doors, windshield, everything is provided by Kaka Limited. Everything is provided by Kaka Limited. And it influences price and terms and conditions. Influences price, terms and conditions. In this case also, we can consider AHA Limited and Kaka Limited as associated enterprises. That means what? One company is manufacturing a finished good. For manufacture of that finished good, entire raw material is supplied by only one supplier, and this company is entirely dependent upon another supplier. Now another supplier is determining the price. In this case, like as this company is entirely dependent upon single supplier, that supplier is influencing the price. Now also we can determine both these companies, both these entities as associated. Are you able to understand? 9. There is AHA Limited. There is Arha Limited. AHA Limited, Arha Limited. AHA Limited sells goods to Arha Limited. Generally, who will determine selling price? Seller will determine the selling price. You wanted to buy iPhone. Okay. So, will you tell I will pay only 10,000 rupees? No. seller will determine the price. He will tell 1 lakh rupees. If he wants to give, he will give discount. Otherwise, he will not give discount. So every time selling price will be determined by seller. But if buyer determines the selling price, then like something fishy na, it is not correct. So if buyer determines selling price or if buyer influences the selling price, in that case also both will be treated as associated enterprises. AHA Limited and AHA Limited will be treated as case number 10. There is individual, Uma is there. Uma is having one company, Uma Limited. He is having one company, Uma Limited. In that Uma Limited, Uma is having more than 26% shareholding. And there is my mother. Her name is Manga. She is having one company, Manga Limited. In Manga Limited, she is having more than 26% shareholding. Now also, we can term Uma Limited and Manga Limited as associated enterprises. That means what? One person is having control, 26% or more shareholding in Uma Limited. His relative is having more than 26% or equal to 26% shareholding in another company. Okay, now both these companies, that means individuals company, relatives company, both these companies will also be treated as associated. Sir, here relative means who? Relative means spouse, brother, sister, mother, father, lineal ascendant, lineal descendant. These are considered as relatives. Here, please understand, greater than 26% shareholding, we can call this as control. We can call this as control. If one person is having control over another company and his relative is also having control over second company, then this first company and second company both are treated as associated entities. Here, control is very important. Control means control can be two types: capital control, management control. Capital control means what? More than or equal to 26% shareholding. So, control is of two types: capital control, management control. Capital control means what? Greater than or equal to 26% shareholding. Management control means like power to appoint majority of board of directors or one executive director. So control can be either capital control or management control. Individual have control over another company. His relative is having control over second company. Now these two companies will be treated as associated entities. Are you able to understand? Similarly, 11th case, HUF is having control over one company, company 1, relative of HUF. Relative of HUF means nothing but member of HUF. Relative of HUF is having control over company 2. Now, both these companies will be treated as associated entities. Company 1 and company 2 will be treated as associated. This control can be either capital control or management control. Case number 12. Partnership form is there, like any person, if he has greater than or equal to 10% of profit sharing ratio in partnership form, LLP or AOP, BOI, then also both these will be treated as associated entities. I will give one example. A Limited is there, ABC and Co is there. A Limited is holding, having 35% profit sharing ratio in ABC and Co. Now A Limited and ABC and Co both will be treated as associated. Able to understand? So these are 12 different cases of associated. I hope you understood what associated enterprise means. If you understand, leave the comment, sir, we understood. Okay. I hope you are finding this session interesting. We discussed what international transaction means. We discussed what associated enterprise means. Next, I am going to discuss about arm's length price. 92C, arm's length. See, to calculate arm's length price, there are 5 different methods. First one is comparable uncontrolled price method, CUP method, comparable uncontrolled price method. Second one is resale price method, second one. Third one is cost plus method. Fourth one is profit split method. Fifth one is transactional net margin method. So there are 5 methods to calculate arm's length. We will discuss one by one, then we will solve problems also, so that you will get better clarity, no confusion. First, comparable uncontrolled price method. See, one company is doing transaction with associated enterprise. The same company is also doing transaction with unrelated party. Okay, so A limited is there, B limited is there. Both are associated enterprises. Now A limited is making payment. A limited is making payment to B limited. A limited is also making payment to C limited. C limited is unrelated party. Okay. Now, whatever the payment made to unrelated party is there. See, payment made to related party, associated enterprise, it is influenced price, right? And whatever payment made to C limited is there, it is uninfluenced price. So, we will take uninfluenced price as base. To this, we will make plus or minus. We will make adjustment of functional differences. Functional differences, we will make adjustment. After making that adjustment, whatever the price that we are going to arrive, that we call as, are able to understand, that is comparable uncontrolled price method. When one company is doing transaction with its associated enterprises and it is also doing transaction with unrelated party, then we will apply CUP method. Whatever the transaction that is done with unrelated party, that will be taken as base. Some differences, functional differences will be adjusted and we are going to arrive at arm's. So that arm's length price will be compared with actual price and income will be added. Shall we do one problem so that you will understand better? Hmm. Yeah, comparable uncontrolled price method. I hope you are having institute material with you. If you are not having institute material, I am going to share with you right now. I am sharing this in the group. I have shared it in the group. You can download also. US Limited, a US company, has a subsidiary IND Limited in India. US Limited, subsidiary means what? More than 50% stake. If it is subsidiary, both will be treated as associated enterprises. So there are two companies basically, uh, US Limited and India Limited, IND Limited. US Limited is incorporated in USA, IND is incorporated in India. Now, US Limited also sells computer monitors to CMI Limited, another computer reseller. Okay, so there is unrelated party CMI Limited. So, like IND Limited purchases computers, CMI Limited also purchases computers from US Limited. It sells 50,000 computer monitors to I&D Limited at the rate of 11,000 per unit. So what is the price that is offered? Purchase price is 11,000 per unit. How many units? 50,000. The price fixed for CMI Limited is 10,000 per unit. So what is the price? 10,000 per unit. CMI Limited is purchasing for 10,000 rupees. However, I&D Limited is purchasing for 11,000 rupees. And here both I&D Limited and US Limited are associated enterprise. By this time, it is fishy. Associated enterprise. I&D Limited is paying excess 1,000 rupees to US Limited. Why excess expenditure? Because if I increase my expenditure, my profit decreases and my tax also decreases. So the reason for paying extra expenditure to associated enterprises to decrease my profits. In this case, we need to calculate transaction at arm's length price. First of all, both are associated enterprises. US is incorporated in USA, Ind Limited is incorporated in India. It is international transaction. So in case of international transaction, we need to calculate transaction at arm's length price. Well and good. Here comparable transaction is available. Whatever US company is there, it is selling to us. It is also selling to CMI Limited. So we are going to take whatever, this is uninfluenced price, right? 10,000 rupees. We will take this as base and we will do some adjustments. Thereby we are going to arrive at arm's length price. Are you able to understand? The warranty in case of sale of monitors by Ind Limited is handled by I&D Limited. However, sale of monitors by CMI Limited, US Limited is responsible for warranty for 3 months. See, for outsider, he is giving warranty 3 months. However, for associated enterprise, warranty is 0 months. No warranty. Warranty was not given. So we will adjust. For unrelated party also, if warranty is not given, generally if warranty is not given, price decreases. So we will bring both of them to comparable terms. So we will adjust functional differences. So what is functional difference? For associated enterprise, no warranty. For unrelated party, warranty is given. So this is at no warranty level. This is at warranty level. Now we will bring transaction with unrelated party also at no warranty level. Then we will compare. Are you able to understand? So what is base? Always base is uninfluenced price. So base uninfluenced price, how much? Uninfluenced price is 10,000 rupees. If no warranty is given, cost will reduce. So reduction in cost if no warranty. Warranty cost is 1,000 per annum into 3 months na 3 by 12. How much? I think 250 rupees. So how much is arm's length price? Arm's length price is 9,750 rupees. That means they should pay 9,750, but actual price paid is 11,000 rupees. Now how much excess expenditure paid? Excess expenditure paid is equal to 1,250 rupees. Are you able to understand? Excess price paid is 1,250. Whatever excess price paid, 1,250 rupees into 50,000 units. Okay, that will be added to 11,000 into 1,002. 1 crore 37 lakh. Am I correct? Wait, 1,250. Sorry. 625 lakhs. I did calculations. I hope you understood CUP method, comparable uncontrolled price method. Now shall I move to next method, second method? Second method is resale price method. Sir, what do you mean by resale price method? When it is applicable? When I purchase goods from my associated enterprise, and sell these goods to outsider, unrelated party. In this case, resale price method is applicable. I will do reverse calculation. Whatever the resale price is there, that I will take as base from this normal GP margin. If I sell to outsider, how much gross profit I will maintain, that gross profit margin I will reduce, and then I will reduce like whatever the purchase related expenses are there, those purchase related expenses I will reduce. Thereby, I am going to arrive at arm's length price. Are you able to understand? So, when you are calculating under resale price method, what is base? Base is resale price. You will take resale price as base. From that resale price, you are going to reduce GP margin. After reducing GP margin, then you will reduce or add purchase related expenses or functional differences. After doing these adjustments, whatever that you arrive at, that we call as, able to understand. So when resale price method is applicable, you are purchasing from associated enterprise and selling to unrelated party. Then resale price method is applicable. You will consider resale price as base. You will reduce your normal GP margin. You will do adjustments for functional differences or purchase related expenditure. Then you are going to arrive at price. Are you able to understand? Shall we do one problem? Earth Private Limited. I hope you are following. Now, Earth Private Limited, Kolkata, is engaged in trading of electronic goods. It purchased goods from its associated enterprise, Sun Pte Limited, Singapore, and also purchased from unrelated party, Oceania Limited, UK. So, there is one company, Earth Private Limited. There is Sun Pte Limited, and there is Oceania Limited. Earth Private Limited and Sun Pte Limited both are associated enterprise. Oceania Limited is unrelated party. Now what's happening? Earth Private Limited is purchasing from Sun Pte Limited. For financial year 24-25, GP margin was 15% on sale of goods of Sun Pte Limited and 20% in case of Oceania Limited. So it is purchasing and reselling. So at the time of resale, what is GP margin? 15%. But whenever Oceania goods are resold, then GP margin is 20%. That means what? For outsider, we are adding 20% profit. For associated enterprise, we are adding only 15% and are selling to outsider. Here, what is influenced? Whatever the margin with associated enterprise is there, that is influenced. So we do not consider this. Whatever the uninfluenced margin is there, that means if he is doing with outsider, whatever the margin that he is leaving 20%, this is like uninfluenced margin. So we will consider 20%. Are you able to understand? After sales warranty of 6 months was provided by Sun Pte Limited, whereas Oceania Limited gave after sales warranty of 1 year. So Oceania gave after sales warranty of 1 second. So our associated enterprise is providing how many months warranty? It is providing 6 months warranty. However, unrelated person is providing 1 year warranty. So we need to bring it comparable terms. We need to adjust the functional difference. The cost of warranty may be taken as 2% of sale price. Sun Pte Limited brand value is internationally known and the benefit of brand value can be taken as 1% of sale price. So Sun Pte, it is renowned. Oceania Limited is not known. You know, right? Whenever brand is higher, they will charge price for their goodwill. Apple charges so much of price for its goodwill, still customers will pay. Okay, now we need to bring both of them at comparable terms. Then we need to do the calculation of arm's length price. During financial year 24-25, it sold goods of Sun Pte Limited 20 crores, Oceania Limited 15 crores. So 15 crores goods are sold, 20 crores goods are sold. When resale price method is applicable, when you purchase goods from associated enterprise and sold to outsider. How much is sold to outsider? Like goods purchased from associated enterprise and sold to outsider is 20 crore rupees. So we will take 20 crore rupees. I will draw one P&L account. Through this, I am going to explain. So how much associated enterprises goods are sold? 20 crore rupees. Actually, GP margin is 15%. But ideally, how, like if it is doing transaction with outsider, how much GP margin is there? 20% GP margin is there. So we will consider 20% GP margin. How much? 20 into 20%, 4 crores. See, if you compare Sun and Oceania, Sun is providing only 6 months warranty, Oceania is providing 12 months warranty. Okay, now if Sun also provides another 6 months warranty, our cost increases na. Whatever the increase in cost that would have been there, that cost we need to add. That means we need to debit. So cost of additional 6 months warranty. How much? 20 crores into 2%. This 2% is per annum. We want only for 6 months into 6 by 12. How much? 20 lakh rupees. Next. Sun Limited is renowned. Oceania Limited is not known. If Sun Limited is not known, and we need to bring both of them at comparable terms. For example, if Sun Limited is also not known, then we need not pay extra 1%, right? There will be decrease in price. So there will be decrease in price by 1%. Am I correct or not? So whatever decrease in price is there, that is the benefit. So that we need to credit it to P&L account. Reduction in price. If you do the transaction with unrelated party compared with Sun Pte Limited, there will be decrease in price by 1% because Sun Pte Limited is charging for goodwill. How much it will be? Again, 20 crores into 1%, 20 lakh rupees. So how much is the expenditure payable? Expenditure payable, which is nothing but arm's length price, that is balancing figure. That arm's length price is balancing figure. How much? 16 crore. So arm's length price is 16 crore rupees. Did you understand? That is the calculation with regard to second method, resale price method. Next, cost plus method. I hope you understood resale price method. Tell me that you have understood resale price. ALP means arm's length price. I hope you have taken coaching previously. Cost plus method. See, we are not doing transaction with anybody. We are doing transaction. There is software company in USA. There is software company in India. We do backup services. We provide backup services to software company in USA. We do not do transaction with any other person. So when we do transaction only with associated enterprise, then at what price we will sell, that there is no unrelated party na, to compare this transaction with another. There is software company US Limited and there is software company India Limited. India Limited only do backup service to US Limited. Now India Limited is not doing transaction with any other person. So in this case, whatever the billing, whatever the sale price that it has done, that we cannot compare with another person. So this is influenced, sale price is influenced. See, they can influence price, but they cannot influence cost na. If they reduce cost, it is up to them. Okay, it is loss to them. If they reduce their cost, it will be loss to them. So uninfluenced is cost. So we will take cost as base, direct cost, indirect cost. Then to this we are going to add GP margin. By adding GP margin, we are going to arrive at arm's length price. Are you able to understand? But sir, how do we get GP margin? Here, India Limited is doing only transaction with US Limited. It is not doing transaction with any other company. If the same type of another company in the industry, if another company in the industry also provides same type of services to its holding company in USA, whatever the GP margin it charges, that GP margin we are going to take as base for the purpose of calculation of arm's length price. Are you able to understand? Now, shall we do one problem on this? Another important point, while calculating GP margin, if there are any functional differences, they will be adjusted. After adjusting functional differences, then we are going to arrive at right GP. Okay. ABC Limited, Canada holds 35% shares in LMN Limited, India. LMN Limited develops software and does both on-site and off-site consultancy services for the customer. So there is ABC Limited, LMN Limited, LMN Limited. Now ABC Limited is holding 35% stake. So can we call both as associated enterprises? Yes, we can call both as associated enterprises. LMN Limited. So LMN Limited is providing services to ABC Limited. Am I correct or not? Now LMN Limited during the year billed ABC Limited Canada for 120 man hours at the rate of 1800 per man hour. So what is sale value or what is service value? 1800 per man hour into 120 man hours. So how much is billing value? 1800 into 120 rupees, 2,60,000 rupees. What is the cost of execution? Cost of execution is 2,25,000. However, LMN Limited billed XYZ Limited India at the rate of 2,800 per man hour for the similar level of manpower and earned GP margin of 50% on its cost. So, what LMN Limited is doing? LMN Limited for outsider. For outsider, how much was billed? For outsider, 2,800 per man hour was billed. And how much is GP margin? GP margin is 50% on cost. So how do we calculate arm's length price? With associated enterprise, whatever the sale value is there, this is influenced. As sale price is influenced, we do not consider this sale value. What we will do, we will take cost. For this cost, whatever this GP margin is there, that GP margin will be added, and thereby we are going to calculate arm's length price. Are you able to understand? Now, how much is GP margin? 50%. For this 50%, we need to do functional adjustment. What is that functional difference adjustment? The transaction of LMN Limited with ABC Limited and XYZ Limited are comparable subject to following difference. While LMN Limited derives technology support from ABC Limited, there is no such support from XYZ Limited. The value of technology support received from ABC Limited may be put at 18% of normal gross profit. See, normally From ABC, it is going to get some support. But from outsider, no support was received. If no support is received from outsider, we need to increase the cost. We need to recruit and we need to increase the expenditure. Whenever our expenditure increases, our profit margin also decreases. So generally, let us write P&L. How much is our, like, for with unrelated party, how much is our GP margin? GP margin is 50% on cost. 50% on cost. But from unrelated party, we do not get any support. If we do not get any support, we need to incur the expenditure. So how much is cost of support expenditure? Cost of support 18%. 50 into 18%, 9%. That we need to. As ABC Limited gives business in large volumes, LMN Limited offered ABC Limited a quantity discount which may be valued at 10% of normal gross profits. See, ABC Limited is providing huge volume, unrelated nominal volume. If huge volume is provided, then obviously more discount will be given, right? When we give more discount, our profit will decrease. So basically our profit is 50%. From that profit, we are incurring expenditure. If expenditure increases, support expenditure. So if expenditure increases, our profit decreases. As profit decreases, we need to reduce 9%. Similarly, when we give huge discount is also expenditure, right? Whenever we give discount is expenditure. Whenever discount is given, our expenditure increases, profit decreases. So how much is discount given? 10%. 50 into 10%, 5% is required to be reduced. Next, third functional difference. In case of rendering services to ABC Limited, LMN Limited neither runs any risk nor incurs any marketing cost. On the other hand, in case of services to XYZ Limited, marketing cost is 12%. That's what. If I want to sell to my parents, I can sell easily. If I want to sell to outsider, that is difficult. Like I am teaching direct taxation. If I wanted to sell to my brother, okay, he already knows I will teach direct taxation. He will purchase. But if I want to sell this to you, you should know me, na. That is the bigger task now. Even though like I should reach to maximum people. That's the criteria now. So then only people will buy course from me. So whenever you are doing transaction with outsiders, you need to incur lot of marketing cost. Okay. So whatever the marketing cost is there, that is also expenditure. If expenditure increases, profit decreases. So 12%, 50 into 12% means 6% that you will reduce. So how much is ideal GP margin? Ideal GP margin for transaction with outsider. That means when you do transaction with outsider, your GP margin will be 50 minus 9 minus 5 minus 6. Your GP margin will be 30%. Am I correct? Yeah, another difference was also there. LMN Limited offered 1 month credit to ABC Limited. Cost of providing such credit may be valued at 2% of gross profit. No such credit was given to XYZ. What is this? LMN Limited for ABC Limited gave credit period of 9 days. Sorry, credit period of 90 days. For outsider, no credit period was given. As no credit period was given, if credit period was not given, our price, like our cost, our expenditure decreases. Correct? So that we need to add. So credit period not given, then our expenditure decreases. In that case, profit increases. 50 into how much it was? 2% of gross profits. 2 into 50%, 1%. That is required to be. So ideal GP margin will be 31. So we know the cost, right? We know the cost. Cost is 2,25,000. So for this cost, we need to add GP margin. Thereby, we are going to arrive at 2,25,000 into 31%. 2,94,000. That is arm's length. That will be compared with actual build 2,16,000. How much is under billing? Under billing is 78,750. That will be added to the. Are you able to understand? Next method is profit split method. Sir, in case of profit split method, we are going to divide the profits between associated enterprises based on the functional risk assumed and the extent of work performed. See, what we will do, let's say transaction is like we will take total bill value, we will take total cost. Whatever the total profit is there, that profit will be split. This profit will be split between two or more associated enterprises. Thereby, we are going to arrive at arm's length price. Let's say like A limited, B limited, C limited is there. A limited bill value, like let's say cost is 80,000 rupees, profit 20,000, bill value 1 lakh rupees. But total cost, for example, let's say total cost is 10 lakh rupees. Sorry, total bill value is 10 lakh rupees. Total cost is 9 lakh rupees. Then how much is profit? Profit is 1 lakh rupees. But A limited contributed for 20% of risk. That means whatever the risk that is there in the contract, 20% of risk and 20% of the work was done by A limited. Now what we will do? We will take A limited cost 80,000 rupees. So A limited bond 20% of risk, right? Now profit will be, okay, hold on. A limited has bond 35% of risk. Now what we will do? 1 lakh into 35%, 35,000 we will add and arm's length price will be 1,15,000 rupees. Are you able to understand? For example, let's say the risk was assumed in the ratio of 35 is to 30 is to 35%. Now, what is the ratio of risk? 35%. Na? So, normal GP that will not be considered. Whatever its profit share is there based on risk, that will be considered in calculation of price. That is profit split method. Last one is TNMM, transactional net margin method. See, in case of TNMM, transactional net margin method, cost plus method, we will consider gross profit. In transactional net margin method, we will consider net profit of similar companies. Let's say I am into manufacturing of medicines. The same manufacturing company of medicines. Let's say I am Reddy Labs. There is Sun Pharma. How much Sun Pharma is charging when it is doing transaction with its associated enterprise? What is the net profit margin? That net profit margin I will consider in calculation of arm's length price. That method we call as transactional net margin method. Are you able to understand? So transactional net margin method, you please try to do this problem. It is easy only. If you have any doubt, you can ask me in the Telegram group. Okay. So this is all about computation of arm's length price. So we discussed about international transaction, associated enterprise, 5 different methods of computation of arm's length price. We also have done 3 problems on this. With this, I hope you got clarity about calculation of arm's Next, we will move ahead. We will discuss advanced concepts. Sir, there are 4 arm's length prices available. Let's say arm's length price 1 800 rupees, arm's length price 2 750 rupees, arm's length price 3 600 rupees, arm's length price 4 870 rupees. So up to 5 arm's length prices if are available, then what you will do? You will do average. How to calculate average? 800 plus 750 plus 600 plus 870. Okay, 3020 divided by 4. How much? 755 is average price. Able to understand? So if you like, there is possibility na you can calculate multiple arm's length prices. So if more than one arm's length price is available and up to 5 arm length prices are available, then what you will do? You will calculate average arm length price, and this average arm length price is final. Okay, this is, sir, what if more than 5 arm length prices are available? If more than 5 arm length prices are available, then in that case range concept is. Sir, what is range concept? Let's say I am having 6 to 7 arm length prices. 100, 110, 120, 125, 128, 130, 135, 140, 142. So how many? 1, 2, 3, 4, 5, 6, 7, 8, 9. So here I have more than 5 arms length prices. Now what I will take? I will take 35th percentile. 35th percentile. That means 9 into 35%. How much? 9 into 35%. It is 3.15. 3.15 is not a whole number. It is not a whole number. So you will consider next number. Next number means you will consider 4. So what is 4? This 125. This is lower limit. Next, you will take 65 percentile. 65, 9 into 65%. How much? 9 into 65%. 5.85. 5.85 is also not a whole number. You will consider next one. Next one is 6. So what is sixth number? 130. This is upper limit. So if your transaction price is in between 125 to 130, that means if your transaction price is in the range of 125 to 130, then that price will be considered as arm's length price. If your transaction price is not in the range of 125 to 130, listen, your transaction price is within the range, then no adjustment is required. No adjustment is required. If your actual price is 140 rupees, it is not within the range, right? Not within range. Then what you need to consider? You need to consider, as it is not within the range, then arm's length price is equal to 50 percentile. 50 percentile means 9 into 50%, which is 4.5. 4.5 is not a whole number. So you will consider next. Next is 5. So how much is 5? 5 is 128. 128 will be considered as price. Able to understand? So this is the concept relating to range. Here another thing is there. Here, sir, what if in this case, if it is a whole number? For example, here it is not 3.15, it is 3. 3 is whole number, na? Then will you consider 120? You should not consider 120. If you get whole number, if you get whole number for lower limit or upper limit or for 50 percentile, then what you need to consider, that whole number plus next number divided by 2. You need to consider this average as lower limit or upper limit or 50th percentile. For example, here for suppose 35th percentile is 3. Then what you will do? You will take third one, you will take fourth one, 120 plus 125 divided by 2. How much? 122.5 I think. Yeah, 122.5 will be considered as lower limit. So when you are calculating 35th percentile or 65th percentile or 50th percentile, if you get whole number, don't take whole number plus next number divided by 2. That average you need to consider as lower limit or upper limit or 50th percentile. Okay, that is range concept. Now up to 3% tolerance band is available. Sir, what do you mean by 3% tolerance band? If arm's length price is greater than 103% of actual price, then arm's length price will be taken as final. However, if arm's length price is less than or equal to 103% of actual price, then actual price will be considered as. That means what? See, how can actual transaction price and arm's length price, how can both the same? Both will be the same. There will be some difference, na? So that is why actual transaction price, arm's length price. In between these two, if there is a difference up to 3%, then it will not be considered. It will be ignored. If difference is more than 3%, then arm's length price will be considered. Are you able to understand? But if you are in wholesale business, instead of 3%, 1% will be considered. Is it clear? Section 92C3. Generally, SSE is required to calculate arm's length price. That means on suo motu basis, on self-assessment basis, SSE himself is required to calculate arm's length price. But there are 4 cases. In these 4 cases, arm's length price will be calculated by assessing officer. Arm's length price will be calculated by AO. Sir, what are those 4 cases? Case 1, AO feels you did not follow most appropriate method. Appropriate. See, there are 5 methods. I followed comparable uncontrolled price method. Assessing officer came, he is saying in this transaction you should not follow cup method, but you need to follow transactional net margin method. So I followed one method. Assessing officer is feeling like transactional net margin method is required to be followed. So when there is difference of opinion in calculation method, in that case assessing officer will calculate the arm's length price. Next, second case, AO feels data used for calculation of arm's length price is not correct. What do you mean by this? Let's say I calculated one arm's length price. To calculate the arm's length price, I considered only one company, Sun Pharma Limited. Assessing officer is saying there are 200 companies available. Why you take only one company? Assessing officer feels that at least 20 companies should be taken. So whenever assessing officer feels the data that I used in calculation of arm's length price is not correct, then assessing officer himself will calculate the arm's length price. Next, third case. If assessing officer feels that documentation is not prepared as per section 92D. Generally, documentation is required to be prepared as per section 92D. Otherwise, 2% of transaction value penalty will be levied. So there is section 92D. It will tell what are the documentation that is required to be maintained. If such documentation is not maintained, assessing officer will calculate the price. Next. Assessing officer will ask information from SSE. If SSE fails to submit information, info to assessing officer. In that case also arm's length price will be calculated by SSE. Okay. Next. Next we discuss advance pricing agreement. So much important APA. Very important. I want everyone's attention. If you are feeling drowsy after doing this much of lengthy class, calculation and all, wake up or wash your face and come, because advance pricing agreement very important. Question can be asked. Appa. Shall we discuss Appa? Please comment us. Are you alive or you kept your mobile phone in front of you and sleeping? Now, see, in transfer pricing, there is more chance for litigation. I will follow cup method, then assessing officer will tell you should not follow cup, you should follow transactional method. Or I will take 5 companies for calculation of arm's length price. Assessing officer will come and tell no, not 5 companies, you should take 8 companies to calculate arm's length price. There is so much of litigation that is there in case of transfer pricing. So to counter this litigation, like central government came up with one concept that is called as advance pricing agreement. Sir, what advance pricing agreement means? Like CBDT and SSC both will sit on one table and they will finalize arm's length price, like arm length price computation method, and how arm's length price is calculated with how many companies as base, and what is the data that will be used for calculation of. Once they come to an agreement, then there is less scope for dispute. Now, if there is no agreement, we do not know what department will follow to calculate the arm's length price. We do not know how many companies data that department will take to complete the arm's length price. So ambiguity is there, confusion is there, there is no certainty. When there is no certainty, there is more scope for litigation. So that is why CBDT, after taking approval of central government, CBDT will enter into agreement with the SSC. Both of them will come together and they will discuss what is the transaction, what are all the activities that are done by the SSC. Based on that, both will come to one agreement. What is the method followed for computation of arm's length price and how that arm's length price will be computed. Once this method is finalized, then there is no litigation. Now, complete clarity is there. I know what department follows for calculation of arm's length price. I know how department calculates the arm's length price. So there is certainty. For this certainty, SSC will enter into advance pricing agreement with CBDT. Okay, sir. Whatever this agreement is there, is this binding on department? Yes. Is it binding on department? Yes, it is binding on department till CIT or PCIT level. That means whatever the terms and conditions of agreement are there, those terms and conditions are also required to be followed by commissioner and commissioner. Okay, whatever the agreement is there, it is applicable to SSC, it is also applicable to the department till the level of CIT or PCIT. Able to understand? Now you will get so many doubts. Sir, for how many years we can enter into advance pricing agreement? Are we required to pay any fees? Yes, you are required to pay fees if you want to enter into advance pricing agreement. Generally, the year in which you wanted to enter into advance pricing agreement. Before starting of that year only, you should make application for APPA, advance pricing agreement. For example, let's say I want to enter into advance pricing agreement for previous year 24-25. In 24-25, if I make application, I cannot enter into advance pricing agreement. I should make application before 24-25 only. Let's say I made application on 25th February 2024. So it is in previous year 23-24, right? In 23-24, I made application for advance pricing agreement from 24-25 onwards. Are you able to understand? So if I make, sir, for how many years I can make advance pricing agreement? I can make application for advance pricing agreement for 2 years, 3 years, 4 years, like that. But maximum advance pricing agreement I can make is for 5 years. Okay. Generally, every person will make application for 5 years advance pricing agreement. Sir, why, sir? Because advance pricing agreement itself will take 1 year, 2 years. If you enter only for 2 years, by the time agreement is entered into, already that 2 years will be over. So you cannot do anything. So in general cases, everybody will enter into APPA for 5 years, advance pricing agreement for 5 years. So let's say I made application for 24-25, 25-26, 26-27, 27-28, 28-29, 5 years. See, for these 5 years, I made application for APPA. Sir, can I also make application for already completed years, already earlier years? Yes. You can make application for advance pricing agreement for earlier years also. For how many earlier years I can apply for APPA? Maximum I can apply for 4 earlier years. So that if I make application for advance pricing agreement for earlier years, then that concept we call as rollback provisions. Are you able to understand? So here, if I want, I can make application for completed years also. But for 4, if I want to make application for completed years, I should mandatorily apply for 4 years. See, APPA, my wish, I can apply for 1 year, 2 year, 3 year, 4 year. But if you want to apply for rollback provisions, you need to mandatorily apply for 4 years rollback provisions with fees of 5 lakh rupees. So I will apply for rollback provisions also. I will pay 5 lakh rupees. For how many years rollback provisions are applicable? For 4 years. So previous year 23-24, 23-24, 22-23, 21-22, 2021. For these 4 years also, I can apply this we call as rollback provision with fees of 5 lakh rupees. I hope you are following. Kindly bear with me as there is no one-to-one connection. I'm expecting comments from you. Sir, that means effectively APPA is applicable for 9 years. Am I correct? So for 5 years plus rollback 4 years. Next. Sir, I wanted to apply only for APPA 5 years. Can I apply? Can I apply? Yes. I wanted to apply for APPA and rollback total 9 years. Can I apply? Yes, you can apply. Sir, I wanted to apply only for rollback. Can apply? No, not possible. Okay. See, marriage is mandatory. Children are optional. APPA is mandatory. Rollback is optional. Okay. We don't want marriage. We want only children. Not correct. Okay. We don't want APPA. We want only rollback. Not possible. Okay. Simple logic. So if you want rollback, mandatorily you should enter into APPA. Along with APPA, you can also enter into rollback provision. Are you able to understand? See, when I made application on 28th February 2024. Now, company that CBDT, both will have so many negotiations, both will sit and they will discuss what the thing and all. So they came to APA agreement. APA agreement entered on 4th December 2026. By 4th December 2026, already like previous year 2021 to previous year 25-26 ITRs are filed. Correct? Already these ITRs are filed by me. So whatever this period is there, previous year 2021 to previous year 2025, 25-26, these returns are already filed na by the time I enter into APPA. So from 2021 to 25-26, I followed comparable uncontrolled price method. In APPA, what is agreed is transactional net margin method. But how I already filed return based on APPA na? I already filed based on comparable uncontrolled price method. Now as per APPA, I need to file return based on transactional net margin method. What I will do, as already returns were already filed, now I am going to file modified return for previous year 2021 to previous year 25-26 within 3 months from end of month in which I entered into APPA. From end of month in which I entered into APPA. Are you able to understand? So no problem at all. Like by the time APPA was entered, advance pricing agreement was entered. If already earlier years returns were filed, now we will modify those returns within 3 months from end of the month in which advance pricing agreement was entered into. Are you able to understand? Now, for these years, ITRs were not filed. Na? ITRs not filed. For those 3 years, while calculating arm's length price, I will follow transactional net margin method only as agreed as per advance pricing. See, for these 6 years, ITR was already filed na for these 6 years. For 23-24, scrutiny 143 assessment is over. As 143 assessment is over, now they will do modified assessment as per transactional net margin method. For 24-25, assessment is pending. If assessment is pending, then they will do assessment as per APPA, advance pricing agreement, based on transactional net margin method. For any previous year, if any IT8 order is passed, if IT8 order is passed, it is conclusive now, it is already final. As IT8 order is already passed, they will not touch even though advance pricing agreement was entered into. Are you able to understand? Next. Because of APPA, if your returned income decreases or if your returned loss increases, then advance pricing provisions are not applicable. That means what? Advance pricing agreement provisions are not. Now you will get doubt. Then why will he enter into APPA, sir? The reason he enters into APPA is his income will be reduced or his losses will be increased. But they should not be increased beyond, returned income should not be decreased beyond returned income as well as returned loss. See, I will tell you one example. ITR income 80 lakhs. Assessing officer will do assessment na 143 scrutiny assessment. As per scrutiny assessment, assessed income is 140 lakhs. APPA is 110 lakhs. Now, SSC will enter into APPA so that he is not required to pay tax on 140 lakhs. At least he will pay tax on 110 lakhs. That means what? By advance pricing agreement, your income can be less than assessed income, but your income should not be less than returned income. Are you able to understand? So that is the concept. Why APA is entered into to reduce their income from assessed income, but they cannot reduce their income below returned income by entering into advance pricing agreement. So by entering into APA, if their APA income is less than returned income, then APA is not applicable. If advance pricing agreement income is less than assessed income, in that case advance pricing agreement is applicable. Are you able to understand? So this is the concept relating to advance pricing agreement and rollback. I hope you understood APA and rollback provisions. Now I am going to discuss with you secondary adjustment. So till advance pricing agreement, I hope you are clear. If you are clear, please say yes. Now we are going to discuss secondary adjustment. So everybody, are you clear with regard to APA and rollback provisions? Very, very important concept for your exam. A question is expected. APA and rollback provisions. Secondary adjustment is also important, which I will explain. So shall I start explaining secondary adjustment? Everybody. Next, secondary adjustment. Before we discuss secondary adjustment, first let us discuss what primary adjustment. If you understand primary adjustment, secondary adjustment you will easily understand. There are two companies, A Limited and B Limited. A Limited is incorporated in India, B Limited is incorporated in USA. Now, A Limited paid paid 15 lakh rupees for expense. Arm's length price is only 10 lakhs. Okay. Now, how much excess paid? Excess paid is 5 lakh rupees. Now, so this 5 lakh rupees will be added to income of S. Let's speak in terms of crores because 15 crores, 10 crores, excess price paid 5 crores. Now 5 crores will be added to income of the SSC. Whatever this 5 crores is there, this we call as primary adjustment. So when you compare it with arm's length price, whatever the increase in income is there, increase in income will be considered as primary adjustment. Till here, you have no doubt, right? You are very much clear. Our finance minister, Nirmala Sitharaman, she said, sir, 5 crores income was added. You paid excess 5 crores to your associated enterprise, na? Actually, you need to pay 10 crores. But how much you paid? You paid 15 crore rupees. You paid excess 5 crore rupees to associated enterprise, na? Bring back that 5 crore rupees from your associated enterprise because you are paying 5 crores in dollars. For example, there is foreign currency outflow. Because of foreign currency outflow, Indian rupee value is decreasing. So Nirmala Sitharaman asked to bring back those 5 crore rupees excess payment within 90 days. Are you able to understand? So SSC should bring back 90 crores from associated enterprise. Sorry, 5 crores from associated enterprise within 90 days. Sir, what if he do not bring back? If he do not bring back, then 5 crores will be deemed as loan given to associated enterprise. Loan given to So the thing is, you intentionally paid 5 crore rupees access to your associated enterprise. Now bring back that 5 crore rupees. If you do not bring back, we will deem you have given 5 crores loan to your associated enterprise, and on that 5 crore rupees, every year interest income will be added to total income of SSC till he bring backs. If he brings back after 80 years, for all 80 years, every year interest income will be calculated, and that interest income will be added to the total income of the SSC, and on that interest income, every year he is required to pay tax for next 8 years. So observe how much strict she is. Okay, so whatever primary adjustment amount is there, that you should bring back to India within 90 days. If you do not bring back that money, whatever that amount is there, that will be deemed as loan given to your associated enterprise, and whatever the deemed loan is there, on this deemed loan, there she is going to charge interest income. Whatever that interest income that will be charged every year is there, that will be called as secondary. Are you able to understand? So you have one option, like you unfortunately paid extra. Now bring back that extra within 90 days. If you fail to bring back that extra within 90 days, then whatever the amount that you have paid is there, that will be deemed as loan given, and on that loan given, you are like every year interest income will be added. Sir, what is the rate of interest? I will tell you. Okay. So did you understand what essentially secondary adjustment means? See, whatever secondary adjustment is there, secondary adjustment is done only if primary adjustment is more than 1 crore. If primary adjustment is less than 1 crore, na, it is bacha. On that, secondary adjustment will not be done. Similarly, if primary adjustment is relating to is for assessment year 16, 17 or earlier years, then this secondary adjustment concept is not. Secondary adjustment concept was introduced in 2016. Okay, so that's why up to 2016, if there are any primary adjustments, you do not know the provision, secondary adjustment concept is not applicable. But from assessment year 16, 17 onwards, from 1st April 2016, like 15 onwards, yeah, secondary adjustment concept came in 2015. So from assessment year 16, 17, that means from for assessment year 16, 17 or earlier years, if you have done primary adjustment, then secondary adjustment concept is not applicable. After assessment year 16, 17 only, secondary adjustment concept is applicable. Are you able to understand? What is the interest rate? Interest rate is, if transaction denominated in Indian currency. If transaction is denominated in Indian currency, then rate of interest rate is SBI 1 year marginal cost of lending rate as on 1st April of previous year. If transaction is denominated in foreign currency, transaction denominated in foreign currency, then you will consider LIBOR. You know LIBOR, right? London Interbank Exchange Rate. You will consider 6-month LIBOR as on 30th September of previous year plus 3%. Here it is plus 3.25. Now, I said whatever the primary adjustment is there, that should be brought into India within 90 days. Now, sir, how you will calculate that 90 days? Basically, secondary adjustment concept, secondary adjustment. This concept is applicable only in 5 cases. What are those 5 cases? Case 1, on suo moto basis, if primary adjustment is done. That means what? SSC himself disclosed arm's length price is 15 crores. He himself said extra 5 crores is paid. Then he should bring back 5 crore rupees within 90 days from due date. Okay? 90 days from ITR due date. Second case, assessing officer has done primary adjustment which is accepted by SSC. That means assessing officer increased income from 10 crores to 15 crores. SSC did not file any appeal. SSC did not object. SSC accepted increase of income of 5 crore rupees. In that case, SSC is required to bring extra 5 crore rupees within 90 days from date of assessment order. 90 days from assessment order. Next, case 3. If primary adjustment is due to safe harbor rules, safe harbor rules, then that primary adjustment amount is required to be brought within 90 days from ITR due date. Similarly, if primary adjustment is because of mutual agreement procedure, see in DTAA, certain lapses will be there. On certain incomes, there is no DTAA. So after entering into DTAA, whatever the uncovered items in DTAA are there, for those uncovered items, both countries will enter into mutual agreement procedure. So if primary adjustment is because of mutual agreement procedure, then whatever the extra primary adjustment is there, that should be brought into India within 90 days from date of agreement, from date of effect of mutual agreement, date of effect mutual agreement. Next, fifth case, primary adjustment is due to APPA, due to advance pricing. If primary adjustment is due to advance pricing agreement and advance pricing agreement is entered before ITR due date, before ITR due date, then whatever that excess primary adjustment is there, excess amount, that should be brought to India within 90 days from actual ITR filing date. If APPA entered after ITR due date, then you need to bring within 90 days from end of month in which APPA is entered. I will explain you this, don't worry. What do you mean by this? See, APPA was entered on 4th December 2026. By 4th December 2026, already these returns were filed, na? ITRs were already filed. So, for these years, if there is any primary adjustment, that primary adjustment is brought to India within 90 days from end of month in which APPA is entered. APPA entered on 4th December 2026. What is end of month? 31st December 2020. From 31st December 26, 90 days means January 31, February 28, March 31, 90 days. So on or before 31st March 2027, they need to bring back that excess money to India within 90 days from end of month in which APA is entered. And for these 3 years, ITR not filed na. So for these 3 years, if there is any primary adjustment, that primary adjustment is to be brought to India within 90 days from ITR filing date. Are you able to understand? So that is the concept. So till here, are you clear? Are you able to understand the secondary adjustment? Next, sir, I gave 15 crore rupees. I need to give 10 crore rupees. But my associated enterprise is not giving me back 5 crore rupees. Now what to do? Every year Nirmalamma is adding 5 interest on 5 crore rupees. Is there any other option possible? Yes, there is option possible. If you don't want to bring 5 crore rupees to India, you should pay one-time tax. Are you able to understand? So you have two options. Option 1, like bring back to India in 90 days. Okay, that is option 1. Else, interest on deemed loan till you bring back that money to India. That is option 1. Option 2, pay one time tax. How much is that one time tax? That one time tax is 18% plus 12% surcharge plus 4% HEC. So this 12% surcharge and 4% HEC always you need to apply. That means how much is effective tax rate? Effective tax rate is 18 plus 12% plus 4%, 20.9664. Able to understand? So this is the effective tax rate. So either you bring back that excess money to India within 90 days. If you do not bring back, it will be deemed as loan. On the deemed loan, every year interest income will be added till you bring back that money. That is option 1. Option 2, pay one-time tax. You paid one-time tax after 3 years. For 3 years, interest income will be added. The day on which you paid one-time tax, after that interest will not be able to understand. So this is the concept of secondary adjustment. I hope you thoroughly understood secondary adjustment. Next, there is another important concept, section 94. Shall I explain section 94B? Limitation on interest deduction. This is also very important. Many times it will be asked in the exam. This time it is expected. So please listen carefully. When you pay interest to associated enterprise, total interest will not be allowed as, let's say there is Modi Limited, there is Trump Limited, both are associated enterprises. Now, Modi Limited took loan from Trump Limited. On this loan, Modi Limited will pay interest na. Whatever the interest paid, total interest is not allowed as deduction. Sir, then how much is the maximum interest allowed? Maximum interest allowed as deduction is equal to actual interest to associated enterprise or 30% of EBITDA, earnings before interest, tax, depreciation and amortization, whichever is only this much expenditure will be allowed. Whatever the excess expenditure is there, that will be disallowed. That is not allowed as deduction. I will take one example. Let's say EBITDA is 200 crores. Okay. Interest to associated enterprise is 80 crores. How much interest was paid? 80 crores. Interest to associated enterprise 80 crores, or how much is 30% of 200 crores? 200 crores into 30%, 60 crores. Whichever is lower means only 60 crores is allowed as deduction. Whatever the balance 20 crores is there, that 20 crores will be able to understand. So when you take loan from your associated enterprise, on that loan you are required to pay interest. Total interest is not allowed as deduction. Actual interest or 30% of EBITDA, whichever is lower, is allowed as. Okay. Modi Limited is very clever. Okay. So what Modi Limited did? Modi Limited, there is a Trump Limited. Both are associated enterprises. If Modi Limited directly takes loan, if it is taking loan, then if it takes loan directly, then 94B gets attracted, na 94B. So it will not take loan directly. What it will do? It will take loan indirectly. Trump Limited will do fixed deposit in HSBC Bank. Fixed deposit of 80 crores. Now HSBC Bank will give loan of 80 crore rupees to Modi Limited. Are you able to understand? Now in this case also section 94B is applicable. That means if associated enterprise indirectly gives loan to company in India, then also 94B provisions are applicable. Are you able to understand? See, if directly given, then obviously 94B provisions are applicable. Not only directly, but if indirectly given, then also 94B provisions are applicable. Able to understand? So careful. Or let's say same transaction. Same transaction. I will make some changes. Modi Limited did not give fixed deposit. Trump Limited did not give fixed deposit. Trump Limited gave guarantee. Whatever the loan 80 crores that is taken is there, on this guarantee was given. Even if guarantee is given, then also 94B provisions are applicable. Total interest paid to HSBC is not allowed. Interest paid to HSBC or 30% of EBITDA, whichever is lower, will be allowed as. So this is the concept relating to transfer pricing. Please do the problems also. After you finish doing the problems, if you get any doubt, please ask me in Telegram group. I hope you are enjoying this session. Thank you very much. Topic is trust taxation. Very important chapter in CA final. At least 8 to 10 marks can be expected from this chapter. Definitely one question will come from. So I request everyone to listen carefully till the end of this. Okay. Sir, what are the sections that we are going to discuss in this revision series of trust? We will discuss section 11, 12, 13, 115 BBC anonymous donations, 115 BBI, and 1023C related section. All these sections will be discussed in this class. First, I will start with section 11. I will take a fresh page. What section 11 says? First of all, section 11 says income derived from property held under trust. Whatever the income derived from property held under trust is there. For that, certain exemptions are given under section 11 and 12. The income derived from property held under trust of charitable or religious trust. Whatever that income is there, out of that income, 15% standard deduction is allowed. That means 15% of such income is not at all taxable and only balance 85% is taxable. Sir, what do you mean by charitable or religious trust? Charitable trust means any trust that is formed for to help poor or for the relief of poor or for the upliftment of poor. So the trust we call as charitable trust. Religious trust means any trust whose main objective is promotion of that particular religion. The trust we call as religious trust. So what section 11 says, whatever the income received by, whatever the income derived from property held under trust of charitable or religious trust is there. From that income, you can claim exemption under section 11 and 12. Now the question is, sir, what do you mean by income derived from property held under trust? Income derived from property held under trust means we can say rental income. For example, trust is having a function hall. Function hall is given on rent for marriage. So by giving function hall on rent, you are getting rental income. That rental income you can call as income derived from property held under. See, big trusts are there like TTD and Shirdi Sai Trust, Sri Sailam Trust. So many trusts are there. All these trusts, whatever the income that they receive, all that income they are going to claim exemption under section 11. So what section 11 says, income derived from property held under trust is eligible for exemption under section 11. Income derived includes rental income, not only rental income. See, what is the main income of trust? Donations. If you go to Tirupati, you will deposit some money in the hundi. Okay, so even whatever the donation income is there, even donation income is also considered as income derived from property held under trust. These donations are classified into two types: general donations, corpus donations. General donations are like treated as income derived from property held under trust. And whatever the corpus donation is there, corpus donation is not at all taxable. Corpus donation is fully exempt, subject to the condition whatever the amount received for corpus fund is there, that is to be deposited in safe modes as per section 11.5. Okay, what are those safe modes? I will discuss little later, but for the time being, please remember, like general donations are treated as income derived from property held under trust. Corpus donation is fully exempt. Sir, what do you mean by corpus trust? If any donation is given with specific direction, the donation should be used as a corpus fund of the trust. Then that donation we call as corpus fund, okay, or corpus donation. Let's say I went to Tirumala Tirupati Devasthanam. I gave 10 lakh rupees donation. I gave instruction. This 10 lakh rupees should be form part of corpus fund of TTD. Then that type of donation we call as corpus donation. So corpus donation is like capital receipt, which is not used generally unless in exceptional situations. Income derived from property held under trust also includes income from movable assets. Let's say on shares and securities, you will get interest income and dividend income. Even that income is also considered as income derived from property held under trust. So income from movable property. Anyhow, income from immovable properties is also treated as income derived from property held under trust. Next. Whatever the business income is there, see, Tirumala Tirupati Devasthanam is there, it is selling laddus, it is selling agarbattis, that is also business na. So if business is incidental to attainment of main objectives of the trust, then even that business income is also considered as income derived from property held under trust. Are you able to understand? Give me 1 second. ISKCON temple is there. It sell Bhagavad Gita books. Selling of Bhagavad Gita books is incidental to main objectives of ISKCON. So even that business income is also considered as income derived from property held under trust. But the only thing is, whatever the business income is there, for that separate books of accounts are to be maintained and are required to get audited. Then only business income will be included in income derived from property held under trust. Whatever the income that forms part of income derived from property held under trust is there, from that you can claim section 11 and 12 exemption. Capital gains. See, trust will have capital assets, right? On sale of capital assets, whatever the capital gains that are received are there. Even capital gains are also considered as income derived from property held under trust. Next, if there are any other receipts, even other receipts will also be considered as income derived from property held under trust. Let's say you wanted to do charity, you got some amount out of the donation, that will be included as income derived from property held under. Now what I said, whatever income derived from property held under trust is there, out of that 15% is straight away not at all taxable. 15% will be set aside. 15% standard deduction will be allowed, and only balance remaining 85% is taxable. So income derived from property held under trust. So out of this, 15% standard deduction is allowed. 15% standard deduction allowed. Balance 85% is there, right? Remaining 85%. Out of remaining 85%, whatever the amount that is applied for charitable or religious purposes is there, that is eligible for deduction. What do you mean by this? Let's say, for example, income derived from property held under trust is 80 lakh rupees. Out of 80 lakh rupees, 15% standard deduction is allowed. 80 lakhs into 15%, how much? 12 lakhs is standard deduction. How much is balance? 80 lakhs minus 12 lakhs, 68 lakhs. So out of 68 lakhs, whatever the amount that I have applied for charitable or religious purpose is there, that is allowed as deduction. Whatever the amount applied for charitable or religious purpose is there, that is allowed as deduction. Let's take an assumption I applied 20 lakh rupees for charitable or religious purpose. That will be allowed as deduction. Sir, you are saying 20%, like you are saying applied for charitable or religious purpose is allowed as deduction. What do you mean by applied? Applied means any expenditure incurred by trust for attaining its main objectives. Whatever the expenditure, TTD is incurring expenditure of salaries of employees and like daily annadhanam expenditure. So whatever the expenditure incurred by trust to achieve its main objectives is there, that expenditure we can consider as applied for charitable or religious purpose. Another important point, applied means both revenue expenditure and capital expenditure. Let's say there is Umasankar trust. Okay, I constructed a temple in that trust. In that temple, there is also a function hall. I wanted to give that function hall on rent. From that function hall, whatever the rental income that I receive, that rental income will be considered income derived from property held under trust. Now the thing is, in that function hall, it is normal function hall. I wanted to convert it into AC function hall. So I installed 8 ACs. Each air conditioner cost is 50,000 rupees. 50,000 into 8, 4 lakh rupees. It is capital expenditure na. Still total 4 lakhs will be allowed as deduction, because whatever the amount that I spent for charitable or religious purpose is there, whether it is revenue expenditure or capital expenditure, total expenditure will be treated as applied. Are you able to understand? So both revenue expenditure and capital expenditure will be allowed as deduction. Another important point, you will get doubt, sir, 4 lakh rupees air conditioners I claimed as expenditure, I treated it as applied. Again on that 4 lakhs, will depreciation is allowed? No. once you claim 100% of the capital expenditure, again depreciation is not allowed. So the thing is, once you claim capital expenditure, again depreciation in second year is not allowed. Who said? As per section 11.6. Okay. So the thing is, whatever the amount that you have applied for charitable or religious purpose is there, entire amount, whether it is revenue or capital expenditure, is treated as applied. But if you claim capital expenditure as applied, depreciation on such capital expenditure is not eligible for deduction from second year onwards as per section 11.6. So out of 68 lakh rupees, I claimed 20 lakhs. How much is balance? Balance is 48 lakhs. Sir, is there any way that I can reduce this 48 lakhs also? Before that, let me tell one point. Generally, whatever the income derived from property held under trust is there, 15% set aside. Standard deduction is allowed. Balance 85% is taxable. Out of that 85%, whatever the amount applied for charitable or religious purpose is there, that is allowed as deduction. Balance is taxable as per slab rates. Trust is AOP na, so for AOP slab rates are applicable, right? So whatever the income that is left after charitable or religious purpose is there, that is taxable at the rate of slab rates. If trust follows default tax regime, those slab rates are applicable, otherwise normal slab rates are applicable. Now next point is, sir, is there any way that we can reduce this 48 lakhs also? Here we need to pay tax on 48 lakhs. Can we reduce our income? Is there any possibility? Yes, there is possibility. What is that possibility? Explanation 1 of section 11.1. So as per explanation 1 of section 11.1, there are two ways further you can reduce your income. First option available is outstanding amount. Sir, what do you mean by this? I have function hall na. On 20th March 2025, I gave function hall on rent. Rent amount is 5 lakh rupees. I took advance of 1 lakh rupees. Balance 4 lakh rupees I did not receive. How much is rent? Rent is 5 lakhs. I received advance of 1 lakh. Balance 4 lakh was not received. Trustee is following accrual basis of accounting. If trustee is following accrual basis of accounting, then 5 lakhs will be included in the 68 lakhs, right? 5 lakhs will be included in 68 lakhs. In the 68 lakhs, 5 lakhs will be included. But how much I received? I received only 1 lakh rupees. On 20th marriage, on 20th March, there is marriage, but marriage got cancelled. Okay. So like there is disturbance and marriage got cancelled. Those people did not give money to the trust. Now what happened? I received only 1 lakh rupees advance, but as per accrual basis of accounting, I need to include 5 lakh rupees in my total income. Na? So now the thing is, whatever the amount that I did not receive, 4 lakh rupees, for those 4 lakh rupees, I will file declaration to assessing officer. Sir, whatever the outstanding amount is there, that outstanding amount I will apply in the previous year in which it is received or in the immediately next financial year. Are you able to understand? And now itself I will take that deduction. So here I will claim 4 lakhs as deduction. So 5 lakhs is rent, 1 lakh rupees I have received, balance 4 lakh rupees I did not get. In future I may get. So in future, whenever I receive that 4 lakh rupees, either in that year or in immediately next financial year, I will apply that 4 lakh rupees. Stating all this, I will file declaration to assessing officer. Then by filing declaration, I can claim it as deduction. But this declaration should be filed within 2 months before the ITR due date. Then only this deduction is available. Now, next year, the same girl came. Okay, so the marriage got cancelled. The same girl with another bridegroom, he came and got marriage done in our temple trust. At that time, she said, sir, earlier year marriage got cancelled. We were not able to give you the money, but right now I am getting married. So she paid balance arrears 4 lakh rupees also. 4 lakh rupees received in 25-26. So in 25-26, I should apply 4 lakh rupees for my charitable or religious purpose. Or in the immediately next financial year, in 26-27, I should apply 4 lakhs for my charitable or religious purpose. If I fail to apply, then whatever the amount that I did not apply, it is taxable under section 115 BBI at the rate of 30%. Let's say this is the story of previous year 24-25. In previous year 26-27, this 4 lakh rupees was received. So whatever 4 lakhs received is there, that I should apply either in 26-27 or what is immediately next financial year 27-28. So out of 4 lakh rupees, I applied 2.5 lakhs. I did not applied till 31st March 2028. That means before 27-28, I could apply only 2.5 lakhs. 1.5 lakh was not applied. As it is not applied, this is taxable under section 115 BBI at the rate of 30%. Are you able to understand? So as per explanation 1 of section 11.1, if there is any outstanding amount, if you are following accrual basis of accounting and if entire amount is included in income derived from property held under trust, whatever the amount that you could not receive in current year is there, that you can claim as deduction. But the year in which you receive that amount, in that year you should apply, or in the immediately next financial year you should apply. If you fail to apply, whatever the amount that you did not apply is there, that amount is taxable under section 115 BBI at the rate of 30%. Are you able to understand? Second option, bumper donation. Sir, what do you mean by bumper donation? On 31st March, I got 8 lakh rupees. How much I got? Bumper donation 8 lakh rupees. If I get on 31st March, how can I apply it in one day, enter 8 lakh rupees? That is not possible, na? So, if I get any bumper donation at the end of the previous year or for any other reason, whatever the amount that is there, I can file again declaration to assessing officer. Sir, like I can file declaration to income tax authority. What is the time limit? Within 2 months before ITR due date, I should file application to assessing officer, and whatever the amount is there, bumper donation, like I will file declaration, I will spend this amount in the immediately next financial year. So in 24-25, I got bumper donation of 8 lakh rupees. I could not apply in 24-25. So what I will do, I will give declaration 8 lakh rupees, I will apply in 25-26, for which AO will grant acceptance. Okay, so in 25-26, I should definitely apply 8 lakh rupees. If I fail to apply 8 lakh rupees, then whatever the amount that I could not apply in 25-26 is there, that is taxable under section 115 BBI at the rate of 30%. So what I will do, in current previous year on 31st March, I got 8 lakh rupees bumper donation. Total 8 lakh rupees I will claim as deduction. So whatever 8 lakh rupees is there, that I should apply in 25-26. But out of 8 lakh rupees, 5 lakh rupees I applied, 3 lakh rupees was not applied. Whatever the amount that was not applied is there, that amount is taxable under section 115 BBI at the rate of 30%. Next, shall I explain further? Sir, out of 48 lakhs, we have reduced our income by 12 lakhs. 48 minus 12, 36 lakhs. Now, are we required to pay tax on 36 lakhs or is there any further choice? Yes, further choice is available. If one trust gives donation to another trust, whatever the donation given to another trust is there, that is also eligible for deduction. So, like general donation by one trust to another registered trust, one trust to another registered trust. But Total donation given is not eligible, not treated as applied. Only 85% of donation given is treated as applied. Let's say Umasankar Trust gave 2 lakh rupees donation to Monish Trust. Now, how much is donation given? Donation given is 2 lakh rupees. Total 2 lakhs is not treated as applied. Out of 2 lakhs, 85% is treated as applied, 1.7 lakhs. So very important, only 85% of donation given is treated as applied. Another important point, if one trust gives corpus donation to another trust, that is not treated as applied. Only if general donation is given, then only it will be treated as applied. Whatever the general donation given, total general donation is not treated as applied. Only 85% of general donation given will be treated as. If I borrow any loan, whatever the loan amount that I have borrowed, that loan amount I will incur in current previous year. Let's say like trust is charitable, I am not getting much income. So I took 1 lakh rupees loan. 1 lakh rupees, using this 1 lakh rupees loan, I paid salaries of all employees of the trust. The year in which I took loan and I paid salaries, in this year that will not be treated as applied. Let's say in 24-25 I took loan. In 24-25 I took loan of rupees 1 lakh. Using this 1 lakh I paid salaries. Out of this 1 lakh rupees I paid salaries in 24-25. Whether it is treated as applied in 24-25, no, it is not treated as applied in 24-25. This 1 lakh rupees, like I repaid loan along with interest, loan plus interest, 1,20,000 rupees in 25-26. In 25-26, it is treated as applied. That means what? The year in which you took the loan for the purpose of salaries, in that year it will not be allowed as deduction. In that year it will not be treated as applied. But whatever the loan that you have taken, that loan you will repay na. The year in which you repay the loan along with interest, both loan repayment, interest expenditure, both are allowed as deduction in the year of repayment. Are you able to understand? So how much is the loan that I took? I took loan of rupees 1 lakh rupees. Whether in 24-25 is it allowed as deduction? No. The year in which you took the loan, that is not the criteria. The year in which you repay the loan, that is the criteria. Okay. So loan or borrowing repaid along with interest. So the year in which you repay the loan along with interest, in that year it is allowed as deduction. Are you able to understand? Accumulation under section 11.2. Sir, what do you mean by accumulation under section 11.2? There is a temple under my trust. For that temple, I wanted to build another function hall. Already one function hall is there, that is congested. I wanted to build second function hall with bigger area. See, I am getting donations. I am not denying it. With 1 year donations, can I build function hall? That is not possible. So what I will do, like I will accumulate the amount every year. After accumulating the amount, I will use this amount for the purpose of construction of another function. So like this is the thing that is used in many offices. Whatever the income is there on which tax is payable, like they will create some specific purpose. Let's say I wanted to build a function hall, that is specific purpose. For that, I will accumulate the money. So I should give declaration to assessing officer under section 11.2 before 2 months before ITR due date. In that declaration, I will tell specified purpose. What is specified purpose? Specified purpose is construction of function hall. I will tell how many years that I will accumulate. Maximum I can accumulate is 5 years. See, this is 24-25 na. ignore current previous year. Other than current previous year, in next 5 years I can accumulate the money, I can build the function hall, I can utilize all this money for the purpose of construction of this function hall, and in current previous year I can claim it as applied. Are you able to understand? So till here how much is there? Like 36 minus 1.7, 34.3 lakhs is there. So out of 34.3 lakhs, I wanted to accumulate 10 lakh rupees. Let's say to construct function hall, it will cost me 50 lakh rupees. I wanted to accumulate every year 10 lakh rupees. So what I will do every year, like I will accumulate, I will tell the specified period. I can tell period 2 years, 3 years, 4 years, like that. Maximum I can tell 5 years. Maximum period allowed is 5 years other than current previous year. Other than current previous year, maximum I can accumulate for 5 years. Next, third point, whatever the accumulation that I have done, what I am doing, I am accumulating 10 lakh rupees for the purpose of construction of function hall. This 10 lakh rupees I should deposit in safe modes. Then only deduction is allowed, otherwise deduction is not allowed. So you should deposit in safe mode. That is next point. Last point, whatever the amount 10 lakh rupees that you deposit in safe mode is there, that should not be given as donation to another trust. Okay, should not be given as donation to another trust. If all these four conditions are satisfied, then you can accumulate the money for specific purpose for specified period, and whatever the money that you have accumulated, that you can claim as deduction. Are you able to understand? So I hope you are all following. I think there is delay that's going on. So yeah, four conditions. If you want to accumulate money for specific purpose, four conditions. You should give declaration to assessing officer before 2 months before ITR due date. In that declaration, you should tell specific purpose, you should tell specific period, you should deposit that money in safe mode, and you should not use that money for any donation to any other trust. If all these four conditions are satisfied, and if you have given declaration to income tax authority before 2 months, then whatever the amount that you have accumulated, that you can claim as deduction. Now there are chances now you can violate these conditions. In current year you will claim 10 lakhs as applied, but in future year you may violate the condition, you may treat this money for other purpose, or you will after 5 years, like you said you will construct function hall in 5 years. After 5 years, out of 10 lakh rupees, only 9 lakh rupees was used, 1 lakh rupees was unutilized. So whatever the unutilized money is there after expiry, and like you said you will deposit in safe modes, but you have deposited in other modes. You said you will not give donation to any other trust, but you have given donation. All these are violations, na? So whatever the violation is there, all these are violations. So whatever the violation is there in the year of violation, these are taxable under section 115 BBI at the rate of 30%. Year of violation, taxable under section 115 BBI at the rate of. So that is the concept relating to section 11.2. Here one important point is there, maximum accumulation allowed is 5 years other than current previous year. So like I gave declaration, I specified 5 years. Now I wanted to buy land for the purpose of construction of function, but I gave advance for land also. After 1 year, that land was under litigation and court gave stay on that land. Whatever the time that I lost because of stay by court, okay, that period is to be excluded while calculating this 5 years. Are you able to understand? We discussed corpus fund, right? Initially, corpus fund. Generally, there is Trust Act as per Indian laws. As per that Trust Act, you should not use corpus fund. Only in emergency cases, you can use corpus fund. Let's say Tirumal Tirupati Devasthanam is there. COVID has come, no devotees are coming, no devotees are giving donations. So TTD has to pay salaries to all its staff, it has to pay electricity expenditure, and all expenses are there. Donations are not coming, but it needs to pay expenses. So there is no income, but expenditure is there, outflow is there. To incur that expenditure, TTD is not having money. Then what TTD will do? TTD will take some amount out of corpus fund and use this amount for the purpose of payment of expenses. So like the year in which you take amount out of corpus fund in 21-22, in previous year 21-22, 15 lakhs, let's say, like we are discussing about Umasankar Trust, 15 lakhs was taken out of Umasankar Trust corpus fund, okay, corpus fund, and this amount is used for payment of all expenses. In 24-25, what I have done, I got income 15 lakh rupees. This 15 lakh rupees, like I have used it for repaying to corpus fund. That means what? I repaid back of 15 lakh. I took 15 lakhs from corpus fund in 21-22. Now, whatever 15 lakhs that I took and paid salaries in 21-22, that amount I repaid back to corpus fund in 24-25. In 24-25, it is allowed as applied. See, here observe. In 21-22, I took 15 lakh rupees. I paid salaries in 21-22, but the year in which I paid salaries, in that year it is not treated as applied. It is treated as applied in the year in which I repaid back that amount to corpus fund. Are you able to understand? So another deduction allowed is income used for deposit back to corpus fund. Deposit back to corpus fund. 15 lakh rupees. Here there is one important point. I took money from corpus fund. I spent this amount for salaries. The year in which I took out the money, when I took out the money, I took out the money in 21-22. So previous year 21-22, ignore. Next 5 years. Next 5 years means 22-23, 23-24, 24-25, 25-26, 26-27. So on or before 26-27, I should repay back to corpus fund. Then only it is treated as applied. If I repay back in 27-28, it is not treated as applied. So whatever the amount that is taken out of corpus fund is there, that you should repay it back to corpus fund within 5 years from the end of the year in which you withdraw that money. Then only it will be treated as applied. Otherwise, it will not be treated as applied. Are you able to understand? So most of the points I have covered. After reducing this 15 lakhs, how much is balance available? Balance available is 34.3 minus 10 lakhs minus 15 lakhs. Balance 9.3 lakhs is available. This 9.3 lakhs is taxable at slab rate. Do you remember 40A3 in PGBP? Per person per day, you should not make cash payment of more than 10,000 rupees. 40A3 provisions are also applicable for charitable or religious trust. That means whenever you are incurring revenue expenditure or capital expenditure per person per day, if you make cash payment of more than 10,000 rupees, it will not be treated as applied. Are you able to understand? Next, 40A3. Next, 40A1A. When you are making payment to resident, two conditions are there. You should deduct TDS before 31st March of previous year, and deducted TDS you should deposit to government before ITR due date. If both these conditions are satisfied, then 100% of the expenditure is allowed. Otherwise, 30% of the expenditure is disallowed. Same provisions are applicable for trust as well. Are you able to understand? So, 2 points. If you make cash payment of more than 10,000 rupees per person per day, that will not be treated as applied. When you are making payment, you forgot to deduct TDS, or you deducted TDS but you did not deposit to government, that will also not to be treated as applied. Are you able to understand? So whatever 40A3, 40A 3A and 40A 1A provisions are there. 40A 3A. Earlier year you have claimed as deduction on accrual basis, but in current previous year you paid in cash more than 10,000 rupees per person per day. In current year it will be disallowed and it will be treated as income. So 40A3, 40A3A, 40A1A, all these three provisions which we have studied in PGBP, same are applicable for trust taxation also. Okay, so this is how we are going to calculate income of charitable or religious trust as per section 11.1. Section 11. I hope you understood it. So quickly I will revise. Whatever the income derived from property held under trust is there, 15% is not taxable. Standard deduction is allowed. We will set aside. Out of balance 85%, whatever the amount applied for charitable or religious purpose is there, it is allowed, whether it is revenue expenditure or capital expenditure. Next. Yeah, explanation 1 of section 11.1. If there is any outstanding amount, you will give declaration. That outstanding amount you will claim as deduction. If you get any bumper donation, that also you will give declaration and you will claim as deduction. But outstanding amount, bumper donation. Outstanding amount you should apply in the year of receipt or in the immediately next financial year. Otherwise, whatever the amount that you did not apply, taxable under 115 BBI at the rate of 30%. Next, bumper donation you should apply in immediately next financial year. If you fail to apply, whatever the amount that is not applied, taxable under 115 BBI at the rate of 30%. If one trust gives donation to another trust, total donation given, general donation given not allowed, only 85% of donation given will be treated as applied. So if you take any loan or borrowing, the year in which you use that money, in that year it is not treated as applied, but the year in which you repay the loan, then in that only it will be treated as applied. Otherwise it is loophole. You will take loan, you will claim expenditure, you will never repay the loan. Okay, so it's like understanding, for the purpose of claiming expenditure you are intentionally taking loan. That's why it was counted. The year in which you repay the loan along with interest, in that year it will be treated as applied. Next, accumulation under section 11.2. Like if you want to accumulate your money, which we normally use in our offices, you can give declaration. In that declaration, 4 points: specified purpose, specified period, maximum 5 years other than current previous year, deposit in safe modes. You should not give that money as donation to any other trust. If any of these 4 conditions are violated, in the year of violation, whatever the amount violated is there, that is taxable under 115 BBI at the rate of 30%. So what is ITR due date? 31st October. 2 months before ITR due date means on or before 31st August, you should give declaration and you can claim it as deduction. Next, if you take any money from corpus fund and use that money in the year of usage, it is not treated as applied, but in the year in which you are actually repaying it back to corpus fund, in that year it will be treated as applied. Whatever the balance income is there, that is taxable as per slab rate. And provisions of 40A3, 40A3A, 40A1A are applicable. Now, explanation 5 of section 11.1. See, if current year expenditure is more than the income, then excess expenditure you cannot set off and you cannot carry forward. What do you mean by this? Income derived from property held under trust is 200 lakhs. You applied for charitable purpose 190 lakhs. Now, how it will be? Whatever the income derived from property held under trust is there, 15% set aside na. So how much is 15%? 200 lakhs into 50%, 15%, 30 lakhs. 13 lakhs is fully exempted. It is not at all taxable. How much is remaining? 85%. Remaining 85% is 170 lakhs. Out of 170 lakhs, how much you have applied? You have applied 190 lakhs. Whether 190 lakhs is allowed? No. So here there is deficit of 20 lakhs. Na? There is deficit of 20 lakhs. Can you carry forward to next year? Answer is no. You cannot carry forward to next year. It cannot be carried forward and it cannot be set off. Are you able to understand? So excess application in current previous year, you cannot carry forward and you cannot set off with any other income. As per Finance Act 2022, general explanation added for whole section 11. For whole section. What is the general explanation? As per the general explanation, accrual based expense. Accrual based expense only treated as applied. Treated as applied. Sorry. Accrual based expenditure is not treated as applied. Cash based expense only treated as applied. What do you mean by this? See, at the end of previous year, my salaries are 6 lakh rupees. Out of 6 lakh rupees, I paid 4 lakhs, unpaid 2 lakhs. For example, this salary was not considered. I am following accrual basis of accounting. Can I claim 6 lakhs as deduction? Not allowed. Only 4 lakhs will be allowed as. That means what? In case of trust, whatever the expenditure that is incurred by trust, that expenditure is allowed only if it is paid in current previous year. Otherwise, it is not allowed as deduction. Now you will get one doubt. Sir, you said outstanding amount and you also said accumulation as per section 11.2. You said bumper donation. See, if you file declaration, then you can claim it as deduction. For example, salaries is there. 4 lakhs I paid in current previous year. Remaining 2 lakhs I did not pay in current previous year. I gave declaration to assessing officer within 2 months before ITR due date. Then I can claim 2 lakhs as deduction. If I do not give declaration, to assessing officer, whatever the accrual based expenditure is there, as able to understand. So for whole section 11, whatever the expenses are there, those expenses are treated as applied only if they are actually paid in current previous year. Otherwise, they are not allowed as deduction on accrual basis. They will not be treated as applied on accrual basis unless you give declaration to as able to understand. Sir, till now you are saying safe mode under section 11.5. What do you mean by, like, what are all the various modes that are covered under section 11.5? That we will discuss. So, safe modes under section 11.5. See, government certificates. Trust can invest its money in government certificates. It is allowed investment. Okay. So government certificates means nothing but national saving certificates or any other certificates issued by government. If trust invests its money in national saving certificates, that will be treated as applied only. It is safe mode. Next, post office savings bank account. Next, if you deposit your money in scheduled bank, deposit in scheduled bank, that is also allowed. For accumulation under section 11.2, we discussed it now. Whatever the amount that is accumulated, that should be deposited in safe modes. What are those safe modes? Government securities, post office savings bank account, deposit in scheduled bank, deposit in cooperative society bank. Next, investments in units of UTI. You know UTI, right? Unit Trust of India. So trust can purchase units of UTI. That is safe mode of investment only. That is allowed. Next, investment in central government or state government securities. That is also permitted. Trust can invest its money in central government or state government securities. That is also treated as a safe mode of investment. It is also allowed. Next. Next point, a bit tricky, but listen, you will understand. debentures of company or corporation which are guaranteed by central government or state government. Let's say there is Reliance Limited, it issued debentures. Whatever debentures issued by Reliance Limited are there, repayment of those debentures along with interest, that is guaranteed by central government. You can invest those deposits. Trust can invest in those debentures that will be treated as safe mode of investment in public sector company bonds. Public sector company bonds. Next, deposits in public financial institutions, investment in public sector company shares, investment in public sector company, investment in immovable property. The renowned educational institution, you all know, okay, they are taking benefit like this only. Whatever the fees collected from students is there, it will be treated as income derived from property held under trust. They will take benefit of section 11 to accumulation. They will invest that money in immovable properties. That's how they are purchasing so many immovable properties in their locality. Okay, that's the loophole. So investment in immovable property is safe mode of investment as per section 11.2, investment in movable property. I hope you understood the way how they are getting so much of income, how they are building so much of assets through this point. If you understand, leave some comment. Okay, now investment in housing financial corporations and investment in HUDCO, Housing Development Corporation, investment in NABARD bonds. All these are safe modes of investment. So if trust invest in all these safe modes of investments, then it is all right. It will be treated as applied. Otherwise, whatever the amount that is misutilized or misinvested is there, that will be treated as income and it is taxable under section 115 BBI. For example, like 10 lakh rupees, na, the example which we took for purpose of construction of function hall, how much I accumulated? I accumulated 10 lakh rupees. Out of 10 lakh rupees, with 9 lakhs, I purchased land. Land is safe mode of investment, na? It will be treated as applied. With 1 lakh rupees, I purchased cryptocurrency. Whether cryptocurrency is safe mode of investment? No. 1 lakh will not be treated as applied. Are you able to understand? So this is the concept relating to safe mode of investment under section. Next, we will discuss section 13.1. Certain cases, whatever the exemption under section 11 are there, exemption under section 11, 12. Exemption under section 11 and 12 is not available in 4 cases. What are those 4 cases? First case, if you create any trust for private religious purposes, then in such case, you cannot claim exemption under section 11, 12. For example, I created one trust, Maganti trust. In that trust, like I build one Shiva temple. For that Shiva temple, I can enter, only my family members can enter, my friends can enter. So if I create any such type of trust only for private religious purpose, the trust is not eligible for section 11 and 12 exemption. If you establish any trust for particular religion or caste or community, even that trust is also not eligible for exemption under section 1112. Let's say I built one temple, okay, I told for the temple only Hindus are allowed, others are not allowed, okay, that's why you will never see in any temple only Hindus are allowed. If such type of placard or notice is given, that trust is not eligible for 11 and 12 exemption. In TTD, can you see anywhere only Hindus are allowed? No, they will not give that disclosure. If such disclosure is given, it will lose status of section 11 and 12 exemption. So if you create any trust for particular religion, particular caste, particular community, the trust is not eligible for section 11 and 12 exemption. But if you create any trust for orphans or widows or for particular backward people, then the trust is eligible for 11 and 12 exemption. Now, Varun is asking, sir, only for widows, those who are suffering with marriage, or those who are suffering with wives, for them also if we create any trust, is it also eligible for 11 and 12 exemption? Yes, that is also eligible for 11 and 12 exemption. So those who are suffering with breakup, those who are suffering with all the nuisance in the house with marriage, for those husbands also, if you create any trust, the trust is also eligible for section 11 and 12 exemption. Okay, so you need not worry if you have any such kind of people. Create one trust and you can claim 11 and 12 exemption. Third point, if any amount of trust is used for benefit of specified person, okay, so benefit of income or assets given to a specified person, then not total amount, whatever the benefit that is given to specified person is there, that amount will be treated as income, and such income is taxable, and such income is taxable under section 115 BBI at the rate of 30%. What do you mean by this? Let's say I established one education institution. In that education institution, my sister is studying. How I charge fees for outsider, in the same way I should charge fees for my sister as well. If I do not charge fees for my sister, whatever the benefit that my sister has received, that benefit will be treated as income of the trust. On such income, trust is required to pay tax under section 115 BBI at the rate of 30%. Are you able to understand? So whatever the benefit that trust gives to its specified person, on that benefit will be treated as income of trust. On that income, trust is required to pay tax under section 115 BBI at the rate of 30%. Are you able to understand? Sir, who are called as specified persons? Whoever the founder or author of trust is there, or whoever the manager or trustee of the trust is there, they will be treated as specified person. Similarly, if any person gives donation of more than 50,000 rupees, why will he give more than 50,000 donation? He might have some specified interest. So those who have given donation more than 50,000 rupees, for that person also, if trust gives any favor, if trust provides any benefit, that benefit will be treated as income of the trust. So those who have given donation more than 50,000, they will also be treated as specified persons, and their relatives, whoever founder, author, manager, trustee is there, their relatives will also be treated as specified person. Similarly, if trustee is Hindu undivided family, if you know Simhachalam temple trustee is one Hindu undivided family. Okay, so if trustee of the trustees Hindu undivided family, whoever the members in the trustees are there, all the members will be treated as specified persons. Okay, so members of HUF, if HUF is trustee. Are you able to understand? So all these will be treated as specified persons. For specified persons, if any benefit is provided, such benefit is taxable under section 115 BBI at the rate of 30%. Another important point, whatever the amount that is taxable under section 115 BBI is there, from such income, you cannot claim any expenditure, you cannot claim any deduction, you cannot set off any losses. Whatever the income taxable under 115 BBI is there, that is taxable at flat rate of 30%. When I say flat, no deduction, no expenditure is allowed, straight away 30% tax is payable on that. income. Are you able to understand? Next, fourth case. If funds of trust are deposited in any mode other than section 11.5, other than 11.5. In that case also, whatever the amount that is deposited in modes other than 11.5, cryptocurrency, whatever the amount that is misutilized, that is not invested in safe mode, to the extent of that amount, it is taxable under 115 BBI at the rate of 30%. Able to understand? Why trust can be formed? Can someone tell? Trust can be formed for charitable purpose, or it can be formed for relief of poor, or it can be formed for yoga, or it can be formed for education, or it can be formed for providing health facilities, or it can be formed for preservation of environment or monuments. For all these purposes, like trust is formed for purpose of education. I created Umasankar educational institutions and I created one trust. In the trust, I am running a school. Through school, I am getting income. Na? So in all these cases, if you do business, and in business, if business receipts are more than 20% of total receipts, then also still section 11 and 12 exemption is available. Still section 11 and 12 exemption is available. But if I create any trust for advancement of any other object, yes, Monish said sports. Even for promotion of sports also, you can create one trust, education, sports, games, you can create one trust, and the trust, in the trust, whatever the business income is there, even if business income is more than 20% of total receipts, still you can claim section 11 and 12 exemption. But if you create any trust for advancement of any other object of general public utility, in this case, if you create a trust for this purpose, and for that trust, if business receipts are less than or equal to 20% of total receipts, then 11 and 12 exemption is allowed. But if business receipts are more than 20% of total receipts, in that case, 11 and 12 exemption is not allowed. See, registration will not be cancelled. I created one trust for the purpose of helping poor. Okay, so helping poor trust. So that is, no object was there. That is for upliftment of general public or to help the poor. Now, using that, what I am doing, I am purchasing bottles at 10 rupees. Intentionally, I am selling it at 40 rupees. I gave notice. Whatever the amount that I receive by selling these bottles, I will distribute this money to poor. Now, what am I doing? I am doing business. So, in my business, if my business receipts are more than 20% of total receipts, my trust registration under 12AB, it will not be cancelled. But in current previous year, section 11 and 12 exemption is not available. Are you able to understand? Further, trustee is required to maintain books of accounts and trustee is required to get its books of accounts audited if total income of trustee is more than basic exemption. So there are certain cases if books of accounts are not maintained, or if books of accounts are not audited, Trust is required to file ITR before on or before 31st October. If trust do not file ITR within due date, do not file ITR within due date, or if business receipts are more than 20% of total receipts in case of advancement of any other object of general public utility. Okay, this particular case, advancement of any other object of general public utility and business receipts are more than 20% of total receipts. So in all these three cases, if books of accounts are not maintained, if they are not audited, or if ITR is not filed within the due date, or in case of trust is formed for advancement of any other object of general public utility, and if business receipts are more than 20% of total receipt, in all these cases, only revenue expenditure is treated as applied. Capital expenditure is not treated as applied. See what I said, income derived from property held under trust, 15% standard deduction, balance 85%. Out of balance 85%, whatever you apply for charitable or religious purpose, application means both revenue expenditure and capital expenditure. Both expenses are treated as applied. But in these four cases, capital expenditure is not treated as applied. Only revenue expenditure will be treated as applied. Are you able to understand? Because violated na, books of accounts are not maintaining, they are not getting audit done, they are not filing ITR within due date, business receipts are more than 20% of receipts, conditions given are violated. So only revenue expenditure will be allowed as deduction. Even this revenue expenditure should not be from corpus fund. This revenue expenditure should not be from corpus. So if revenue expenditure is from corpus fund, again it will not be allowed as deduction. And this revenue expenditure should not be from any loan or borrowing, because if revenue expenditure is from any loan or borrowing, it will not be allowed in current year. It will be allowed in the year in which you repay the loan. So it should not be from loan or borrowing. And it should not be depreciation for which 100% deduction is allowed in earlier years, for which 100% deduction allowed in earlier years. So this is the thing. In all these four cases, as you have violated the condition, revenue expenditure will not be allowed as capital expenditure will not be allowed as deduction. Only revenue expenditure will be treated as applied. Even in that revenue expenditure also, if you incur any revenue expenditure out of corpus fund, that will not be treated as applied. If you incur any revenue expenditure out of loan or borrowing, that is not treated as applied. Earlier year you have claimed 100% capital expenditure. For that asset you want to claim depreciation now. That is also not out. Are you able to understand? Capital gains. This will be interesting. Listen. Section 11(1)(a). See, trust will have assets na. Whenever trust sell assets, on sale of capital assets, trust is also required to calculate capital gains. Whatever the capital gain is there, that capital gain will be considered as income derived from property held under trust. Do you remember? Initially, I told even capital gain is also considered as income derived from property under trust. Got. Okay, so trust is having one land. It sold that land for 14 crores. Let's say transfer expenses are 1 crore. How much is net consideration? Net consideration is 13 crores. Cost of acquisition. Cost of acquisition is 8 crores. Now how much is capital gain? Capital gain is 5 crores. Sir, can we claim any exemption from capital gain? Yes, you can claim exemption from capital gain, but you need to do reinvestment. Okay, the formula is if total net consideration is reinvested, total net consideration is reinvested, then total capital gain is exempted. Total capital gain is if part of net consideration is reinvested, part of net consideration is Then exemption is equal to cost of new asset minus cost of old asset. Cost of new asset. Did you understand? Now, let's say total 14 lakhs reinvested. Reinvestment exemption. If total net consideration is reinvested 13 crores, total 5 crores capital gain is exempted. Are you able to understand? But total 13 crores, what net consideration? Total 13 crores was not reinvested, only 11 crores was reinvested. Then how much is exemption? Cost of new asset minus cost of old asset. New asset 11 crores, old asset is 8 crores. Only 3 crores is exemption. Are you able to understand? For example, let's say 9 crores is reinvested, then 9 crores minus 8 crores. 1 crore is allowed as exemption. Are you able to understand? So, if only 6 crores is reinvested, 6 crores minus 8 crores, it is negative 2 crores. In this case, exemption allowed is 0. Are you able to understand? So, whenever trust sells any capital asset, then what you need to consider is net consideration. Net consideration should be reinvested. If total net consideration is reinvested, total capital gain is fully exempt. If proportionate net consideration is reinvested, then exemption is equal to cost of new asset minus cost of old asset. I hope you are following me. Next we will discuss something interesting, anonymous donation. Okay, I framed one problem on this as well. So we can discuss that problem also after we discuss. Anonymous donation under section 115 BBC. Anonymous donation means what? Someone whom we do not know. Okay, unknown person deposited money, unknown person gave donation. It's also called as Gupta Dan. So if any anonymous donation is received, anonymous donation is taxable. So if anonymous donation is received by religious trust, anonymous donation received by religious trust, then whatever the anonymous donation received by religious trust is there, that anonymous donation we will treat as income derived from property held under trust. However, if any anonymous donation is received by charitable trust, then 115 BBC gets attracted. So in this case, 115 BBC will not get attracted. It will be treated as income derived from property held under trust. But if anonymous donation is received by charitable trust, then it is taxable under section 115 BBC. Let's say anonymous donation received is 10 lakh rupees. Anonymous donation received 10 lakh rupees. From this 10 lakh rupees, deduction is allowed. See, total 10 lakh rupees is not taxable under section 115 BBC. Deduction is allowed. How much is deduction? 5% of total donation. 5% of total donation or 1 lakh, whichever is higher. That will be allowed as deduction. And whatever the balance is there, that balance amount is taxable under section 115 BBC on a flat rate. Okay, no deduction will be allowed on a flat rate at the rate of 30%. Are you able to understand? And whatever the donation that is allowed, that is not exempt, that will be treated as income derived from property held under trust. Okay, so that should not be exempt. That will be treated as income derived from property held under. Here, sir, what do you mean by total donation? Total donation includes anonymous donation plus corpus donation plus any general donation or voluntary donation. If any government grant was received, that is also to be considered in calculation of total donation. Because see, why this concept was introduced, many people are converting black money to white money using trust concept. So they are saying unknown person gave this much of amount and they are bringing that money to the trust. So to counter this, if any unknown person gives money to the charitable trust, it will be treated as anonymous donation. But at least some people will be there now who will give, some unknown persons who will give out of genuine reasons. So further deduction will be allowed 5% of total donation or 1 lakh rupees, whichever is higher. Balance is taxable as anonymous donations under section 115 BBC at the rate of 30%. Whatever the deduction that is allowed, that is not exempt, it will be treated as income derived from property held under. Now, sir, there is Uma Trust, like it is having temple, it is also having hospital. That means what? The trust is having both charitable entity, like that is charitable trust as well as religious trust. Charitable as well as religious. So if it is charitable as well as religious trust, then for charitable purpose, if it receive any anonymous donation, then 115 BBC is applicable. For other purpose, if any anonymous donation is received, then 115 BBC is not applicable. Very simple. If any trust is formed for both charitable and religious purposes, ETD, educational institution is there, religious purpose is there. So if any trust is created for both educational as well as both charitable as well as for religious purpose, for education, for health, if any anonymous donation is received, 115 BBC is applicable. For orphans and for any other purpose, if any anonymous donation is received, that is not taxable under 115 BB. Okay. Now, shall we solve one problem for better understanding? Shall we solve? There is one trust with the name Gali Trust. There is one guy who constantly commenting. How do you expect that I can reply while I am teaching the class? Gali Trust. Now, there is Gali Trust. Income derived from property held under trust is 20 lakh rupees. Next, donations received. See, even donations received is also considered as income derived from property held under trust, right? Donation received is 50 lakh. Out of 50 lakh, anonymous donation is 12 lakh. And corpus donation is 20 lakh. Next, business income incidental to main objects. If it is incidental to main objects, then it will be treated as income derived from property held under trust, right? So business income incidental to main objects is 13 lakhs, sorry, 3 lakhs. Next, amount applied for charitable or religious purpose is 30 lakh rupees. Compute total income of Gali Trust under section 115 BAC. That means if trust is paying taxes under section 115 BAC, we need to calculate the tax liability. Shall we calculate? Everybody. Now, first, we will write income derived from property held under trust. Computation of total income of Charlie Trust. First, how much is income derived from property held under trust? 20 lakhs. How much are donations received? 50 lakhs. Corpus donation is not taxable, na? Corpus donation is exempt, right? If it is deposited in safe modes. So, total donation is not taxable. Only other than corpus, other than anonymous. See, out of anonymous donation also, total is not treated as income derived from property held under trust. 5% of total donations or 1 lakh, whichever is higher. So, we will do one thing. How much is anonymous donation? Anonymous donation is 12 lakhs, right? From this 12 lakhs, deduction is allowed. How much is deduction? Deduction is 5% of total donations. So how much is total donation? 50 lakhs. 50 lakhs into 5%, 2.5 lakhs or 1 lakh, whichever is higher. That means 2.5 lakhs is allowed as deduction. How much is balance? 12 minus 2.5, 9.5 lakhs is balance. This 9.5 lakhs is taxable under 115 BBC at the rate of 30%. And whatever this 2.5 lakh is there, that will be treated as income derived from property held under. So how much is total donation received? Donation 50 lakhs. But from the donation, you need to reduce corpus donation because corpus donation is not taxable. How much is corpus donation? 20 lakhs. Next, how much is anonymous donation? Anonymous donation is 12 lakhs. How much is balance? 50 minus 32, 18 lakhs. Correct? To this, we are going to add income derived from property held under trust. So, anonymous donation total will not be treated as income derived from property held under trust. Only 2.5 lakhs it will be treated as income derived from property held under. Now, out of this, total how much? 20 plus 18 plus 2.5, 40.5 lakhs. Out of 40.5 lakhs, standard deduction is allowed na. How much is standard deduction? Standard deduction at the rate of 15%. So 40.5 into 15%, 6.075 lakhs. Let how much balance? 34.425 lakhs. I am making one small change. Please change this amount applied for charitable or religious purposes 21 lakhs. How much? 21 lakhs. So from this we will reduce amount applied for charitable or religious purpose. How much? 21 lakhs. How much is balance? Balance is 13.425 lakhs. So if we convert 13 lakh 42,500. So this is total income of the trust. Now shall we calculate tax liability? Total income is 13 lakh 42,500. Out of this, no, 13 lakh 42,500. To this we need to add amount taxable under 115 BBC. How much is taxable? 9 lakh 50,000. So how much is total income? 13 lakh 42,500 minus 9,50,000. 22,92,500. I hope you are following till here. So total income is 22,92,500 divided into two parts. Anonymous donation 9,50,000, other 13,42,500. This is taxable at the rate of 30%. 9,50,000 into 30%. How much? 2,85,000. Next, 13,42,000. He is following 115 BAC na. If he follows 115 BAC, then tax rates up to 3 lakh there is no tax. Greater than 3 lakh up to 7 lakh tax rate is 5%. Tax amount is 20,000. Greater than 7 lakh up to 10 lakh tax rate is 10%. Tax amount is 30,000. Greater than 10 lakh up to 12 lakh tax rate is 15%. Tax amount is 30,000. About 12 lakh tax rate up to 15 lakh tax rate is 20%. So 1,40,500 into 20%, 28,500. So how much is tax? 28,500 plus 80,000. 1,08,000. So how much is total tax? 2,85,000 plus 1,08,500. Total 3,93,500. To this you will add HEC at the rate of 4%. 15,740. How much is final tax liability? 393. 4,09,240. I hope you understood. So, do you also got the same answer? Today I am live from Vijayawada. Previously I used to come live from Hyderabad. Later on that incident happened to Ongole, then came to Vijayawada. So from here onwards I am taking class for you. So you also got the same answer? Please reply. Hello. Am I audible? Next, we will see registration process of the. Before we start with registration process of trust, I wanted to explain 1023C. See, as per 1023C, clause 3A, clause 3AB or clause 3AC. Whatever the income of government hospital, government school or hospital is there, that is fully exempt. Sir, when we call an institution or hospital as government institution or government hospital, when any hospital or institution is substantially financed by government, then we call such hospital or educational institution as government institution or government hospital. So if like substantially financed means what? Whatever the government grant that they receive, government grant is more than 50% of total receipts. Such type of educational institution or hospital we call as government hospital or government educational institution. Income of government hospital, government educational institution is fully exempt. It is not at all. 1023C, 3AD, 3AE. Private educational institution or private hospital whose aggregate annual turnover is less than or equal to 5 crores. then also their total income is not taxable, their total income is fully exempt. Let's say I started one small school for the purpose of education. Okay, I am a private one. Like my trust is not a government trust, it is a private trust formed for educational purposes. But whatever the fees that I collect from students is there, it is less than 5 crores. So if you create any trust whose aggregate annual turnover is less than or equal to 5 crores, if it is either educational institution or any hospital, then whatever total income received by the trust or educational institution, it is not at all taxable, it is fully able to understand. 1023C 4 or 5 or 6 or 6A. See, these people are there na. They are not required to obtain any registration, any approval from CIT or PCIT. Any educational institution which is formed solely for charitable purpose, any hospital which is formed solely for charitable purpose, whose aggregate annual turnover is less than 5 crores, they are not required to obtain any approval from CIT or PCIT. Their total income is fully exempt. However, in case of any private trust, educational institution or hospital whose aggregate annual turnover is more than 5 crore rupees, then they are required to get approval of CIT or PCIT. Approval of CIT or PCIT is required, then only exemption is allowed, otherwise exemption is not allowed. Then only exemption is available, exemption under section 1112, otherwise exemption under section 1112 is not. Okay. See, trustees registered under section 12AA or 12AB or trustees registered under section 1023C clause 4 or clause 5 or clause 6 or clause 6A. See, in either case, 11 and 12 exemption is available. If they get registered under 12A or 12AB, 11, 12 exemption is available. Or if they get registered under section 1023C4, 5, 6 or 6A, then also section 11, 12 exemption is available. So, Nirmalamma thought, our finance ministry is Miss Nirmala Sitharaman, right? She thought, see, in either case, exemption is available under section 11, 12. Then why registration under two different sections, 12A, 12AB, 1023C, 4, 5, 6, 7? Why? Then, so with effect from 1st October 2024, if you want to obtain new registration, you can apply new registration only under section 12AB. You cannot obtain registration under section 1023C, 4 or 5 or 6 or 6. This is not allowed from 1st October 2020. So earlier two options are there. If you want to claim exemption under section 1112, either you can get registered under 12A or 12AB, or you can get registered under section 1023C. But nowadays, this is the recent amendment made in Finance Act number 2 of 2024 with effect from 1st October 2024. If you want to apply for new trust registration, you have only one option. You can apply under section 12AB. You cannot obtain registration under 1023C clause 4, 5, 6 or okay. Now this registration I will explain in ICA material. Now see, 1st April 2021, remember this date. Before 1st April 2021, you have to get registration under 12A or 12AA. After 1st April 21, they introduced one new section, 12AB. Okay. See, before 1st April 21, if you take trust registration, lifelong the trust registration is there. TTD got registered, for example, in 1976. That's it. Again, they need not go to Commissioner of Income Tax. So whenever Income Tax Department is doing audit, when it asks for certificate of registration, they were not able to give. They are saying it got registered in 1976. Certain documents were not found. Irregularities are there. So Nirmala Sitharaman, after she became finance minister, she introduced one amendment with effect from Finance Act 2021. She said that every trust is required to get its registration renewal for every 5 years. That means what? Like today, if I take any registration under section 12AB, it is not for lifetime. It is only for 5 years. After 5 years, again I have to get my registration renewed. Okay, only if I get my registration renewed, then only 11 and 12 exemption benefit is available. Otherwise, section 11 and 12 exemption benefit is not available. Are you able to understand? Now, those trusts which are already existing as on 1st April 2021, they need to migrate from 12AA to 12AB. So for migration, they were given 3 months. So within 3 months, 3 months means what? 1st April 21, 3 months means 30 June 2021. So within 3 months, they should keep application for migration from 12AA to 12AB. However, 30 June 2021 was extended. Okay. You can see 30 June 2021, it is extended up to 30 June 2024. It got extended by circular 30 June 2024. So those who wants to migrate, those who are already registered as on 1st April 2021 are there, within 3 months, they need to keep application to commissioner or principal commissioner for migration to 12AB. Then commissioner will pass the order for registration under section 12AB within 3 months from end of the month in which application was received. So the month in which application is received by commissioner, he will ignore that month. Within next 3 months, he will pass the order for registration under section 12AB. Sir, when he is giving registration for migration from 12AA to 12AB, will he check any documents? Will he do any inquiry? He will not do any inquiry. Without any inquiry, he will give the registration, and that registration is valid for 5 years. Are you able to understand? The year in which a trust is created, from that year they can claim exemption for additional 5 years also. Are you able to understand? Last point, if you want to create a new trust, let's say today I got thought I wanted to start one trust for those who are unmarried. Okay, for unmarried people I wanted to create one trust under advancement of any other object of general public utility. So like for new trust, first I need to apply for provisional registration. They will grant provisional registration. Once I get provisional registration, then I should apply for final registration. So when should I make application? At least 1 month prior to commencement of the previous year relevant to assessment year. What is today's date? 24th July 2025. So today I got an idea. I wanted to start a trust for unmarried people. You know, right? If I start new trust today, then previous year will commence from 24th July to 31st March. Generally, previous year 1st April to 31st March. But if I want to start in case of new business, new source of income, new profession, previous year will start from date of commencement of business or profession or source of income. I'm starting trust today, so date of commencement is today. So this is previous year beginning. So I need to be upfront within before 30 days, before 30 days only, or before 1 month, I think. At least 1 month prior to the commencement of previous year. So 24 July, 1 month means 24th June 25. Before 24 June 2025 only, I should make application for provisional registration of the trust. The month in which application is received, ignore that month. Within next 1 month, commissioner will give provisional registration to. Are you able to understand? So within 1 month from end of month in which application is made, or application is made, order to be passed for provisional registration without detailed inquiry. So commissioner, principal commissioner, they will not do any inquiry. So I am applying for provisional registration. So I made application. The month in which I made application, ignore that month. Within next 1 month, I am going to get the provisional registration, and that provisional registration is valid for 3 years. Next, second point. Once I get a provisional registration, then I have to apply for final registration. Sir, when I should apply for final registration? So within 6 months from commencement of activities. See, I am starting trust now, I will do some activity. The date on which I started the activity, from the date within next 6 months or within or before 6 months from expiry of provisional registration, whichever is earlier. So the date on which I start the activity, from the date within next 6 months or the date on which provisional registration expires before 6 months from that date. Okay, I need to apply for final registration. When I apply for final registration, commissioner or principal commissioner, he will ask all the documents, he will go through the entire documentation, he will completely do inquiry upon my trust. After doing complete inquiry, if he is satisfied, he will grant final registration. If he do not satisfy, then he will give opportunity of being heard and he will reject the application for final registration. If he gives approval for final registration, it is valid for 5 years. Like those 5 years are to be counted from the year in which that trust application, provisional application for trust was made. From that year onwards, 5 years is 5 years that final registration will be granted. Trust is already registered under section 12AB. I said now for every years they need to get renewal. So trust already registered under section 12AB. And it want and 5 years time limit is over. 5 years time limit is getting over. Then it needs to apply for renewal na. So for renewal application, when it should apply for renewal application should be made 6 months before date of expiry of registration. So whatever date of expiry is there, for the date of expiry, you need to calculate 6 months. Before that 6 months only, you should apply for renewal of registration. Then if you apply for renewal also, like commissioner will go through entire documentation. If he is satisfied, he will renew your registration. Otherwise, he will reject your renewal registration after giving opportunity of being heard. Now renewal registration is again valid for another 5 years. Okay. If your trust is inoperative and you wanted to make it operative, let's say in 24-25 trust is inoperative. In 25-26 I wanted to make trust operative. So in 24-25 only, like I wanted to make it operative from 1st April 25. So from 1st April 25, I need to do back calculation 6 months. 6 months means 30th September 24. Am I correct? So before 30th September 24 only, I should apply for operation of inoperative trust. Are you able to understand? Then again, income tax officer will go through entire documentation. If he is satisfied, he will grant final registration. Otherwise, he will reject the registration after giving opportunity of being heard. It is also available for 5 years. All clause 2, clause 3, clause 4. All three are available for 5 years. Next, there is modification of objects of trust. If there is modification of objects of trust, then also the trust is required to make application for change of objects. Within 30 days from date of change of objects, it should make application. He will go through, officer will go through the entire documentation. If he is satisfied, he will grant registration. Otherwise, he will cancel the modification of object. Okay, if he grants registration, again it is valid for 5 years. So this is the concept relating to registration of. Now last concept, important concept, a question you will get in examination, that is tax on accreted income. This is also called as exit tax. Now, what do you mean by exit tax? This exit tax, this is applicable in three cases. What are those three cases? I will tell you. In these three cases, whatever the accreted income is there, that accreted income is taxable at MMR, maximum marginal rate. Sir, what do you mean by MMR? 30% tax plus 12% surcharge plus 4% HEC. So, what is effective tax rate? 34.944%. That is effective tax rate. Now I will explain these three cases. In these three cases, whatever the accreted income is there, on accreted income, tax rate applicable is 34.944%. Let's say trust is closed. There is dissolution of trust. Till 30 years, I am claiming exemption under section 1112. I accumulated so much of assets. So what I will do at the time of closure of trust, whatever the income that I accumulated, whatever the income that is accreted is there, on such income I am required to pay tax at the rate of 34.944%. Are you able to understand? That is maximum marginal rate. Now, shall I discuss those three cases? Actually, four cases, but in Act they were given as three cases. Now let us see one by one. Trust got converted into non-eligible form. Trust got converted into non-eligible form. What do you mean by this? Let's say non-eligible form means trust registration was cancelled. You know, like if income tax officer finds something suspicious, then commissioner has right to cancel the registration. If trust registration is cancelled, in that case, whatever the accreted income is there, on such accreted income, you are required to pay tax at the rate of 34.944%. Next, trust made modification of objects. Just now we have discussed, if trust made modification of objects and not applied for fresh registration, or applied for fresh registration but it got cancelled, applied for fresh registration but got. So in these cases, whatever the accreted income is there, on such accreted income, tax is applicable at the rate of MMR, maximum marginal. So first trust registration is cancelled by commissioner, or trust made modifications and it did not apply for fresh application, or it applied for fresh application which is cancelled by commissioner. In these cases, whatever the accreted income of trust is there, on such accreted income, trust is required to pay tax at the rate of not migrated from 12AA to 12AB. You know, right? After 1st April 21, every trust is required to migrate from 12AA to 12AB, but they did not migrate from 12AA to 12AB, or not renewed registration under section 12AB after 5 years. See, for every 5 years, it needs to renew its registration, right? But trust failed to renew its registration after 5 years under section 12AB. Then also, like whatever the accreted income is there, on that it is required to pay tax at the rate of MMR. Next, after provisional registration, not applied for final registration. In this case also, like accreted income, on such accreted income, it is required to pay tax at the rate of M. Case 2. Trust merged with another trust. It got merged with another trust. Another trust is not registered under section 12AA or 12AB or 1023C, 4 or 5 or 6 or another trust is registered but not having same object. That means what? If one trust gets registered with another trust, if one trust gets merged with another trust which is unregistered, then also accreted income concept is applicable. Registered trust getting merged with another registered trust. Registered, like I am in educational field, education trust got merged with hospital trust. Even though both are registered, still accreted income concept is applicable because both objects are not same. If there is dissolution of trust, what you need to consider? You need to consider date of dissolution. From date of dissolution, from end of such month, within next 12 months, it need to transfer all assets to another registered trust having same objects. Another registered trust having same object. Then whatever the assets transferred to another registered trust having same objects, on that tax is not levied. Whatever the not transferred are there, on those not transferred assets to another trust having same objects, on this MMR is applicable. Tax is required to pay at the rate of M. Now, what do you mean by accreted income? Here I said accreted income. Sir, what do you mean by accreted income? Accreted income means fair market value of all assets less total liabilities. Whatever the balance is there, that balance we call as accreted income. Here, another important point is there. When you are calculating fair market value of all assets, you need to exclude three assets. Three assets are excluded. First, asset purchased out of agricultural income. That means if any asset is purchased out of agricultural income, on that asset will not be considered in calculation of accreted income. On that asset, MMR, maximum marginal rate tax, is not applicable. Next, second, asset purchased before 12AA or 12AB registration. So if you purchase any asset before obtaining registration under section 12AA or 12AB, see, only if you obtain registration under 12AA or 12AB, then only you will get 11 and 12 exemption. Before that date, there is no concept of 11 and 12 exemption, right? So if you purchase any asset before obtaining registration under 12AA or 12AB, that asset is purchased out of tax paid money. Already you paid tax in earlier years. Now again, why will they levy maximum marginal rate? That's why if you purchase any asset before obtaining registration under section 12A or 12AB, that asset is to be excluded while you are calculating accreted income. Third, assets transferred to another registered trust having same objects within 12 months from dissolution date. So whatever the assets that are transferred within 12 months, we have discussed this point, right? If you transfer within 12 months to another trust having same objects, then whatever the assets that you have transferred, on that no tax is required to be paid. Whatever the untransferred assets within 12 months are there, okay, on those accreted income, you are required to calculate tax at the rate of MM. See, whatever the tax at the rate of maximum marginal rate is there, that is required to be paid within 14 days. Are you able to understand? That 14 days is required to be calculated from date of is from expiry of 12 months. You need to pay within next 14 days. Or if there is modification of objects from date of cancellation of modification of objects within next 14 days, you need to pay maximum marginal rate tax on accreted income. Otherwise, interest will be levied. Now valuation, here it was there, you can see the valuation also. I will explain in simple terms. Valuation, how to calculate fair market value of assets valuation. If it is immovable property, it is calculated at stamp duty value or fair market value, whichever is lower as on valuation. If there are quoted securities, then you need to consider lower price plus highest price divided by 2. Nothing but you will consider average price on the date of valuation. If there are unquoted securities, then you will consider A plus B minus L divided by PE into PV. Don't worry, I will explain you. Let's say trust is there. Trust is having 10,000 shares in Reliance Industries Limited. Now, let's say Reliance Industries Limited balance sheet is there. In this balance sheet, let's say equity share capital 60,000 shares, 6 lakhs, current liabilities 10 lakhs, fixed assets 80 lakhs, current assets 5 lakhs. Now, what you will do? You will consider fair market value. Let's say fair market value is 90 lakhs. 90 lakhs plus 5 lakhs, current liabilities minus 10 lakhs divided by total number of shares 60,000. How many shares trust is having? 10,000. So 10,000 shares means nothing but PV. 60,000 shares means nothing but PE. And this 90 lakhs plus 5 lakhs we call as B, and 10 lakhs is liability. See, if there are gold, jewelry, immovable property, for all of them you will consider fair market value. For any asset which you will not consider fair market value, you will consider book value. That's how we are going to arrive A plus B minus L divided by PE into PV. So we are going to calculate value of unquoted shares. So if there is any other asset, you will consider fair market value. Fair market value on valuation. Shall we do one problem in icai module so that you will get better understanding? Let's do 7th problem in institute material. Helpage is a charitable trust set up on 1st April 2010 with the object of providing relief to the poor. Later on, in April 2012, it changed its objects to medical relief. So when it was formed, 1st April 2010, correct? So at that time, objective is relief of poor. When it changed its objects, it changed its objects on 1st September 2012. So the objects was changed. What is the objective? The objective is to provide medical relief. Again, it applied for registration on 1st April 2013 for 12AA. That means during this period, there is no registration under section 12AA, right? As there is no registration under section 12AA, no exemption can be claimed under section 1112. No exemption under section 1112. That means what? It has paid taxes during 1st April 2010 to 31st March 2013. From 1st April 2013, it took 12AA registration. So it is eligible for exemption under section 11 and 12. Exemption under section 11 and 12 is on 1st April 2024, HelpAge got merged with PoorAid. He is not eligible for registration under 12AB or approval under section 1023. So what happened on 1st April 24? HelpAge merged with PoorAid. See, PoorAid is also another trust, but is it registered trust? No, it is unregistered. So when one trust gets merged with another trust, okay, another trust which is not registered, in such a case, like it is required to pay exit tax. I told now in 3 cases. Now HelpAge registered trust under section 12AB, it is getting merged with unregistered trust. As it is getting merged with unregistered trust, it is required to pay tax on accreted income at the rate of maximum marginal rate. So assets were given: land, immovable property. What will we consider? Stamp duty value or fair market value, whichever is higher. 1st September 2010, that means before 12AB registration. So if any asset is purchased before 12AB registration, that should not be considered in calculation of fair market value of assets. Next, 1st September 2013, stamp duty value or fair market value, whichever is higher. That means we will take 120. Shares, quoted shares. For quoted shares, you need to consider average price. 320 plus 300 divided by 2, 310 shares into 5000 shares. How much? 5000 into 310. 15 lakh 50,000. Next, 2000 preference shares. What you need to consider? Fair market value. For any other asset, you will consider fair market value. 2000 into 180, 3 lakh 60,000. Next, book value of liability is 120 lakhs. Corpus fund. Corpus fund is like share capital, right? Share capital is not treated as liabilities. That should be excluded. Another important point. Here, fair market value of all assets minus liabilities, right? While calculating liabilities, you should exclude corpus fund. That means corpus fund is not a liability. Provision for tax is also not a liability. See, generally provision for tax is liability, but for calculation of accreted income, provision for tax is not a liability. Next, if any reserve is there for dividend, that reserve for dividend is also not a liability for calculation of accreted income, and reserves and surplus are to be excluded. Reserves and surplus is also not a liability. Next, provision for contingent or unascertained liability, that is also not a liability for the purpose of calculation of total liabilities. Are you able to understand? So all these items you should exclude. So whatever the items are there, all these you should exclude while calculating liabilities. So here liabilities are 120 lakhs. From 120 lakhs, you should exclude corpus fund, because corpus fund is not a liability. 12 lakhs you will exclude. Next, provision for tax. It is also not a, generally it is a liability. For calculation of accreted income, it is not a liability. Next, reserves and surplus, 18 lakhs. After you reduce all these three, 120 minus 12 minus 8 minus 18, 82 lakhs. So your total liabilities are 82 lakhs. Now shall we calculate accreted income? Accreted income. Fair market value of all assets. So immovable property, you will consider 120 lakhs, right? Land. Next, quoted shares. How much you will consider? Quoted shares, 15 lakh 50,000. Next, unquoted shares, 3 lakh 60,000. So how much is fair market value of total assets? 1 crore 39 lakh 10,000. From this, we are going to reduce liabilities. We have calculated liabilities. Na? While calculating liabilities, we should not consider corpus fund, we should not consider reserves and surplus, we should not consider any reserve for dividend, we should not consider provision for tax, we should not consider provision for unascertained or contingent liabilities. So we have calculated 82 lakh rupees. So how much is accreted income? 57 lakh 10,000. On this accreted income, tax rate applicable is MMR, maximum marginal. So 34.944%. How much? 19 lakh 95,302 point. So this is the tax that they need to. Now let us check the answer. As no one is there to tell me the answer, what can 19 lakh 95,302 we got rounded off to a previous multiple of 10, which is nothing but 19 lakh 95,000. So dear students, this is the concept of trust taxation. I hope you understood this revision very well. If you like this, please share with your friends as well. Thank you very much. Topic is MAT and AMT. Minimum alternate tax and alternate minimum tax. First, I will discuss MAT. Then we will do two problems. Once we finish our discussion with regard to MAT, then I am going to start with AMT, alternate minimum tax. Then on AMT also we will do one problem. Then we are going to conclude the. First of all, MAT. Sir, what is MAT? For whom MAT is applicable? MAT is applicable for companies. Sir, you said MAT is applicable for companies. There are a lot of companies in India, like private companies, public companies, listed companies, unlisted companies, government companies, foreign companies, domestic companies. So there are many companies, sir, for which companies MAT provisions are applicable. MAT provisions are applicable for all companies, whether company is private limited or public limited, whether it is domestic company or foreign company, whether it is government company or non-government company. For every company, MAT provisions are applicable. Are you able to understand? Now, sir, what do you mean? Like, what if MAT provisions are applicable? If MAT provisions are applicable, then tax as per normal provisions or MAT, whichever is higher, that is required to be paid. Whichever is higher is payable to government. What happened? Many companies, as per accounts, they are showing huge profits, but as per income tax, they are showing very low profits and they are paying lower taxes. Sir, how is it possible? Under accounts, depreciation rate is low. Under income tax, depreciation rate is high. So they are claiming higher depreciation and they are claiming they are reducing their profits. So in accounts, they are showing higher profit. In income tax, they are showing lower profit. Many benefits are there. Deduction under section 35 AD specified business. Deduction under section 10 AA. 100% of profits are eligible for deduction. So under income tax, they are taking advantage of certain sections and thereby they are reducing their total income and they are paying very lower taxes. However, under accounts, they are showing huge profits. So at least they should pay minimum certain amount of tax rate. That's why MAT provisions are introduced. So what if MAT provisions are applicable? Normal tax or MAT, whichever is higher, that is payable to government. Sir, you said MAT. How to calculate MAT? MAT is equal to book profit into 15% plus applicable surcharge plus health and education cess. Sir, what do you mean by book profit? I will explain little later. Today, entire discussion, majority of the discussion is on book profit only. We will discuss book profit, not a problem. Now, book profit into 15% plus applicable surcharge plus health and education cess. If your unit is located in IFSC, International Financial Service Center, Gujarat, then concessional rate is applicable. 15% MAT is not applicable. 9% MAT is applicable. So what you will do, every year you will calculate. If you are a company, you will calculate tax as per normal provisions, or you will calculate MAT, whichever is higher, that is required to be paid to government. Now I will take one example. Let's say normal tax. Normal tax is 18 lakhs. MAT is 14 lakhs. Now out of these two, whichever is higher means 18 lakhs na. So 18 lakhs is payable to government. Now SSC will start arguing, sir, I am required to pay only 14 lakh rupees, but you are compelling me to pay 18 lakh rupees. Why are you asking me to pay extra 18 lakh rupees? So for that, income tax department gave clarity. Whatever the excess tax paid, as per normal provisions, he is required to pay only 14 lakhs. But whatever the excess tax, 18 lakhs minus 14 lakhs that is paid is there, that will be treated as MAT credit. Okay. So this MAT credit can be carried forward and set off in next 15 assessment years. Carried forward and it can be set off in next 15 assessment. So did you understand? So every year we will calculate tax as per normal provisions. We will also calculate MAT. Out of these two, whichever is higher, that is required to be payable. If normal tax is greater than, sorry, if MAT is, here I did a mistake. Hold on. Let's reverse. MAT is 18 lakhs, normal tax is 14 lakhs. In this case, MAT is greater than, MAT is higher than normal tax. Na? As MAT is higher than normal tax, whatever the extra tax that is paid to government is there, that will be treated as MAT credit, and whatever MAT credit is there, it can be carried forward and it can be set off in subsequent 15 assessment year. Now, this is year 1. Let's say this is belonging to previous year 22-23. For example, in previous year 23-24, scenario is like this. MAT is 10 lakhs. Normal tax is 13 lakhs. Normal tax is 13 lakhs. Now, out of these two, whichever is higher means 13 lakh rupees. Na? So, tax payable is 13 lakh rupees. Remember, every year we need to minimum pay MAT. So every year either you will pay MAT or if you will pay normal tax, but minimum you should pay MAT. So how much is MAT? MAT is payable. MAT payable is 10 lakh rupees. Over and above MAT, how much is excess normal tax? Excess normal tax is 3 lakh rupees. Against this 3 lakh rupees, you can set off MAT credit. How much is MAT credit available? MAT credit available is 4 lakhs. But whatever the MAT credit 4 lakhs available is there, out of this, you can set off only 3 lakhs. 3 lakhs you will set off, balance 1 lakh, it will be carried forward to subsequent years. So in current year, how much you are required to pay? You are required to pay 10 lakhs. Are you able to understand? Minimum MAT you are required to pay to the government. So very simple logic. If MAT is greater than normal tax, if MAT is greater than normal tax, then how much is payable? MAT is payable. But whatever the difference is there, difference. What is difference? Difference is MAT minus normal tax. The difference will be treated as MAT credit and it can be carried forward and set off for next 15 assessment. This is point number 1. Point number 2. If MAT is less than normal tax, in that case, minimum you are required to pay MAT. Minimum MAT is payable. Minimum MAT is payable. Whatever the extra excess normal tax is there, excess normal tax, you can set off against MAT credit. You can set off against credit. After setting off against MAT credit, still if there is any balance, that balance is payable. So this is the concept of. Sir, we will see one another example. In 21-22, normal tax, MAT. Normal tax is 20 lakhs, MAT is 25 lakhs. Here MAT is greater than normal tax. Na? So how much is tax payable? Tax payable is 25 lakhs. Is there any MAT credit? Yes, there is MAT credit. How much is MAT credit? 5 lakh rupees. In 22-23, normal tax is 40 lakhs, MAT is 38 lakhs. So, how much is payable? Minimum MAT is payable. So, MAT means minimum 38 lakhs. How much is excess normal tax? Excess normal tax is 2 lakh rupees, correct? So, minimum 38 lakhs is payable. Excess normal tax 2 lakh rupees. Against this 2 lakh rupees, you can set off MAT credit. How much you can set off? You can set off 2 lakhs. After setting off MAT credit, how much is balance available? Balance MAT credit available is 3 lakh rupees. Are you able to understand? Now, previous year 24-25. In previous year 24-25, normal tax is 60 lakhs. MAT is 51 lakhs. So minimum MAT is payable na. So minimum 51 lakhs is payable. I am writing 51 lakhs. How much is excess normal tax? Excess normal tax is 9 lakh rupees. Out of 9 lakh rupees, how much you can set off? MAT credit available is only 3 lakhs. After setting off, still how much normal tax is payable? 6 lakh rupees. So total tax payable is 57 lakh rupees. MAT credit available is 0. I hope with this example you got complete clear cut understand. Did you understand till here? Now I will proceed further. What I said, every year tax as per normal provisions or MAT, whichever is higher is payable. Am I correct? Now, MAT calculation, book profit into 15% plus applicable surcharge. We have studied in case of domestic company, if total income more than 1 crore, surcharge rate 7%, total income more than 10 crore, surcharge rate 12%. If it is foreign company, total income more than 1 crore, surcharge rate is 2%, total income more than 10 crore, surcharge rate is 5%. That's what we need to apply, that surcharge, and we need to apply health and education cess. And 2-3 small points are there. If company, domestic company is paying taxes under 115 BAA or 115 BAB, in such case MAT provisions are not applicable. Similarly, if insurance company which is taxable under section 115B, for that insurance company also MAT provisions are not applicable. Next, 44B, 44 BBA, BB, 44 BBA. You know, right? Non-resident shipping business, non-resident aircraft business. In case of non-resident shipping business, presumptive income is 7.5% of aggregate income. In case of non-resident aircraft business, presumptive income is 5% of aggregate income. So for those non-residents also, MAT provisions are not applicable. Okay. Now, next we are going to see how to calculate book profits. This is important. Our entire discussion is about this only. Calculation of book profit. Explanation to section 115G. See, while we are calculating book profits, don't think about income tax P&L account. We are nowhere concerned about income tax P&L account. What is basis for us is Companies Act P&L account. Whatever Schedule 3 Companies Act P&L account is there, that we will take as base, and using that only we are going to do adjustments. So no relevance to income tax P&L account. For calculation of book profit, what we will consider is net profit as per Schedule 3 Companies Act 2013. If you are calculating MAT for banking company or power sector company or insurance company, they have separate acts na. As per those separate acts, you need to calculate. Are you able to understand? So as per those acts, as per those particular acts, you need to calculate the, you need to take whatever the profit as per Banking Regulation Act net profit is there, that you will take as base, or whatever the profit as per like uh, insurance company net profit is there as per insurance regulations, that you will take as base. Okay, so first you will take net profit as per Companies Act 2013, and you will do some additions, you will also do some deletions. Okay, thereby you are going to calculate the book profit. Whatever the book profit is there, on that book profit you are required to calculate MAT. First adjustment is whatever the income tax is there, income tax related expenses are required to be added. Income tax or surcharge or health and education cess or interest. So whatever the amount that is there as per Income Tax Act, income tax, surcharge, health and education cess, interest, all these are required to be added back. Okay, and dividend distribution tax. So all these, whether they are paid or provision for income tax is also required to be added back. Sir, we will calculate PGBP income. In PGBP income also we will do like this only. In PGBP also we will add back provision for income tax, we will add back advance tax, we will add back health and education cess, we will add back interest. What is difference between PGBP calculation and book profit calculation? In PGBP, if you pay any penalty as per Income Tax Act, that is required to be added back. However, as per book profits, whatever the penalty that is paid under income tax is there, that is not required to be added back. So very simple, penalty under income tax. When you are calculating PGBP, you will add back. But when you are calculating book profit, you will no adjustment. Okay, you will not add back, it will be as it is. Another important point, under PGBP, any direct tax will be added back. Wealth tax, it is direct tax, that will also be added back. However, for calculation of book profit, wealth tax is not required to be added back. Only income tax is required to be added back. Are you able to understand? Second adjustment. See, there is, I will take another sheet for our adjustments. P&L account is there. P&L account debit to general reserve. So if you create any reserve through P&L account, you are reducing your profits. You are creating more reserves and you are reducing your profits. So through P&L account, if you create any reserve, whatever the amount transferred to reserve is there, that is required to be added back. You have written P&L account debit to general reserve 8 lakh rupees. That is required to be added back. So second adjustment is amount transferred from P&L account debit to any reserve. So if you transfer any amount from P&L account to general reserve or any reserve created through P&L account, that is required to be added back. Same is the opposite. See here what you did, you have transferred amount from P&L account debit to general reserve. Reverse means what? You have brought amount from general reserve account debit to P&L account 5 lakh rupees. In that case, like your income is getting increased, but it should not be increased. So what you will do? You will reduce. So first adjustment is amount transferred to P&L account from any reserve. That is first adjustment. that you will reduce. Very simple. If you transfer any money to reserve, you are reducing profits. So whatever the amount transferred to reserve is there, that is not allowed, that will be added back. Same opposite. If you transfer any amount from reserve to P&L account, okay, that is also not correct. So whatever the amount that you transfer from reserve to P&L account is there, that will be that will be reduced. In that case, your income increases. To do the adjustment, it is to be disallowed. If income is disallowed, you will reduce it. Are you able to understand? So that is the adjustment. Dividend paid. Dividend paid is appropriation of profit. It is not expenditure, right? So in schedule 3 P&L account, if there is any dividend paid, that will be added back while you are calculating book profits. So dividend paid is required to be added back. Fourth one, provision for contingent or unascertained liability. That will also be added back. Sir, what do you mean by this? I will tell you. Provision for gratuity you have created. Is it allowed? That is not allowed. That will be added back. Under PGBP also, provision for contingent liability, provision for unascertained liability, you will add back. Under book profit calculation also, provision for contingent liability, provision for unascertained liability, you will add back. Under PGBP, any provision is required to be added back, whether it is contingent, ascertained or unascertained. Any provision that is created, that is required to be added back while you are calculating PGBP income. However, when you are calculating book profit, if any provision is created on based on actuarial valuation, or if any provision is created based on a scientific basis, then whatever the provision that is created on scientific basis or created on actuarial valuation is there, that is not required to be added back. See, this is the difference you need to remember. Under PGBP, any provision you will add back. Okay, whether it is scientific basis, whether it is actuarial valuation, any provision you will add back while you are calculating PGBP income. But when you are calculating book profit, if any provision is created on actuarial valuation, that is not required to be added back. Any other provision of contingent liability or unascertained liability, that is required to be added back. I will tell you one example. After 10 years, company is required to pay gratuity. How much gratuity is payable? I recruited one actuarial valuationer. I have valued the provision for gratuity, and whatever the provision for gratuity that I have created based on actuarial valuation is there, this will be added while calculating PGBP income, but this will not be added while calculating book profit. Are you able to understand? So very simple, all provisions are required to be added back as per PGBP, but any provision created based on scientific basis or on actuarial valuation, that will not be added while calculating book profits. Remaining provisions will be added back. Are you able to understand? Next, there is one interesting thing. Provision for bad debts. Whether provision for bad debts is allowed as per PGBP. As per PGBP, provision for bad debts is disallowed, right? However, as per Companies Act, book profits also it is disallowed. But what happened? There is one case law. In that case law, SSC challenged income tax department. What SSC said, sir, provision for contingent liability or unascertained liability, that is required to be added back. Provision for bad debts, when provision for bad debts is created, this is created against asset. Am I correct? This is created against debtors. Whether debtors are liability, debtors are not a liability, right? So he won the case in Supreme Court. He said that what he said, provision for contingent liability is required to be added back, but provision for bad debts, it is created against debtors. Debtors is not a liability. So he won the case. Provision for bad debts is not required to be added back. Then income tax department realized the loophole. What is loophole? If you create provision against liability, that is required to be added back. But provision for bad debts is not created against liability, na? It is created against asset. So income tax department realized that there is loophole, and income tax department added another new point in the next finance act, that is provision for diminution in valuation of diminution in value of asset or investment. So against asset value or investment value, if you create any provision, that is also required to be added back. AS 13 investments is there. So if you make any investment at the end of the year, you will value it. Okay. So if there is any loss compared with market, that for that loss you will create provision for loss on investment, that is also required to be added back. So not only against liability, even against any asset, if you create any provision, that provision is required to be added back while you are calculating book profits. This is something very interesting. Income exempted under section 10, 11 and 12. Income exempt under section 10, 11, 12, that is required to be reduced. Agricultural income is there. Agricultural income is not taxable. It is exempt. But accountant does not know na what accountant will do when he is preparing P&L account. He will credit agricultural income. So whatever the agricultural income that is credited is there on this MAT is not applicable. As MAT is not applicable, whatever the agricultural income is there, that will be reduced while calculating book profits. So whatever the income that is exempt under section 10, 11, 12, that income is to be like reduced while you are calculating book profit, because as that income is not taxable, on that income MAT is also not applicable. Are you able to understand? Similarly, if there are any agricultural expenses, see, income is exempt, it is reduced. So if there are any expenses relating to agricultural income, they are also not to be allowed as deduction, right? So whatever the expenses relating to income exempt under 10, 11, 12 sections are there, those expenses are to be added back while you are calculating book profits. Are you able to understand? So to this you will add back expenses of income exempt under section 10, 11, 12. So whatever the expenses relating to incomes exempt under section 10, 11, 12 are there, they are required to be added back while you are calculating book profit. Loss of subsidiary company. Whatever loss of subsidiary company is there, that is required to be added back while you are calculating book profit. Otherwise, it becomes a loophole. He will intentionally create subsidiary company. He will book losses there. Thereby, he can reduce book profits. So that's why what lawmaker said, if there is any provision for loss of subsidiary in Schedule 3 Companies Act, that is required to be added while you are calculating book profits. Deferred tax. In your FR, in days, you have studied about deferred tax, right? So, if there is deferred tax liability, what is the entry that you will pass? P&L account debit to deferred tax. Similarly, if there is a deferred tax asset, what is the entry that you will pass? Deferred tax account debit to P&L account. Whatever deferred tax is there, that is not allowed. Okay. So if there is a deferred tax asset, what is the entry that you will pass? Deferred tax asset account debit to P&L account. That will be reduced. If there is deferred tax liability, what is the entry that you will pass? P&L account debit to deferred tax. However, deferred tax liability expenditure is not allowed. For that, as it is not allowed, what you will do? You will add back deferred. Next, income of AOP BOI. Whatever income of AOP BY is there, that is also to be excluded. Sir, why income of AOP BY is to be excluded? AOP BY already paying taxes at maximum marginal rate. As AOP BY is already paying taxes, what after payment of taxes, balance income we have received. So whatever the share of income that we are getting from AOP or BY is there, that income is after payment of taxes. So as it is after payment of taxes, again MAT provisions are not able to understand. So whatever the share of income from AOP or BOI is there, that is to be excluded. Similarly, if there is any expenditure relating to share of income from AOP or BOI, that is required to be added back. See, income you are disallowing, whatever the expenditure relating to that income is there, that is also required to be added back. That is next adjustment. Okay, 10th one. Here it is, 5th one. Royalty income taxable under section 115 BBF at the rate of 10%. So if you are resident patent holder, as per section 115 BBF, whatever the royalty income that you receive, that is taxable at very nominal rate of 10%. So royalty income 115 BBF, they said they will levy tax of 10%. Again, by MAT, if they levy 15%, it's like cheating. Na? See, I am getting royalty income, I am required to pay 10% tax. Again, they are only coming and they are telling me you are required to pay 15% tax. What will I tell? You are doing cheating. Correct? Cheating kar rahe tu. Correct? So that's why if there is any royalty income which is taxable at 10%, which is less than MAT, then on that MAT is applicable, on the tax rate of 10% is only applicable. So that will be reduced while calculating book profit. Similarly, if there is any expenditure for royalty income taxable at the rate of 10%, that expenditure is also required to be added back. See, royalty income is reduced, so corresponding expenditure is also to be disallowed. Na? That's why expenditure relating to royalty income we will add back. Are you able to understand? Next adjustment is depreciation. Whatever the depreciation is there, depreciation will be add back. Sir, in PGBP, what will we do? We will add back Companies Act depreciation. We will reduce income tax depreciation. But careful, when you are doing calculation of book profits, you will add back Companies Act depreciation. You will also reduce Companies Act depreciation. Companies Act depreciation minus depreciation on revalued assets. Very important adjustment. You will get confused, but you should not get confused. What I said, as per PGBP, add back Companies Act depreciation, reduce depreciation as per Income Tax Act. But when you are calculating book profits, then you are playing with Companies Act P&L account. You should add back Companies Act depreciation. You should reduce Companies Act depreciation minus depreciation on revalued assets. For example, let's say depreciation is 400 crores. Out of this 400 crores, like normal depreciation is 350 crores. Depreciation on revalued assets is 50 crore rupees. What will you do? You will add back 400 crores, but here you will not add back 400 crores. You will reduce 400 crores minus depreciation on revalued assets 50 crores. So how much you will reduce? You will reduce only 350 crores. Are you able to understand? So you will add back Companies Act depreciation. When you are reducing, don't think of income tax depreciation. You need to reduce Companies Act depreciation only, but after reducing depreciation on revalued assets. Are you able to understand? I hope this depreciation concept you are very clear. This adjustment pakka will come in examination. So please be very careful. Okay. So what I said, PGBP, add Companies Act, reduce income tax. Book profit, add Companies Act, reduce also Companies Act, but after reducing depreciation on revalued assets. Okay. Next one, this is also a bit important. Transfer from revaluation reserve, but you will reduce only to the extent of depreciation on revalued assets. depreciation on revalued assets. Only that will be. For example, I will take one example. P&L account is there. In P&L account, in the same example, we have discussed example na 400 crores is depreciation. Out of that, 350 crores is normal depreciation. 50 crores is depreciation on revalued assets. Correct? What happened? Revaluation reserve account debit to P&L account, 90 crores entry was written. Okay. So as per Ind AS, I think Ind AS 16, right? PPE. Am I correct, Monish? What is Ind AS per PPE? Is it Ind AS 16? I feel there is some lag between you and me. So Ind AS 16, right? Perfect. So as per Ind AS 16, I don't know the treatment, but let us assume the entry written is revaluation reserve account debit to P&L account 90 crore rupees. But how much is depreciation on revaluation? Depreciation on revaluation is 50 crore rupees. So when you are calculating book profits, how much you will reduce? You will reduce only 50 crore rupees. Are you able to understand? Let's say revaluation reserve account is 40 crores. How much is depreciation? Depreciation on revaluation assets. Depreciation on revaluation assets is 50 crore rupees. In this case, how much you will reduce? You will reduce total 50 crores. Okay. Next, let's say depreciation on revalued assets is 60 crores. How much you will reduce? You cannot reduce 60 crores. Maximum you will reduce is only 50 crores. In this case, how much you will reduce? You will reduce 40 crore rupees. Similarly, revaluation reserve is 120 crore rupees. But how much is depreciation on revalued assets? 50 crores. How much you will reduce is only 50 crore rupees. So if any amount is transferred from revaluation reserve to P&L account as per Ind AS 16, then total amount transferred from revaluation reserve, you cannot reduce 90 lakh rupees. Okay, that's not correct. Maximum you can reduce is to the extent of depreciation on revalued assets. That is another adjustment. So if any amount is transferred from revaluation reserve to P&L account, don't reduce total amount, either that amount or depreciation on revalued assets, whichever is lower. Okay, so only to the extent of depreciation on revalued assets it will be reduced. Profit of sick industrial company. Sick industrial. See, already it is sick company. It is not making any profits. It is into losses. But from government grant, it came into profits. Just now it came into profits. Again, if you levy MAT, it will be burdensome. So whatever the profit of sick industrial company is there, that will be reduced. Next point. Foreign company is there. For foreign company, in NR taxation, concessional tax rates are there. Capital gains, interest on security, they are taxable at less than 15%. So those which are taxable at less than 15%, on that if you apply, if you levy MAT 15%, they will tell cheating. Okay, Nirmala Sitharaman went to foreign. She tell invest in India, tax rate is only 10%. After they come to India, she is telling MAT is applicable, 15% tax is payable. Now they will tell Nirmalamma is cheating. Okay, you said 10%, again you are levying MAT 15%. So in order to maintain international relations, so whatever the income that is taxable at less than 15% in case of foreign company there, that will be reduced. On that MAT is not applicable. On that reduced tax rate is only applicable. Are you able to understand? Similarly, corresponding uh, adjustment, expenses of foreign company relating to capital gains or interest on securities which are taxable at less than 15%. for those assets, if any expenditure is incurred, that is also not allowed. If income is there, that is reduced from book profit na. So if there is any expenditure, that will also be added back, that is disallowed from book profits. Okay, so that needs to be added back. That is next adjustment. Next, one benefit was given to companies, brought forward losses or unabsorbed depreciation, whichever is lower, it can be reduced. Sir, brought forward losses as per Income Tax Act? No. Brought forward losses as per Companies Act, unabsorbed depreciation as per Companies Act. Out of these two, whichever is lower is there, that can be reduced. Are you able to understand? But there are two cases. For example, insolvency application. Any company for which insolvency application is made, or any company for which section 241 and 242 of Companies Act is applicable. Okay. So in these two cases, like brought forward losses and unabsorbed depreciation, both are allowed as deduction. Both are allowed as deduction. What I said, generally conjunction is or. What is general conjunction? Or. But in two cases conjunction is and. In two cases conjunction is and. What are those two cases? Section 241, 242 of Companies Act are applicable, or any company became like it did not become insolvent, insolvency application was filed. In these two cases, both, okay, brought forward losses, unabsorbed depreciation, both you can claim as deduction. Are you able to understand? So these are the adjustments. I think one more adjustment is also there. Sorry, two adjustments are there. I will tell. See, till now, how many adjustments we have seen? We have seen 12 adjustments. What is interesting is all these 12 adjustments, they need to be added back when credited to P&L account. They need to added back, sorry, when debited to P&L account. Okay, but in one situation, even though amount is not debited to P&L account, still it is required to be added back. What is that one? I will explain. See, there is one asset. The asset cost is 20 lakh rupees, but fair market value is 90 lakh rupees. I don't want to pay tax. Now, how much is my profit? If I sell in the market, my profit is 70 lakh rupees. On this 70 lakh rupees, I don't want to pay tax. What will I do? There is one hack. Normally, as per accounts, what will you do? Accounts, you will write bank account debit 90 lakhs to asset account 20 lakhs to P&L account 70 lakhs. Correct? Whatever this 70 lakhs is there, on this MAT is applicable now. So if I disclose, if I credit 70 lakhs to my P&L account, on that 70 lakhs, I am required to pay minimum alternate tax. Now how to avoid that minimum alternate tax? I have one hack. What is that hack? What I will do? Asset, how much is asset cost? 20 lakhs. Fair market value 90 lakhs. What I will do? I will do revaluation. I will write the entry asset account debit to revaluation reserve account 70 lakh rupees. Now I will sell the asset bank account debit 90 lakhs to asset account 90 lakhs nullified na. Asset account is like 70 lakh plus 20 lakhs 90 lakhs, it got nullified. And whatever my profit is there, revaluation reserve, this I will directly transfer to general reserve without touching P&L account. Are you able to understand the loop? What will I do? Revaluation reserve account debit to general reserve account 70 lakh rupees. So in this entire transaction, did I touch P&L account? Did I touch P&L account? No, I did not touch P&L account. I did not touch P&L account. Am I correct? So in this entire transaction, I did not touch P&L account at all. I did not touch P&L account. So this has become a loophole. Somehow Nirmalamma came to know about this loophole. Nirmalamma said, so whenever you sell any asset, with regard to that asset, if there is any balance in revaluation reserve, that should be credited to P&L account. If you fail to credit it to P&L account, it will be added while you are calculating book profits. Are you able to understand? That is 13th adjustment. The 13th adjustment is on sale of asset. Whatever corresponding revaluation reserve is there, that should be credited to P&L account. If not, if it is not credited to P&L account, that will be added in calculation of book profits. So I told you the loophole. I also told you how it was countered by Nirmala Sita. Next, one last adjustment is there. So I hope you found this example interesting. Last example is relating to business trust. Let's say there is MRF Limited and there is it invested in My Home Limited. Actually, My Home Limited is basically a real estate company. Real estate company. So MRF Limited invested in My Home Limited real estate company. Now, MRF Limited wants to form business trust. How it will form business trust? MRF Limited is there. So it is having shares of My Home, right? Shares of My Home. Now what it will do? What MRF Limited will do? MRF Limited is having shares of My Home Limited, right? So we can tell My Home Limited is SPV, Special Purpose Vehicle. It will create business trust. When creating business trust, actually MRF Limited is having shares of My Home Limited. What MRF Limited will do? MRF Limited will transfer shares of My Home Limited to business trust. In return, MRF Limited will get units of business trust. So here there is exchange. Na? What MRF Limited is doing, it is actually shareholder of My Home Limited. It is transferring shares of My Home Limited to business trust and business trust is giving units. So there is exchange here, exchange of My Home shares for getting units of business trust. Whatever this exchange transaction is there, na, this exchange transaction is not a transfer and no capital gains are required to be calculated. No capital gains are required to be calculated. But the point here is shares transferred are 40 crore rupees, units received are 45 crore rupees. There is a notional gain. Na? How much is notional gain? Notional gain is 5 crore rupees. Tell me, what, for suppose I am MRF Limited. What I am doing? I am transferring my shares in My Home Limited to business trust. From business trust, I am getting units. How much worth of shares I transferred? 40 crores. How much worth of units I received? 45 crores. Now I got profit of 5 crore rupees. But did that 5 crore rupees realized? Those 5 crore rupees was not realized. So at the time of exchange of SPV shares for getting units of business trust, if there is any income or loss, that is notional in gain or notional loss, whatever the notional gain is there, that will be reduced. If there is notional loss, that will be added back while calculating book profit. Are you able to understand? So last adjustment, notional gain. If there is notional gain, that will be reduced. Notional gain on exchange of shares of SPV to receive units of business trust. That notional gain is to be reduced, and whatever the notional loss is there, that notional loss will be added. Sir, you said 5 crore rupees is notional gain. It is not realized. In current year, it was reduced from calculation of book profits. Is it not at all taxable? Profit 5 crores is there. Is it not at all taxable? Answer is no. In future, I will sell these units, right? The year in which I sell the units, whatever the total gain that I receive on the total gain in the year of realization, in future when I realize 100% of profits, in that year I am required to pay MAT. So whatever the gain, final gain, realized gain is there, so realized gain is to be added. Realized gain on sale of units of business trust, that is to be added. If there is finally if I get any loss, so in the year of realization, if I get any loss, realized loss, so realized loss on sale, final sale, if there is loss, that I will, are able to understand? So these are all the adjustments which you need to do for calculation of book profit. Are you able to understand? So shall we do one problem, everybody? So this problem is from institute. Now we will do one problem at, if possible we will do 2-3 problems also. Yeah. If you see institute material, if you want, I will send institute material to our Telegram group so that you can also easily access. Give me 1 second. So to our Telegram group, I have transferred the institute material. So it will be handy. You can easily access, see this problem. I hope you received this material. Comment us if you have received the material. Now, shall we discuss? Yes, illustration 1. Page number is 9.37, my dear students. Please open 9.3. A domestic company, ABC Limited, furnishes following particulars in respect of assessment year 25-26 and seeks your opinion on application of section 15 JB. You are also required to compute total income and tax payable. See here, what is he saying? He is asking us to calculate total income as well as tax payable. So when he asked us to calculate tax payable, we need to calculate tax as per normal provisions. We also required to calculate MAT. Out of these two, whichever is higher, that is the final tax payable. Are you able to understand? So in this problem, you are required to calculate PGBP income. You are also required to calculate book profit. Which one we will calculate? First, shall we calculate book profits or shall we calculate PGBP income? Your wish. Tell. You want book profits or PGBP income? Okay, first we will calculate book profit. So profit as per Schedule 3 Companies Act, that is base. Net profit as per Companies Act, that is base. How much? 215 lakhs. First we are calculating book profit. I am sorry Monish, you are asking PGBP, but there was some lag in between you and me. I took the decision book profit. So first we will finish book profit, then I will calculate P. Statement of profit and loss includes dividend income from Indian companies. Whether dividend income is required to be excluded, till now we have discussed additions and deletions from book profit. Did we discuss about dividend? No. On dividend, MAT is applicable. You are not required to reduce. Excess realized on sale of land, capital gain. See, till now we have discussed the book profit calculation. Did we see capital gain? Yes. In case of foreign company, if capital gain tax rate is less than 15%, then we need to reduce. However, here it is domestic company. Am I correct or not? If it is domestic company, why will you reduce capital gains? You will not reduce capital gains. On that capital gain also, MAT is applicable. Okay. Depreciation on straight line method. This will be added. Depreciation as per Companies Act, add back. Also reduce depreciation as per Companies Act, but reducing after reducing depreciation on revalued asset. Are you able to understand? Provision for loss of subsidiary. This is required to be added back. Depreciation as per income tax rules. This is coming in the middle. Don't consider depreciation as per income tax rules. Like you will have susceptibility. The moment you see income tax depreciation, okay, sugar will not be controlled. Okay, you will immediately reduce, but you should not reduce. When you are calculating book profit, you should reduce only Companies Act depreciation. Short-term capital gain on sale of land. On this also, MAT is applicable. You are not required to reduce. Losses as per books and as per income tax. So brought forward loss or unabsorbed depreciation, whichever is lower. Whichever is lower means 50 lakh rupees. So what are the adjustments? First, you need to add back depreciation on straight line basis. So add Companies Act depreciation. How much is Companies Act depreciation? 100 lakhs. Provision for loss of subsidiary. That is also required to be added back. So loss of subsidiary. Next. You will reduce depreciation. Depreciation minus revaluation depreciation. So is there any revaluation depreciation given? No. It is 0. So how much you will reduce? 100 lakhs. Next. Brought forward loss or unabsorbed depreciation, whichever is lower. How much is brought forward loss? Brought forward loss 50, unabsorbed depreciation 60 lakhs. Whichever is lower means 50 lakhs. So how much is book profit? 215 lakhs plus 100 plus 6. 225 lakhs. Is it correct? Let us check. Yeah, book profit is 25 lakhs. So shall we calculate MAT? What is MAT rate applicable? 15% na? And here book profit is more than 1 crore. So surcharge of 7% is applicable. So how much is tax? 225 lakhs into 15%. How much? 33 lakhs 75,000. To this you will add surcharge at the rate of 7%. 236 250. How much? 33 lakh 75,000 plus 236. 36 lakh 11,250. To this you will add HEC at the rate of 4%. 1,44,450. 37 lakh 55,700. Is it MAT? Am I correct? Yeah, 37 lakh 55,700. That is. Now, shall we calculate PGBP income? Everybody, I want some Josh. PGBP. See, I will tell you. I am studying Finance Act number 2 of 2024 to teach you this revision lecture. I am also studying Finance Act 2025 to prepare for next attempt. I am also studying new income tax bill which is going to come from 1st April 2026 onwards. See, whenever I go to different class, I need to change my mode. Okay, I came to your class, change the mode to Finance Act number 2 of 2024. That's how it was there for me. Similarly, you also, when you are calculating book profit, you need to tune your mind to Companies Act. whenever you are calculating PGBP income, you need to tune your mind to Income Tax Act. Okay, so now we are going to calculate PGBP income. You forget about book profit calculation, Gajini. Now you are going to apply provisions of Income Tax Act. Okay, now shall we do the adjustments? So profit as per Companies Act, we will take dividend income. This is taxable under IFOS, right? So will it be credited to P&L account? No, this is to be disallowed. If income is disallowed, what you need to do? You will less. Excess realized. This is capital gain. Capital gain is separately taxable under the head capital gains. Will it be credited to P&L account? No, it will be disallowed. If income is disallowed, you will reduce. Am I correct? Depreciation on straight line method. See, Companies Act depreciation. Why will it be allowed under income tax? No, that is to be disallowed. If expenditure is disallowed, what is the treatment? You will add back. Provision for loss of subsidiary. Array why? As per income tax provisions, any provision that you have created, any provision is required to be added back. So provision for loss of subsidiary, that also you will add back. Depreciation as per income tax, that you will reduce. Short-term capital gain. So short-term capital gain other than triple 1A. If nothing is said, short-term capital gain is other than triple 1A. It is taxable as per normal provision. And under income tax, you will claim business loss. You will also claim unabsorbed depreciation. Careful, while you are calculating PGBP income, you will reduce business loss. You will also reduce unabsorbed depreciation. But when you are calculating book profits, then like unabsorbed depreciation or business loss, whichever is lower, you will reduce. Are you able to understand? Shall we calculate everybody? So Monish and Varun are my constant partners. They are completely following me from beginning to the end. So yes, let's calculate PGBP income. Net profit as per Companies Act, how much? 215 lakhs. Next, dividend income from Indian companies. This is to be reduced, right? So less dividend income. How much is dividend income? Dividend income is 20 lakhs. Capital gain is 30 lakhs. Capital gain 30 lakhs will also be depreciation on. I see. Companies Act depreciation, we will add back. We will reduce income tax depreciation. So add Companies Act depreciation. How much? 100 lakhs. How much is income tax depreciation? 150 lakhs. Next, provision for loss of subsidiary. Loss of subsidiary, how much? 60 lakhs. What's next? Yeah, business loss 50 lakhs. Unabsorbed depreciation 60. So how much is net PGBP income? Can someone help me? 215 minus 100 minus 65 lakhs, correct? To this, we will add capital gain. How much is short-term capital gain? Short-term capital gain is 30 lakhs. We will add dividend. Dividend is taxable under IFOS, na? How much is dividend? 20 lakhs we will add. So how much is total income? Total income 65 plus 150. Am I correct? Whether total income is 115 lakhs? Oh, somewhere I did mistake it. I'm sorry, capital gain is 40 lakhs na. I took 30 lakhs. Capital gain, short term capital gain is 40 lakhs. So total 125 lakhs. I can make mistake. I am already qualified. Again in my life, I am not required to write CA exam again. But you should not make. Total income 125 lakhs and turnover of company is 390 crores less than 400 crores. So tax rate applicable is 25%. 125 lakhs means more than 1 crore. Surcharge of 7% is applicable. So how much is tax? 125 lakhs into 25%. 31 lakh 25,000. To this, we need to add surcharge at the rate of 7, which is 2 lakh 18,750. Total 33,43,750. To this, we will add HEC at the rate of 4%, which is 1 lakh 33,000. So how much is final tax? 34 lakh 77,000. So this is normal tax na. Normal tax is 34 lakh 77,500. How much is MAT? We have calculated in the beginning. MAT is 37 lakh 55,000. So out of these two, whichever is higher, 37 lakh 55,700 is payable. So what is payable is MAT. In this scenario, MAT is greater than normal tax. So MAT credit is available. How much is MAT credit? MAT credit is equal to 37,55,700 minus 34,77,500 balance 278,200. This will be carried forward and set off in next. So are you clear till here? I can't hear. Of course, how can I hear? I'm only going through your comments. Now, there are 4 adjustments which I need to teach you with regard to Ind AS. Once I teach those adjustments, uh, MAT concept will be completed. I will switch to AMT concept. Okay. So, if company is following Ind AS, in that case, certain extra adjustments also required to be done. What are those adjustments? Net profit as per Schedule 3 Companies Act, you will take, and you will add some additions. You will also reduce some deletion. See, as per Ind AS, there is one account called OCI, Other Comprehensive Income. When you are studying financial instruments, Ind AS 109, Ind AS 32, at that point of time, you would have studied, your FR faculty would have told you about other comprehensive income. In other comprehensive income, certain items you will restate it to P&L account, certain items you will not restate to P&L account. So as per Ind AS, like there is P&L account, there is also other comprehensive income account. In other comprehensive income account, there are certain incomes which are not restated to P&L account. See, if they are not restated to P&L account, in future, they will never come to P&L account. If they never come to P&L account, MAT is not applicable. So, those items which are created to other comprehensive income and which are never restated to P&L account are there. They are escaping from MAT. So, if there are any such items, you need to add while calculating book profits. Are you able to understand? So, what you will do first adjustment is items credited to OCI. See, if it is credited to P&L account, anyhow MAT is applicable, but they are not credited to P&L account, they are credited to other comprehensive income. See, if you have knowledge on Ind AS, the explanation will be meaningful. If you do not have knowledge on Ind AS, go to financial instruments, Ind AS 10932, learn about OCI and come back here and listen this concept. Okay, so items credited to OCI, and not restated to P&L account. That should be added back. Not restated to P&L account. That needs to be added back. Similarly, if any item is debited, if any expenditure is debited to OCI, if any item is debited to OCI and it will never be restated to P&L account, that we will reduce. So items debited to OCI and never restated to P&L account, that should be reduced. See, as per Ind AS 9, equity instruments are revalued. Whenever equity instruments are revalued, whatever the gain or loss that you will receive, that you will transfer to other comprehensive income. Okay. So, let's say initially equity instrument value is 100 crores. But later on, at the end of the year, fair market value is 110 crores. Gain is 10 crore rupees. You will credit 10 crore rupees. But whether is it realized gain, it is not realized gain, it is only notional gain. So whatever the amount transferred to OCI is there, with regard to equity instruments, that needs to be adjusted. Okay, so second addition is, this is first addition, second addition is gain on change in fair value of equity instruments, equity shares through OCI, that needs to be added. And if there is any loss from change in fair value of equity shares through OCI, that needs to be reduced because it is not realized yet. Next, demerger. See, at the time of demerger, assets are 100 crore rupees. But when these assets are transferred to another company, fair market value is 120 crore rupees. That means 100 crores worth of book value of assets I am transferring to resulting company, but fair market value of that asset is 120 crores. I will tell one example. Tata Limited got split into Tata Limited and Kanishka Limited. See, Tata Limited transferred 100 crores worth of assets. So, book value is 100 crores, but fair market value is 120 crores. So, how much is gain is there? Gain is 20 crore rupees. Whatever the gain 20 crore rupees is there, is it realized? It is only notional, na? So, whatever the notional gain is there, that should not be recognized in calculation of book profits. Are you able to understand? So, if there is any amount credited to P&L account during demerger, so if any gain 20 crores, see this 20 crores gain is there, na? This is credited to P&L account. But is it realized? Is it in the form of cash? It is not in the form of cash. So as it is not realized, now you will reduce it. In future, whenever you realize that amount, in that year, it is going to be taxable. Are you able to understand? So similarly, amount debited to P&L account during demerger. For example, loss is there, that will be added back. For example, book value is 100 crores, but fair market value is only 90 crores. How much is loss? Loss is 10 crores. This is notional, na? Whatever the notional loss is there, that will be added back. Okay. You know Ind AS 101. As per Ind AS 101, when you are transitioning, when you are shifting from AS to Ind AS, there will be transition amount. Okay. So whatever the transition amount is there, transition amount, if transition amount is credit balance, then it is income. If transition is debit balance, then it is loss. So whatever the income or loss that is there because of transition is there, that will not be given effect in 1 year. No, that will be given effect in 5 years. Okay. So that's why whatever this income is there, this will be 1/5 of income will be recognized over a period of 5 years. Similarly, whatever the loss is there, 1/5 will be recognized over a period of 5 years. So whatever the loss that will be reduced in 1/5 of transition amount. If it is loss, it will be reduced. If it is gain, 1/5 of transition gain will be recognized over a period of 5 years. So these are the adjustments that you need to do if you are following it. This is the concept of MAT. I hope you enjoyed. Now, shall I discuss AMT, alternate minimum tax? This is small topic only. We can clear off less time, and we will also do one problem on. I thank you both, Monish and Varun, for being consistent. Now, see, for companies, MAT is applicable. Other than for companies, for remaining provisions, for remaining persons, alternate minimum tax provisions are applicable. Are you able to understand? So other than companies, for remaining persons, AMT provisions are. Sir, what if AMT provisions are applicable? Okay, same story. If AMT provisions are applicable, normal tax or AMT, whichever is higher is payable. Normal tax or AMT, whichever is higher is payable. Next question is, sir, how to calculate alternate minimum tax? Alternate minimum tax means adjusted total income into 18.5% plus applicable surcharge plus health and education. Other than companies means what? Like for individual, HUF, AOP, BOI, partnership firm, LLP, local authority, AJP, for every other person, this AMT provisions are applicable. But if cooperative society is there, for cooperative society, concessional AMT rate is applicable, 15% rate is applicable for cooperative. Next, same story. If AMT is greater than normal tax, in that case, AMT is payable. AMT credit is available. How much is AMT credit? AMT credit is equal to AMT minus normal. Whatever this AMT credit is there, this can be carried forward and set off in next 15 SS. If AMT is less than normal tax, in that case, minimum AMT is payable. Minimum AMT is payable. Whatever the excess normal tax is there, excess normal tax, you can set off against AMT credit. You can set off against AMT credit. Whatever the balance is there, that balance you need to. For example, in this case, after set off, still balance AMT credit is there. Balance AMT. In that case, it will be carried forward to same, just like MAT, AMT is copy paste. But MAT is applicable for companies, AMT is applicable for other. Now, next question is how to calculate this adjusted total income. Calculation of adjusted total income. What is base for calculation of adjusted total income? You will take total income as per income tax provisions. Whatever total income as per income tax provisions is there, for that you will add back deduction under section 10AA, deduction under section 35AD, chapter 6A deduction under section 80IA to 80RRB. All these three deductions you will add back. After adding back all these three deductions, you are going to arrive at adjusted. No, I am sorry. From this, you will reduce depreciation on assets of 35AD business. The depreciation you will reduce. After reducing the depreciation, you are going to arrive at, sorry, not book profit, adjusted total income. So from this we can come to one conclusion. Those persons other than companies who are having deduction under section 10AA, who are having deduction under section 35AD, who are having deduction under section 80IA to 80RRB, chapter 6A deductions. So if any person is having these three deductions, any one of these three deductions, then only this AMT provisions are applicable. Otherwise AMT provisions are not applicable. Are you able to understand? So you know how to calculate adjusted total income. On this adjusted total income, you will apply 18.5% plus surcharge plus. Another important point, other than companies. For example, resident cooperative society is there. It is paying taxes under 115 BAD or 115 BAE. Resident cooperative society. And there is individual. He is paying taxes under 115 BAC, individual. So under 115 BAC, 115 BAD, 115 BAE, if persons are paying taxes under concessional tax rates, AMT provisions are not applicable. Are you able to understand? Yeah, except ATP, 80IA to 80RRB, except ATP. I agree with you, deduction in case of POP. In case of individual, HUF, AOP, BOI, AJP, for these persons, if adjusted total income is less than or equal to 20 lakhs, then also AMT provisions are not applicable. See what I said, individual, HUF, AOP, BY, AJP. That means in case of partnership form or LLP, irrespective of adjusted total income, AMT provisions are applicable. Irrespective of adjusted total income, AMT provisions are able to understand. On whatever AMT credit is there, on AMT credit, government will not pay any. So this is the concept relating to AMT. Shall we do one problem? AMT, shall we do one problem? I think 70 some. Page number. Or else let's do one thing. Final questions are there na, at the end of the chapter. Please open those questions. Test yourself, questions are there na? Open question number 6. PQR LLP. So PQR LLP, a limited liability partnership firm, set up a unit in special economic zone in the financial year 1920. With for production of washing machines, the unit fulfills all the conditions under section 10AA. See, under section 10AA, first 5 years, 100% of export profits. 1920 is first year. So 24-25 is 1920 first year, 2021 second, 21-22 third, 22-23 fourth, 23-24 5, 24-25 is sixth year. As it is here, only 50% of export profits are eligible for deduction, not 100% of export profits. Okay. So during financial year 23-24, it has also set up a warehousing facility in a district of Tamil Nadu for storage of agricultural produce. It fulfills all conditions under section 35 AD. Capex in respect of warehouse is 75 lakhs, including cost of, see, cost of land. Land is not a depreciable asset. So whatever 10 lakhs is there, that 10 lakhs is not allowed. So 75 lakhs was capitalized. Profit of unit located in cess. See, first of all, this is LLP. It has deduction under 10AA. It has deduction under 35 AD. In examination, he will not specifically tell you to calculate AMT. The moment you see deduction under 10AA or deduction under section 35 AD, immediately it should strike in your mind that you need to calculate AMT. Are you able to understand? So profit of unit is 40 lakhs, exports 80 lakhs, domestic sales 20 lakhs. So first will we calculate deduction under section 10AA? Deduction under section 10AA, 50% of export profits, right? 50% of export profit. So what is formula for export profit? Export profit is equal to total profit into export turnover divided by total turnover. So how much is total profit? 40 lakhs. Export profit is 80 lakhs. Total turnover means 80 lakhs export turnover plus 20 lakh domestic turnover. How much? 40 lakhs into 80%, 36 lakhs. 50% of export profits means 36 lakhs into 50%. 36 or 32? I am sorry, 32. 32 lakhs into 50% means 16 lakhs. So therefore deduction under section 10AA is 16 lakh rupees. Now shall we calculate? First we will calculate tax as per normal provisions, then we will calculate AMT. So as per normal provisions, how much is cess profit? Cess profit 40 lakhs. From this you can claim deduction under section 10AA. How much? 16 lakhs. So how much is balance? 24 lakhs. Next, 35 AD business profit. How much? 105 lakhs. Correct. From this, you can claim deduction. 75 lakhs minus cost of land. Land cost 10 lakhs, that is not allowed. Only 65 lakhs is allowed. Less capex. How much is capex? 65 lakhs. So how much is taxable? 40 lakhs. So how much is total income? Total income is 64 lakhs. So on 64 lakhs, for partnership form, tax rate applicable is 30%. Correct? So tax is 64 lakhs into 30%. Much? 19 lakh 20,000. To this, you will add HEC at the rate of 76,800. Total 19 lakh 96,800. You also got the same answer? Please reply. Next, we need to calculate AMT. What will we take? Total income as per Income Tax Act. How much? 64 lakhs. To this, you will add back deduction under section 10AA. How much is deduction under section 10AA? 16 lakhs. Na? So you will add back. Next, you will add back deduction under section 35 AD. 65 lakhs. Is there 80 IA to 80 RRB deductions? From this, you will reduce depreciation. See, 65 lakhs is building na. As per Income Tax Act, on building rate of depreciation is 10%. 65 lakh into 10%. 6 lakh 50. So now how much is alternate minimum tax? 64 lakh plus 60 plus lakh 50. 1 crore 38 lakh 50. So whatever this 1 crore 38 lakh 50,000, it is more than 1 crore na. So surcharge at the rate of 12%. Why 12%? Because for partnership form, more than, if total income is more than 1 crore, surcharge rate applicable is 12%. So AMT tax 18.5%, 138 lakh 50,000 into 18.5. 25 lakh 62,250. To this you will add surcharge at the rate of 12, 3 lakh 7,000. 28 lakh 69,000 into 4%, 1 lakh 14,790. 29 lakh 84,000. Now how much is normal tax? Normal tax is 19 lakh 96,800 or AMT 29 lakh 84,510. Whichever is higher. Higher means AMT. Much? 29 lakh 84,005. So this is payable. So will they get AMT credit? Yes, AMT credit. How much is AMT credit? AMT credit is it in 9800. 9 lakh 87,000. So I hope you understood non-resident taxation. I welcome you all for this most awaited lecture. See, determination of residential status, that and all I will discuss later. It is easy only. You also can learn. But from taxation of NRIs, non-resident Indians, and from taxation of non-resident, almost 7 to 8 marks are being asked in every examination. So first I will focus on taxation of NRIs, then I will discuss taxation of non-residents, then we will do some problems. NR taxation is very vast. So today I am trying to focus on taxation of NRIs as well as taxation of non-residents. Determination of residential status, business connection, taxation of interest, royalty fees for technical services, that I will plan in second part. Most probably again tomorrow also we will discuss non-resident taxation. In tomorrow's session I will discuss those things. We will also do problems. Okay. Because non-resident taxation is such a chapter which I can't revise in 1.5. So first I will cover taxation of NRIs, and I will cover taxation of non-resident. Taxation of NRIs, non-resident Indians. First of all, who are called as NRIs? You have to tell Varun, Monish, Samir. Who are called as NRIs? Non-resident Indians. Taxation of NRIs, chapter 12A. This we are going to discuss right now. First of all, who are called as non-resident Indians? To call an individual as NRI, two conditions are required to be satisfied. First condition, he should be non-resident. Along with non-resident, he should be an Indian citizen or person of Indian origin. So whenever both these conditions are satisfied, then that individual we call as NRI. See, quite often you hear the word NRI. NRI means who? Any individual who is non-resident in India and who is an Indian citizen or who is a person of Indian origin. Then that person we call as non-resident Indian. Indian citizen who is not resident. Not only Indian citizen, if an individual is person of Indian origin and also non-resident, then that person also we can call as NRI. Are you able to understand? See, for non-resident Indians, certain benefits are given under income tax. Those benefits are given as per chapter 12A. Are you able to understand? What are those benefits? Let's say non-resident Indian is there. Non-resident Indian invested in foreign exchange asset. Where he invested? Foreign exchange asset. Sir, what do you mean by foreign exchange asset? I will tell you. So whenever non-resident make investment in foreign exchange asset, how investment should be made? Invested in foreign currency. That means he is purchasing foreign exchange asset not in Indian rupees. Non-resident Indian is purchasing foreign exchange asset using the foreign currency. Now, sir, what do you mean by forex asset? In shortcut, this is also called as forex asset. What do you mean by forex asset? Forex asset means shares of an Indian company. Indian company can be either private limited or public limited. Next, debentures or deposits with Indian public company. Debentures or deposits with Indian public. Very important. Only if it is a public company, then only it will be treated as forex asset. NRI purchased debentures issued by private limited company. If debentures are issued by private limited company, then those debentures are not forex asset in the hands of NRI. Debentures or deposits should be made in public limited company. Are you able to understand? Then only it will be treated as forex asset in the hands of NRI. Sir, what is the importance of forex asset? What is the significance? See, whenever forex asset is purchased by NRI, lower rate of tax will be levied. What is that lower rate of tax? I will tell you. Next, third investment is capital central government securities. So whenever non-resident Indian purchases forex asset means like shares of an Indian company, whether public limited or private limited, debentures or deposits of Indian public company, then only it is called as forex asset. Capital gain security, sorry, central government security. Whenever these three assets are purchased, they will be called as forex asset. And whenever investment is made in forex asset, how that investment should be made? Investment should be made in foreign currency. Are you able to understand? Now, whenever this investment is made, from this income will be received by NRI. That income is not taxable at general rates. That income is taxable at concessional tax rates, lower tax rates. Sir, what is the lower tax rate? Whatever the income is there, if income is investment income, such investment income is taxable at the rate of 20%. Sir, what do you mean by investment income? NRI is purchasing shares of Indian company. From shares of Indian company, dividend can be received. Dividend is investment income. He is purchasing debentures of Indian public company. From debentures, interest will be received. Interest is also considered as investment income. On investment income, tax rate applicable is 20%. The thing is, this 20% is gross, taxable on gross basis. No expenditure is allowed as deduction. No chapter 6 reductions are allowed. Whatever investment income is there, on investment, total investment income without any deduction, you are going to apply 20% tax rate. Are you able to understand? Uh, if the nature of income is long-term capital gain, then tax rate applicable is 10% if long-term capital gain is before 23rd July. If long-term capital gain is on or after 23rd July, then tax rate applicable is 12.5. My dear students, you need not check whether forex asset is taxable under section 112A or 112. That is different. Okay, for NRI separate taxation is there now. So from this, on sale of forex asset, whatever the capital gain that is received, whether it is taxable under 112A or 112, that is not necessary. On sale of forex asset, whatever the long term capital gain is there, on that long term capital gain, tax rate applicable is 10% or 12.5%. Are you able to understand? If there is any other income, then other income is taxable at normal tax rate. Other income taxable at, non-resident tax rates, right? Even non-resident individual also, he has two options. Either he can pay taxes under default tax rates or optional tax rates. So like other income is taxable at slab rates. Are you able to understand? Now, whatever investment income is there, investment income, that is dividend or interest. Investment income is taxable on gross basis. No deduction will be allowed. Expenditure not allowed as deduction. Chapter 6 reductions also not allowed as deduction from investment income. Investment income is taxable on gross basis. Next, non-resident Indian sold forex asset. On sale of forex asset, there will be capital gain. Let's say there is long-term capital gain. Then that long-term capital gain is taxable at 10% or 12.5%. While calculation of this long-term capital gain, indexation benefit is not available. Even before 23rd July 2024, indexation benefit is not available while calculating capital gains on transfer of forex asset. Okay, next. Chapter 6 deductions are also not allowed while calculating. So whatever the long term capital gain is there, from such long term capital gain you cannot claim chapter 6a deductions also. But there is first proviso to section 48. First proviso to section 48. See, whenever non-resident purchased shares of Indian company, then we have discussed full value of consideration is to be calculated in dollars. Transfer expense also to be calculated in foreign currency. Capital gain also calculated in foreign currency. Whatever the capital gain in foreign currency is there, that will be converted into Indian rupees. And while converting Indian rupees into foreign currency for the purpose of calculation of for full value of consideration transfer expense, we will consider average rate, average of buying and selling rate as on the date of transfer. For conversion of cost of acquisition, we will consider average rate as on the date of purchase. Okay, so normally in case of non-resident, whenever he purchase shares or debentures of Indian company, then what will we do? We will calculate capital gains in foreign currency. Whatever the capital gain in foreign currency is there, that we will convert to Indian currency. That's what we have studied in first proviso to section 48. That first proviso to section 48 is also applicable for non-resident Indian. Are you able to understand? See, non-resident is different, non-resident Indian is different. Directly, he is not Indian citizen, he is foreign citizen. He came to India, he is non-resident in India. Brettley can never be NRI. Brettley can only be NR because Brettley is not an Indian citizen. Brettley is not a person of Indian origin. So Brettley in India we call as non-resident. Are you able to understand? Like whatever this first proviso to section 48 is there, that is applicable for non-resident as well as for NRI also. For non-resident Indian also, first proviso to section 48 is. Are you able to understand? So till here, are you clear, everybody? Please comment. Hi Niranjan, finally your wish came true. Okay, you are asking NR taxation from lot of time. Next. See, foreign exchange asset is there. Foreign exchange asset transferred. On transfer of foreign exchange asset, there is long-term capital gain. Now, from this long-term capital gain, you can claim exemption. Are you able to understand? So, whatever long-term capital gain is there, if long-term capital gain is reinvested within 6 months, reinvested within 6 months from date of transfer, then whatever the amount reinvested is not eligible for exemption. Proportionate exemption is to be calculated. Are you able to understand? So whatever the long term capital gain is there, if it is reinvested, interest income, which section? Interest income, like we are discussing section 115. Reinvested within 6 months from date of transfer. Where reinvestment should be made? Reinvestment should be made in any other foreign exchange asset or reinvestment should be made in savings certificates issued under section 10(4)(b). So if reinvestment is made in another foreign exchange asset or if reinvestment is made in savings certificates issued under section 10(4)(b), whatever the amount reinvested, total amount reinvested is not eligible for exemption. Proportionate exemption is to be calculated. How to calculate? Exemption is equal to long-term capital gain into amount reinvested divided by net consideration. Okay, so proportionate exemption is allowed as deduction. So what is time limit for reinvestment? Time limit for reinvestment is 6 months. Let's say there is one guy, Sundar Pichai. He is non-resident in India, but he is Indian citizen. Sundar Pichai is NRI. Sundar Pichai is having shares of Reliance Limited. Now Sundar Pichai sold shares of Reliance Limited. Now Sundar Pichai will get long-term capital gain. Now whatever the long-term capital gain that is received, if it is invested in shares of another Indian company or if it is invested in saving certificates issued under section 10(4)(b), are you able to understand? Then whatever the long-term capital gain that is reinvested, total reinvestment is not eligible for exemption. Proportionate exemption will be allowed. Long-term capital gain into amount reinvested divided by net consideration. Next, lock-in period. You know lock-in period, right? Whatever the new asset that is purchased is there. See, Sundar Pichai sold shares of Reliance Limited. He got long-term capital gain. Long-term capital gain is reinvested in shares of Wipro Limited. Now, whatever new foreign exchange asset that is purchased. Whatever shares of Wipro Limited that are purchased are there, they are not to be transferred within 3 years from the date of purchase. That means from date of reinvestment for next 3 years, you should not transfer the new foreign exchange asset. Are you able to understand? Sir, what if he transfers Wipro shares within 3 years from date of purchase in case of violation? Violation means what? Transferred within 3 years from date of purchase. Violation means transferred within 3 years from date of purchase. Then earlier exemption claimed. Earlier exemption is taxable as long-term capital gain in year of violation. Are you able to understand? So in the year he violates, in that year, whatever the earlier benefit that was taken, earlier benefit is taxed as. Till here, did you understand, everybody? Section 115C. What section 115? Not 115C, section 115. What section 115H says? Let's say in 2023-24, he is NRI. But in 24-25, he became resident in India. Now the question is, sir, if he is NRI, these benefits are available. Okay, if he is NRI, all these benefits are available. Investment income is taxable only at 20%. Long-term capital gain taxable at 10% or 12.5%. Now, in the year in which he purchased a foreign exchange asset, in 23-24 he purchased Reliance Limited shares. In 23-24 he is NRI, but in 24-25 he became resident in India. Now, what is the situation, sir? Earlier he is NRI, but in current previous year he is resident in India. Even though he is resident in India, still NRI provisions will continue to apply. Provisions will continue to apply if declaration is given by SSC. Are you able to understand? If declaration given by, that means what? Sundar Pichai has to give declaration in 23-24 I am NRI. As an NRI, I purchased foreign exchange asset, but in 24-25 I become resident in India. So even though I become resident in India, I will opt the provisions. I wish to continue the same NRI provisions. So if he gives declaration while filing ITR, that option is available whether you wish to continue to apply NRI provisions. If that option is selected, then even though he is resident in India, still those NRI provisions will continue to apply until whatever that investment income is there, that is taxable at the rate of 20%. Are you able to understand? Till investment income is taxable at the rate of 20%. Students, today's class is very important. Taxation of NRI, taxation of non-resident, easily 6 to 8 marks are being asked in the examination. Nowadays he is not focusing that much on foreign fees for technical services. That introductory part, whatever determination residential status is there, that he is not testing. He is testing taxation of NRI and tax. Next, one last point is there, section 115I. What section 115I says? Whatever chapter 12A provisions are there, whatever chapter 12A provisions are there, these chapter 12A provisions are optional. Provisions are. What do you mean by this? NRI have two options. If NRI wants normal tax rates, he can choose normal tax rates. Or if NRI wants chapter 12A, he can choose chapter 12A. So whatever chapter 12A provisions are specifically drafted for non-resident Indian are there, those are not mandatorily applicable for non-resident Indian. It is up to the choice of the NRI. If NRI wants to choose these provisions, he will choose these provisions. Otherwise, he will pay taxes at normal tax rate. Are you able to understand? Let's say investment income 4 lakhs was received. Now 4 lakhs is taxable at the rate of 20%. And I will advise NRI not to choose chapter 12A, because if you choose regular provisions up to 2,50,000 basic exemption and only balance 1 lakh is taxable, that too at the rate of 5%. So I will advise to choose normal tax rate. So whatever these NRI provisions are there, they are not mandatory on NRI. If he wants to follow, he will follow. Otherwise, he can pay taxes at normal. You will understand. Whenever NRI is having investment income, then ITR is not required to be filed. Are you able to understand? So NRI not required to file ITR if two conditions are satisfied. If total income includes investment income and capital gain, long-term capital gain, and TDS is deducted. If these two conditions are satisfied, that means NRI total income consists of only two incomes: investment income, long-term capital gain, and TDS is already deducted. If these two conditions are satisfied, NRI is not required. Now open the problem, we will solve the problem. All of you, are you having problems with you? I have shared this PDF in the Telegram group. I hope you understood the concept taxation of NRI. Now we will solve one problem also. You will get clarity. Open question 1. I'm sorry, in just 10 minutes, I picked these problems, and these are also done by me editing. So that's why editing was not proper. I have no time to give this work to my editor. The following data is furnished by Mr. Rahul, a non-resident and a person of Indian origin. Careful while reading the question. He is non-resident and also a person of Indian origin. So can we tell Rahul as NRI? Both the conditions are satisfied. Na? Rahul is non-resident. He is person of Indian origin. As both the conditions are satisfied, we can tell Rahul as NRI, non-resident Indian. For financial year ended 31st March 2025, long-term capital gains arising on transfer of foreign exchange asset on 21st July. See, when foreign exchange asset was transferred 21st July, that means before 23rd July or after 23rd July. Before 23rd July, na. If it is before 23rd July, while calculating long-term capital gains, what is the tax rate? 10% or 12.5%? 10% tax rate is applicable. Next, expenditure incurred wholly and exclusively incurred in connection with such a transfer, nothing but transfer expenses. We will reduce transfer expenses. Interest on deposits held with private limited companies, super point. See, if you purchase debentures with private limited company, is it a foreign exchange asset? This is not a foreign exchange asset. Okay. Only if debentures or deposits are made in public company, then only it will be treated as foreign exchange asset. Are you able to understand? Now, interest on government securities. The interest on government securities is a foreign exchange asset. What I said? Shares of Indian company, debentures or deposits of Indian public company, central government securities. So central government securities will be treated as foreign exchange asset. Next, interest on deposits with public limited companies. So whatever the deposit, see where investment is made in deposits of public limited company. So it is a foreign exchange asset. Are you able to understand? From foreign exchange asset, if any investment income is received, that is taxable on gross basis at the rate of 20%. Next, savings and investments. Investment in notified savings certificates in section 104B on 30 March 2025. See, reinvestment should be made within how much period? Reinvestment should be made in 6 months. When these are transferred on 21st July 2024. So date of transfer 21st July 2024. 6 months means 20 August 2024, 20 September 2024, 20 October 24, 20 November 2024, 20 December 2024, 20 January 2025. So 20 January 2025, that is 6 months. But when reinvestment was made on 30th March. Reinvestment made on 30th March 2025. So whether reinvestment was made within 6 months or after 6 months. Reinvestment was made after 6 months. As reinvestment was made after 6 months, exemption is not available. See, whatever reinvestment 2 lakhs is there, that is not eligible for exemption because reinvestment was made after 6 months from date of transfer. Time limit for reinvestment is only 6 months. Okay. Investment in shares of Indian Public Limited Company as on 31st December 25. See, 30th March 2025 is only after 6 months. 31st December 2025 means this is also obviously after 6 months. So if reinvestment is made after 6 months, that reinvestment is not eligible for exemption. Are you able to understand? Compute balance tax payable or refund due for assessment year 25-26 in accordance with special provisions applicable. See, in question clearly specified in accordance with special provisions applicable to non-residents. That means in question he himself is asking us to calculate tax liability using special provisions applicable to NRIs. Next, assume SSC opted out of 115 BSE means he is opting out of default tax rates and he is paying taxes under optional tax rates. Are you able to understand? So shall we calculate the income, everybody? Now, before we calculate, one important point. Long-term capital gain that is taxable at the rate of 10% because transfer was made before 23rd July 24. This is not a foreign exchange asset. So this is taxable at normal tax rate. Interest on government securities, interest on deposits with public limited company. These two are foreign exchange asset. As their foreign exchange asset, investment income is received. So it is taxable at 20%. Are you able to understand? So first we are clear with tax rates. Investment income 20%, long-term capital gain 10%, other income taxable at normal rates. So first we will calculate investment income. How much is investment income? Calculation of total income. Investment income. Now, investment income, two incomes are there interest on government securities, interest on government securities, interest on deposit with public company. Am I correct? Deposit with public company. How much? 95,000, 2,60,000. Whatever this 95,000, 2,60,000 is there, this is investment income and this is taxable at the rate of 20%. Are you able to understand? Long-term capital gain. How much is full value of consideration? Full value of consideration is 6,50,000. How much are transfer expenses? Transfer expenses are 80,000. How much is net consideration? 6,50,000 minus 80,000. 5,70,000. Now, whether indexed cost of acquisition is available? No, I said indexation benefit not available. From this long-term capital gain, you cannot claim Chapter 6 deductions. Another important point, yeah, 5,70,000. How much is cost? Hmm, cost. So it is already computed. Computed means what? After claiming cost of acquisition. Okay. So whatever long-term capital gain is there, that is already computed. So this is not full value of consideration. This is long-term capital gain only. So long-term capital gain 6,50,000. Transfer expenses 80,000. So after deduction of transfer expenses, long-term capital gain is 5,70,000. From this, can we claim exemption? Exemption is not available. Why exemption is not available? Because reinvestment was made after 6 months. Are you able to understand? So, taxable long-term capital gain is 5,70,000 rupees. On long-term capital gain, applicable tax rate is 10%. Now, how much is other income? See, deposits with private limited company, that is not foreign exchange asset na. So other income is 5,90,000 rupees. Interest on deposit with private limited company. Private limited. How much? 5,90,000. So how much is the total income? Calculate. 5,90,000 plus 5,70,000 plus 95,000 plus 2,60,000. 15,50,000. Am I correct? Let's check. Next, shall we calculate the tax liability? Calculation of tax liability. Tax liability of Rahul. We already discussed investment income is taxable at the rate of 20%. So, tax on investment income. How much is investment income? 95,000 plus 2,60,000. 3,55,000. 3,55,000 to 20%. 71,000. Long-term capital gain is taxable at the rate of 10%. So, tax on long-term capital gain. How much? 5,70,000 na? 5,70,000 into which is 57. Next, how much is other income? Other income is 5,90,000. Up to 2.5 lakh nil. Greater than 2.5 lakh up to 5 lakh. Tax rate is 5%. Tax amount is 12,000 because he is paying taxes under optional tax. Above 5 lakh up to 10 lakh tax. So 90,000 into 20%, 18,000. So total is 30,500. How much? 30,500 plus 57,000 plus 71,000. 1,58,000. To this we need to add 6,000. So how much is fine? 1,64,000. Yeah, 1,64,840. TDS deducted is 1,83,000. So refund is So everybody, are you clear with question 1? Then we will quickly do question 3 as well. Question 3, I will not write everything, but I will explain with the answer because we are lacking. Next, Arohi, a non-resident Indian, has the following sources of income in India during previous year 24-25. Income from house property located in India. Computed means what? After claiming standard deduction, after claiming interest on borrowed capital, whatever the income from house property is there, ultimate income from house property was given. It is 1,80,000. See, again she is non-resident Indian. That means she is NRI. Income from house property is other income na. So obviously it is taxable at normal tax rates. Dividend from Indian companies. See, this is foreign exchange asset, not dividend from Indian companies. So obviously it is investment income. On investment income, tax rate applicable is 20%. Next, interest on debentures of Indian company subscribed in convertible foreign exchange. See, I told you, foreign exchange asset means investment should be made in foreign currency and debenture should be purchased of Indian public company. Here, Indian company was given. If no clarity was given, let us take assumption it is public company only. I told you, investment income for foreign exchange asset is taxable on gross basis. Income is 1 lakh, expenditure is 20,000, net income is 80,000. Tax is not applicable on 80,000, tax is applicable on gross basis 1 lakh rupees. Are you able to understand? Long-term capital gain on sale of debentures subscribed in US dollars. Sale value 6 lakhs, cost is 4 lakhs, transfer expenses 6,000. Okay. So ultimate long-term capital gain is 1,94,000. Now, whatever the long-term capital gain is there, what is the date of transfer? 10th December 24. That means after 23rd July na. So as it is after 23rd July 2024, tax rate applicable is 12.5%. Are you able to understand? So you already know on long-term capital gain, you will apply 12.5%. Next, whatever the interest income is there, 1 lakh, you can see it is taxable on gross basis. So investment income on foreign exchange, again foreign exchange asset, against that investment income, expenditure is not allowed as deduction. Chapter 6 reductions are not allowed. It is taxable on gross basis. So you can see income from house property 1,80,000. This is other income na. Other income is taxable at normal rates. So you can take the benefit of basic exemption limit. Basic exemption limit available is 2,50,000. Other income you can set off against basic exemption limit. Balance income, it is taxable at uh, special tax rates applicable for NRI. Investment income taxable at 20%. Long term capital gain taxable at the rate of 12.5%. Okay. Next, shall we discuss other concepts? This is all about taxation of NRI. In one case scenario question, I think in November 2024, he asked 8 marks exclusively relating to taxation of NRI. Okay, because this concept is only at final level now, definitely he will test this. Next, we will discuss special tax rates for NR. Special tax rates for non-resident. Till now, we discussed about tax treatment of non-resident Indian Now we are going to discuss about tax rate of non-resident. Shall we discuss everybody? See, India always needs money because India is not a developed country. India is a developing country. So foreigners have more money. So how to attract foreigners to make investment in India? To give concession in tax rates. So for non-residents, like concession will be given in tax rates. At the same time, let's say in foreign, if you go to foreign, the rate of interest is very low. Interest rate is 2%, 3% like that, because inflation is low. In India, inflation is very high. Therefore, interest rate is very high. In India, interest rate will range from 9% to 12%. So, how can we attract foreigners? Like we will issue securities to foreigners, or we will issue debt securities to foreigners. We will issue rate of interest high. We will offer 8% interest rate. In foreign, non-residents will not get 8% interest rate. Obviously, they will show interest in investing in India because they will get 8% interest. Are you able to understand? At the same time, that is one offer. Another offer is whenever they make investment in India, lower tax rates will be levied. So that will encourage more non-residents to come into India and make investment in India. So to encourage more investments from non-residents, special tax rates are applicable for non-residents. What are those special tax rates? That we will see now. Okay. This is chapter 12. See, NRI chapter 12A, NR non-resident chapter 12. Okay. There is non-resident or foreign company. Non-resident or foreign company made investment in infrastructure debt fund, infra debt fund. Sir, what do you mean by infrastructure debt fund? Infrastructure debt fund is a debt fund that is incorporated in India that will take money from non-residents, and that money will be given as loans to NRIs in India. Sorry, that will be given as loans to those companies who are involved in infrastructure business. Are you able to understand? So let's say Sundar Pichai is NRI. He made 1 crore rupees investment in infrastructure debt fund. What infrastructure debt fund will do? This 1 crore rupees will be given as loan to various infrastructure companies. Are you able to understand? Now, on this investment, see, non-resident or foreign company is making investment in infrastructure debt fund. From this investment, they are going to get the income. Now, that income is taxable at normal rates. What is the income that they will get? They will get interest income. Whatever the interest income that is received, that interest income is taxable at normal rates. Sir, what is the tax rate? That interest income is taxable at the rate of 5% plus applicable surcharge plus 4% HEC. Are you able to understand? So, see, non-resident in India slab rates up to 2,50,000 nil, greater than 2,50,000 up to 5 lakh 5%. Above 5 lakh tax rate applicable is 20%. But normal slab rates are not applicable whenever investment is made by non-resident in infrastructure debt fund. Whatever the interest income that is received, that is taxable at a very low tax rate of 5% plus applicable surcharge plus health and education cess. And see, we cannot catch non-resident. Na Malia went to London. It's been more than 6 to 7 years. Indian government could not catch Malia and could not bring Malia into India. That's why before making any payment to non-resident, TDS is required to be deducted. So whenever any interest is paid on infrastructure debt fund to non-resident or foreign company, on such interest, TDS is required to be deducted. Okay. So infrastructure debt fund will deduct TDS. Under which section? It will deduct TDS under section 194 LB. Sir, what is the rate of TDS? TDS will be deducted at the rate of 5% plus applicable surcharge plus health and education. If you remember, in TDS chapter I have told you, TDS provisions relating to NR will be discussed here. Okay. See, now infrastructure debt fund earns income in India, na? Whatever the income earned by infrastructure debt fund is there, such income is not at all taxable. Such income is exempt under section 10(4)(b), 1047. Are you able to understand? Income earned by infrastructure debt fund in India, total such income is exempt. I hope you are clear with section 115A. This is section 115A, whatever that we have discussed. Investment in infrastructure debt fund by non-resident or foreign company. Are you clear, everybody? Did you understand section 115A? I can't do anything. NR taxation is like this. We should keep on discussing different sections with different tax. Shall I explain further? Are you there? Anyone? Next, same 60, section 115A. Non-resident or foreign company is there. Now, what non-resident or foreign company has done? They have given foreign currency loan. They gave foreign currency loan to Indian company or business trust. We have discussed business trust concept in earlier lecture. So, non-resident or foreign company, they have given foreign currency loan to Indian company or business trust. And this loan agreement, whatever this loan is there, this agreement was entered in between 1st July 2012 to 30th June 2023. So if any foreign currency loan is given by non-resident or foreign company, either to Indian company or business trust, subject to the condition, such foreign currency loan agreement should be entered on or after 1st July 2012, but before 30th June 2023. As per that loan agreement, if any interest is paid, okay, then that interest income is taxable to non-resident at a concessional rate. Okay, that interest income is taxable to non-resident or foreign company at, at a concessional rate of 5% plus applicable surcharge plus health and education. Are you clear? So, non-resident infrastructure debt fund interest income 5%. Non-resident foreign currency loan given in between 1st July 2012, 30th June 2023. Interest income received taxable at lower tax rate of 5%. Are you clear till here? Non-resident or foreign company. There is Indian company or business trust. Now, non-resident or foreign company subscribed long-term bonds. Long-term bonds issued till 30th June 2023. Till 30th June. Or non-resident or foreign company, they have purchased rupee denominated bonds issued till 30th June 2020. Issued till 30th June 2020. So non-resident or foreign company, infrastructure debt fund, interest income received 5%. Case 2, non-resident or foreign company giving foreign currency loan. Then also whatever interest income received taxable at the rate of 5%. Non-resident or foreign company has invested, okay, has subscribed long-term bonds issued by Indian company or business trust, or non-resident or foreign company purchased rupee denominated bonds issued by Indian company or business trust. Then on all these, interest income will be paid na. Whatever the interest income that is paid is there, this interest income is taxable at the rate of 5%. Are you able to understand? 5% plus applicable surcharge plus health and education cess. Now, TDS is required to be deducted. Sir, under which section TDS will be deducted? TDS will be deducted under section 194 LC. So, whatever this interest income is there, before this interest income is paid to non-resident or foreign company, TDS is required to be deducted under section 194 LC at the rate of 5% plus applicable surcharge plus health and education cess. Is it clear? So we can tell one conclusion, whatever interest income that is received, it is taxable at 5%. TDS will also be deducted at 5%. Are you clear? Now, whatever these rupee denominated bonds are there, if rupee denominated bonds are issued in between 17 September 2018 and 31st March 2019. So, if non-resident or foreign company purchases rupee denominated bonds issued in between this period, what is the period? 17 September 2018 to 31st March 2019. Okay, because 2019 is election year, benefit was given. What is the benefit? If any rupee denominated bond is purchased during this tenure, then on those rupee denominated bonds, whatever the interest income that is received is there, whatever interest income is there, that interest income is fully exempt lifetime. Okay, that interest income is never taxable, that interest income is fully exempt lifetime. Okay, whatever these long-term bonds issued till 30th June 2023 and whatever rupee denominated bonds issued up to 30th June 2023 are there, if these two are issued on or after, if they are issued on or after 1st April 2020 but before 30th June 2023, before 30th June 2023, and these are purchased, see, non-resident or foreign company, they are purchasing denominated bonds. When they are purchasing rupee denominated bonds, they are purchasing in between 1st April 2020 and 30th June 2023. They are purchased from recognized stock exchange located in IFSC. Are you able to understand? So if any rupee denominated bonds are purchased from recognized stock exchange located in IFSC in between 1st April 2020 and 30th June 2023. Then on those rupee denominated bonds, interest income will be paid na. On that interest income, tax rate applicable is only 4%. Are you able to understand? Generally, tax rate is 5% for interest income. But if rupee denominated bonds are purchased from recognized stock exchange located in IFSC, tax rate applicable is not 5%, tax rate applicable is only 4%. But if they are purchased after 30th June 2023, then tax rate applicable is 9%. Are you able to understand? Tax rate 9% is applicable. Niranjan, are you able to understand? You have waited for this lecture for so long time. Very simple. Generally on rupee denominated bonds, if any interest income is received, taxable at 5% only. But if rupee denominated bonds are purchased from recognized stock exchange located in IFSC before 30th June 2023, then 5% not, even lesser, 4% tax rate is applicable. Are you able to understand? But if rupee denominated bonds are purchased from recognized stock exchange located in IFSC on or after 30th, like after 30th June 2023, then tax rate applicable is 9%. Will I explain further? Next, non-resident foreign company, they have invested in business trust. This point we already studied in business trust concept. So whenever non-resident or foreign company invest in business trust, from business trust, dividend income will be transferred now. So whatever dividend received from SPV, that will be passed on to non-resident or foreign company. Whatever the dividend income passed on to non-resident or foreign company is there, that is taxable now. What is the tax rate that is taxable? Taxable to non-resident or foreign company at the rate of 10% plus applicable surcharge plus health and education cess. So see, we discussed 2 points. Special purpose vehicle, it is paying taxes as per normal tax rates, 25%, 30%. Then whatever dividend income received by non-resident, not at all taxable, fully exempt. But whatever special purpose vehicle is there, it is not paying taxes at 25% or 30%. It is paying tax at concessional tax rates under section 115 BAA. In that case, whatever the dividend income received, that is taxable to non-resident or foreign company, the tax rate applicable on dividend income is 10%. But on this dividend income, whatever the dividend income is there, from this dividend income, TDS will be deducted under section 194 LBA at the rate of 10% plus applicable surcharge plus health and education. Are you able to understand? This already we have discussed. Next, general provision. Non-resident or foreign company, if it gives any foreign currency loan to Indian company or Indian government, then on that interest income will be received na, that interest income is taxable at the rate of 20%. Whatever that interest income is there, that is taxable at the rate of, that is general. So normally if interest income is received by non-resident or foreign company, tax rate applicable is 20%. That is the maximum tax rate applicable on interest income. Next, non-resident or foreign company, if they receive any dividend, if they receive dividend or income from units of UTI, if they receive any dividend or income from units of UTI, whatever the dividend income that is received is there, the dividend income is taxable at the rate of 20%. But if dividend is received from IFSC, very very important, dividend received from IFSC, then tax rate applicable is only 10%. Are you able to understand? Non-resident foreign company getting dividend from dividend income or any other income from units of UTI, tax rate 20%. But if dividend income is received from units purchased in IFSC, International Financial Service Center, then on those units, whatever the dividend income that is received, on such dividend income, tax rate applicable is only 10%. Are you able to understand? Shall we discuss further? Till here, are you clear? Very simple. Interest on securities, infrastructure debt fund, or foreign currency loan, whatever the interest income is there, that is taxable at 5%. Next, dividend income taxable at 10%. Normal interest income, any other interest income received by non-resident or foreign company, either from Indian government or Indian concern, taxable at 20%. Next, if dividend is received from units of UTI, tax rate applicable is 20%. But if units are purchased from IFSC, then tax rate applicable is only 10%. Actually, I'm having class these days till 6 o'clock. So from class to home, I could not reach by 7 p.m. That's why I extended class time from 7 to 7. Next, section 115 AB. See, nowadays, non-resident or foreign company, they can directly invest in Indian share market or they can directly purchase Indian shares. Once upon a time, non-resident or foreign company, they cannot directly purchase shares in Indian stock market. They can only purchase through mutual fund. So non-resident will invest money in mutual fund. Mutual fund will invest money in Indian shares or Indian stock market. Now, 115 AB, Overseas Financial Organization. It is also called as OFO. Let us keep the shortcut OFO. Overseas Financial Organization is there. It made investment. It made investment in mutual fund or UTI. Whatever the investment that is made, investment was made in foreign currency. Now, from this investment, they are going to receive the income. Now, income is of two types: revenue income, capital income. Revenue income is now that income is like normal income. It is taxable at the rate of 10%. Revenue income. If it is capital income, long term capital gain, that long term capital gain is taxable at the rate of 10% or 12.5%. Are you able to understand? So overseas financial organization, it made investment in mutual funds or units of UTI. From that investment, income was received. That income, if it is revenue income, taxable at the rate of 10%. If it is capital gain, taxable at the rate of 10% before 23rd July. After 23rd July, taxable at the rate of 12.5%. Now, your doubt is, sir, what overseas financial organization means? Okay. So, overseas financial organization means an institution or an association or a body established under foreign law. So we can simply tell any entity incorporated outside India established under foreign law. Now this entity entered into agreement. It entered into agreement for investment in India. for investment in India, with whom it entered into agreement for investment in India, either with public financial institution or public sector bank PSB or with any mutual fund. Whatever this agreement is there na, this agreement should be approved by SEBI. Should be approved by SEBI. Then we call it as investment made by overseas financial organization in units of UTI or other mutual. Okay. Honestly, NR taxation requires next level preparation and probably the only complex chapter in DT, as we have to remember a lot. Very simple logic, Monish. Now you are listening this revision lecture na, first time you are listening. Next time when you are listening, listen in 1.5. Like listen it 3 to 4 times. When you listen it for 3 to 4 times, it will automatically register in your subconscious mind. Definitely you will remember, not a problem at all. Any complex concept you take, the only thing that matters is revision. If you revise it for n number of times, it becomes so easy for you. Okay, so don't be afraid of non-resident taxation. Face non-resident taxation, listen it multiple times, keep your efforts, automatically you will remember. So overseas financial organization means any entity incorporated outside India. So any entity established under foreign law, if it enters into agreement for investment in India, either with public sector bank or public financial institution or mutual fund. Okay, and that agreement should be approved by SEBI. Okay, then that organization we call as overseas financial organization. So this is all about section 115 AB. Next, I will discuss section 115 AC. Shall I discuss 115 AC? Section 115 AC. I strongly feel whatever the concepts that I am discussing today, from these concepts only you will get question. Because how to determine residential status, that and all inter-level concept. In inter only he is asking questions. At final level, he is not testing how to determine residential status. He is also not testing business connection that much. Most of the time he is testing about taxation of NRIs and taxation of non-residents. So these today's lecture is very important. Niranjan, are you following this lecture today? Very, very important. Section 115 AC. Non-resident or foreign company, they invested in GDRs, Global Depository Receipts, or foreign currency convertible bonds of an Indian company. You know GDRs, right? In CA Inter Financial Management, GDRs is theory question. 4 marks theory question. You would have studied like difference between GDR and ADR, Global Depository Receipts and American Depository Receipts. That theory question will be there. Okay. So very simple. Now Indian company is there. Adani Limited is there. Adani Limited wants to issue shares in USA. Whether Adani Limited can issue shares in USA, whether Adani Limited can issue shares in NASDAQ, can it list shares in NASDAQ? Not possible. Now, so what Adani Limited will do? There is one bank called S Bank in USA. Adani Limited will issue shares to S Bank. S Bank, keeping those shares as underlying asset, S Bank will issue global depository receipts to non-residents. Now, non-residents will give money to S Bank will give money to Adani Limited. Are you able to understand? So, global depository receipts are a medium for getting foreign money. So, like you cannot issue shares outside India. So, you will issue shares to a bank located outside India. That bank keeps those your company shares as underlying asset, and it will issue GDRs, Global Depository Receipts. Non-residents will purchase the GDRs, amount will flow to foreign bank will make investment in India. Are you able to understand? So, if any GDRs are issued or if any investment is made in foreign currency convertible bonds of Indian company, On this income will be received by non-resident or foreign company. Na? On this income, if the nature of income is interest or dividend income, then that interest or dividend income is taxable at the rate of 10%. If it is long-term capital gain, then it is taxable at the rate of 10% or 12.5%. In this case, while paying this income, TDS is required to be deducted under section 196C. Sir, what is rate of TDS? For normal income, rate of TDS is 10% plus applicable surcharge plus HEC. For capital gain, rate of TDS is 10% or 12.5% plus applicable surcharge plus HEC. That is TDS rate under section 196. Today, NR taxation viewership is very low, very, very low. But what can I do? N number of times I can only revise these tax rates. So did you understand 115 AC? Next I will explain section 115 AD. Shall I explain? Section 115 AD speaks taxation of foreign institutional investors. For foreign institutional investors also special tax rates are there. What are those special tax rates that we will see right now? Now, foreign institutional investor, he received any income from India. He received any income on security in India. Any income on security, very important, other than interest on units of UTI or mutual fund. Sir, why other than interest on units of UTI or mutual fund? Because they are already covered under 115 AB. Under 115 AB, we have already discussed. So, foreign institutional investor, if he gets interest income on units of UTI or mutual fund, whatever the income that is received, that is taxed as per section 115 AB. Other than income from UTI or mutual fund, if any other income is received, for such other income, section 115 AD gets attracted. Are you able to understand? Sir, what is the tax rate? Whatever the income that is received, if that income is long-term capital gain, if that income is long-term capital gain under section 112, tax rate applicable is 10%. See, generally amendment was made before 23rd July, long-term capital gain under section 112, tax rate applicable is 20%. On or after 23rd July 2024, tax rate applicable was reduced from 20% to 12.5%. But in this section, lawmakers, I think it is drafting error. Lawmakers did not write the tax rate at 12.5%. So like whenever long-term capital gain under section 112 is received by foreign institutional investor, whether before 23rd July or after 23rd July, tax rate applicable is only 10%, 12.5% is not applicable. Generally, see, for every long-term capital gain on or after 23rd July, tax rate applicable is 12.5%. But when you read section 115 AD, you will not find 12.5% for long-term capital gain under section 112. Probably the lawmakers, they forgot to make the amendment. They might make amendment in upcoming finance acts. But the thing is, everywhere you see long-term capital gain under section 112 taxable at the rate of 12.5% after 23rd July 2024. But in case of foreign institutional investor, long-term capital gain under section 112 is still taxable at the rate of 10% only, whether before 23rd July or after 23rd July 2024. Okay. If the nature of income is long term capital gain under section 112A, then up to 1.25 lakh exempt. Greater than 1.25 lakh, it is taxable. What is the tax rate? Tax rate is 10% before 23rd July. Tax rate is 12.5% on or after 23rd July 2020. Okay. If it is short term capital gain under section 111A, tax rate applicable is 15% or 20%. Before 23rd July, tax rate 15%. On or after 23rd July, tax rate applicable is 20%. Next, short term capital gain. Other short term capital gain, tax rate applicable is 30%. If there is any income, investment income, that means dividend income or interest, then the dividend or interest that is taxable at the rate of 20%. Another important thing is, for all these incomes, whatever the incomes that we have discussed it under section 115 AD, for all these incomes, maximum surcharge rate applicable is only 15%. Generally, if total income is more than 2 crores, higher surcharge rate, 25%, 37% gets attracted. But in case of foreign institutional investor, whatever the income received under section 115 AD is there, on such income, maximum surcharge rate applicable is only 15%. Okay. This is all about taxation of NRIs and taxation of non-resident. I discussed about taxation of non-resident Indians, and I also discussed about taxation of non-resident. In today's class, we will discuss residential status of various category of persons, and I will also discuss with you section 7 and section 9. Now, shall I start discussing residential status of various persons? Of course, this you have studied at CA inter level, but the thing is, the same concept is also there at CA final level. You need to study, but you will find it easy because most of you, like, you have studied residential status at CA inter level. At CA inter level, that chapter is also very important. So I think you all had very good knowledge about residential status. Anyhow, we will quickly revise it. First, I will discuss residential status of an individual. There are 4 conditions. Using 4 conditions, we are going to determine residential status of an individual. What are the 4 conditions? Out of 4 conditions, 2 are basic conditions, 2 are additional conditions. Okay, so what are basic conditions? Like B1, B2, additional conditions A1, A2. What is the conjunction between basic conditions? Conjunction between basic conditions is OR. That means out of 2 basic conditions, if any one of the basic condition is satisfied, sufficient. Sir, why we use basic conditions? We use basic conditions to tell whether individual is resident or non-resident. Are you able to understand? Once individual becomes resident in India, to tell whether that resident is ROR or RNOR, we are going to use additional condition. So simple, using 4 conditions, we will determine residential status of an individual. Out of 4 conditions, 2 are basic conditions, 2 are additional conditions. Why we use basic conditions? We use basic conditions to tell whether individual is resident or non-resident. Once individual becomes resident in India, then we use additional conditions to tell whether resident is resident and ordinarily resident or resident but not ordinarily resident. Conjunction between basic conditions is OR. That means out of 2 basic conditions, if any one of the basic condition is satisfied, sufficient, individual becomes resident in India. If both basic conditions are not satisfied, then individual becomes non-resident. Next. Once individual becomes resident in India, we have to tell whether that resident is ROR or RNOR. For that, we use the additional conditions. Sir, what is the conjunction between additional conditions? Conjunction between additional conditions is AND. That means if both additional conditions are satisfied, individual becomes ROR. If any one of the additional conditions are not satisfied, or if both additional conditions are not satisfied, individual becomes RNOR. Are you able to understand? I did not discuss what are the conditions. I am just explaining you the methodology to determine residential status of an individual. So what will we check? We will check B1. Individual is there. For individual, first check B1. If B1 is satisfied, then he becomes resident in India. If B1 is not satisfied, then we will check basic condition 2. If basic condition 2 is also, if basic condition 2 is satisfied, then he becomes resident in India. If basic condition 2 is also not satisfied, then he becomes non-resident. Are you able to understand? Next. Once individual becomes resident in India, then we will check additional conditions, because once he is resident in India, then we need to tell whether he is ROR or RNOR. So then we are going to check additional conditions. Okay. Now we will check A1. He is satisfied, he is resident in India, na? Then we will check A1. If A1 is satisfied, if A1 is not satisfied, if A1 is not satisfied, he becomes RNOR. If A1 is satisfied, then we will check A2 also, because if both the additional conditions are satisfied, he becomes ROR. If any one of the additional conditions are not satisfied, or if both additional conditions are not satisfied, he becomes RNOR. So we will check A2 also. If A2 is also satisfied, then he becomes ROR. If A2 is not satisfied, then he becomes RNOR. Are you able to understand? Very simple. First check basic condition 1. For individual, basic condition 1 satisfied, resident in India. Basic condition 1 not satisfied, then we will check second basic condition. If basic condition 2 is satisfied, he becomes resident. If both basic conditions are not satisfied, he becomes NR. Are you able to understand? Once, if any one of the basic conditions are satisfied and he becomes resident in India, then we will check additional conditions. If both additional conditions are satisfied, he becomes ROR. If any one of the additional conditions are not satisfied, if both additional conditions are not satisfied, then he becomes RNOR. Are you able to understand? Now I will discuss with you the conditions. Did you understand the methodology, how to determine residential status of an individual? Now shall I discuss what are all those conditions? B1. As per basic condition 1, individual must stay in India for greater than or equal to 180 days, 182 days during current previous year. That means in current previous year, if any individual stays in India either for 182 days or more than 182 days, he satisfies basic condition 1. Once basic condition 1 is satisfied, he becomes resident in India. So what is the Finance Act applicable for your attempt? Finance Act number 2 of 2024. It is applicable for previous year 24-25. So for your attempt, current previous year is previous year 24-25. In previous year 24-25, if an individual stays greater than or equal to 182 days, then basic condition 1 is satisfied. Are you able to understand? Next, basic condition 2. As per basic condition 2, what happened to this? Why is it behaving like this? Yeah, basic condition 2. Basic condition 2 has two subconditions. Subcondition 1, individual must stay in India for greater than or equal to 60 days during current previous year. Subcondition 2, in last 4 previous years. Last 4 previous years, individual must stay in India for greater than or equal to 365 days. Then both subconditions are satisfied. The conjunction is and. If both subconditions are satisfied, then we can tell basic condition 2 is satisfied. Only if basic condition 2 is satisfied, then only If basic condition 2 is satisfied, he becomes resident. If basic condition 2 is also not satisfied, then he becomes non-resident. Are you able to understand? Basic condition 2 has two subconditions. If both subconditions are satisfied, then basic condition 2 is said to be satisfied. Are you able to understand? Now, I will tell a simple example. Current previous year is 24-25, right? In 24-25, individual must stay in India for greater than or equal to 60 days. Then we can tell subcondition 1 is satisfied. Next, ignore current previous year. Whatever current previous year is there, ignore current previous year. Take last 4 previous years. What are last 4 previous years? 23-24, 22-23, 21-22, 20-21. In last 4 previous years together, if an individual stays in India for greater than or equal to 365 days, then subcondition 2 is satisfied. Are you able to understand? Now, if both these subconditions are satisfied, then we can tell basic condition 2 is also satisfied. Are you able to understand? So, basic condition 2 has internally two subconditions. Subcondition 1, individual should stay in India for 60 days or more during current previous year. Subcondition 2, ignore current previous year, take last 4 previous years. In last 4 previous years, individual must stay in India either for 365 days or more than 365 days. Then subcondition 2 is satisfied. If both subconditions are satisfied, then we can tell basic condition 2 is also satisfied. Are you able to understand? Now, if basic condition 2 is satisfied, he becomes resident. If basic condition 2 is also not satisfied, then he becomes NR. Are you able to understand? Next, additional condition 1. What additional condition 1 says? As per additional condition 1, individual must be resident in India for 2 previous years immediately for 2 previous years out of 10 previous years immediately preceding current previous year. Immediately preceding current previous year. What do you mean by this? Whatever current previous year is there, we will ignore current previous year. Let's say current previous year is 24-25. We will ignore current previous year. We will take last 10 previous years. What are last 10 previous years? Previous year 23-24, 22-23, 21-22, 20-21, 19-20, 18-19, 17-18, 16-17, 15-16, 14-15. These are 10 previous years. In 10 previous years, for at least 2 previous years, if he is resident in India, then we can tell additional condition 1 is satisfied. Sir, how to tell whether he is resident or not? For last 10 previous years, for each previous year, we will check basic condition 1, basic condition 2. So for every year, we will check B1, B2. Okay, for example, in 23-24, B1 satisfied, B2 not satisfied. B1 is satisfied, na, he is resident. 22-23, both basic conditions not satisfied, non-resident. But in 16-17, B1 not satisfied, but B2 satisfied, he is resident in India. So, for 2 previous years, he is resident in India, na. For previous year 23-24, previous year 16-17, sufficient. He satisfies additional condition 1. Are you able to understand? So ignore current previous year, take last 10 previous years. Out of last 10 previous years, for at least 2 previous years, if he is resident in India, then we can say additional condition 1 is satisfied. Are you able to understand? Next, additional condition 2. Ignore current previous year. Take last 7 previous years. 1, 2, 3, 4, 5, 6, 7. In last 7 previous years, for at least 730 days. So, greater than or equal to 730 days if an individual stays in India. Okay. Then we can tell additional condition 2 is satisfied. Are you able to understand? If additional condition 2 is satisfied, then like if both additional condition 1 as well as additional condition 2, if both are satisfied, he becomes ROR. If both, like if additional condition 1 is not satisfied, or if additional condition 2 is not satisfied, or if additional condition 1 and additional condition 2, if both are not satisfied, in those cases he becomes RNOR. Are you able to understand? So very simple. 4 conditions to determine residential status of an individual. Out of 4 conditions, 2 are basic conditions, 2 are additional conditions. Using basic conditions, we will tell whether individual is resident or non-resident. Once individual becomes resident in India, then we use additional conditions to tell whether resident is ROR or RNOR. Are you able to understand? Now, there is only one viewer. Okay. Now, we use basic conditions. Basic conditions B1, B2. Conjunction is or. Out of 2 basic conditions, if any one of the basic condition is satisfied, he becomes resident in India. If both basic conditions are not satisfied, he becomes non-resident. Once individual becomes resident in India, we will check additional conditions. If both additional conditions satisfied, ROR. If any one of the additional conditions not satisfied, or if both additional conditions not satisfied, he becomes RNOR. Are you able to understand? Now, B1, as per B1, individual should stay in India for greater than or equal to 182 days in current previous year. As per B2, there are 2 subconditions. Subcondition 1, individual should stay in India for greater than or equal to 60 days in current previous year. Subcondition 2, individual should stay in India for 365 days or more during 4 previous years immediately preceding current previous year. Are you able to understand? That means ignore current previous year, take last 4 previous years. In last 4 previous years, for at least 4 previous years, if he is resident in India, sufficient, in last 4 previous years, if he stays in India for 365 days or more, then subcondition 2 is satisfied. If both subconditions are satisfied, then we can tell basic condition 2 is satisfied. Next, additional condition 1, ignore current previous year, take last 10 previous years. Out of last 10 previous years, for at least 2 previous years, if he is resident in India, then we can tell additional condition 1 is satisfied. Next, additional condition 2, ignore current previous year, take last 7 previous years. In last 7 previous years, if an individual stays in India either for 730 days or more, then we can tell additional condition 2 is also satisfied. Are you able to understand? If both additional conditions satisfied, ROR. If any one of the additional conditions not satisfied, or if both additional conditions not satisfied, he becomes RNOR. Are you able to understand? There are 4 conditions to determine residential status: B1, B2, A1, A2. There are 2 exceptions to second basic condition. Okay, so for that means in 2 cases, second basic condition is not applicable. In those 2 cases, we will check only first basic condition. If first basic condition is satisfied, he becomes resident in India. If first basic condition is not satisfied, don't check B2 because B2 is not applicable. So if B1 is not satisfied, directly he becomes non-resident, NR. Are you able to understand? Sir, what are those 2 exceptions? What are those 2 cases? Exception 1. First of all, exception 1 is applicable only for Indian citizen. So, in case of an Indian citizen, if he leaves India, why he leaves India? If he leaves India either for business or profession or for employment outside India or as a crew member of an Indian ship, crew member of an Indian ship, crew member of an Indian ship. As a crew member of an Indian ship. In this case, only basic condition 1 is applicable, basic condition 2 is not applicable. Basic condition 1 satisfied, resident in India. Basic condition 1 not satisfied, don't check B2 because B2 is not applicable, directly he becomes NR. Look, Indian citizen, like let's say I got job in Australia, I went to Australia, I am Indian citizen, but I am permanently moving to Australia for the purpose of employment outside India. So whenever I go to Australia, for me only basic condition 1 is applicable, basic condition 2 is not applicable. Are you able to understand? So in case of any Indian citizen who is leaving India, why he is leaving India? Either for employment or for business or for profession outside India, then for that Indian citizen, basic condition 2 is not applicable. Or Indian citizen is leaving India as a crew member of an Indian ship, then also for that Indian citizen, basic condition 2 is not applicable. So in these cases, we will check only B1 satisfied resident, B1 not satisfied, don't check B2, straight away he becomes NR. Important point, Indian citizen leaving India for the purpose of tour. If he leaves India for tour, both basic conditions are applicable. Or Indian citizen leaving India for the purpose of education outside India, then also both the basic conditions are applicable. Second basic condition is not applicable only if Indian citizen leaves for employment, business or profession. Otherwise, if in case of an Indian citizen, if he leaves for any other purpose, education, tour, business purpose, okay, or to meet friend, or for the purpose of health checkup, in all these cases both basic conditions are applicable. Are you able to understand? Exception 2. Exception 2 is applicable for Indian citizen or person of Indian origin. That means what? Exception 1 is applicable only for Indian citizen. Exception 2 is applicable for Indian citizen or person of Indian origin. Sir, who is called as person of Indian origin? See, person of Indian origin means in case of any individual, either his parents or grandparents, if any one of them are born in undivided India, then we call that person as person of Indian origin. Are you able to understand? Let's say individual is there, either individual or his parents. Parents means mother or father. Grandparents can be maternal or paternal. Maternal means mother side grandparents, paternal means father side grandparents. So mother side grandmother, grandfather, father side grandmother, grandfather. So out of these many person, if anyone are born in undivided India, born in undivided India. Undivided India means India before 1947. Before 1947, India includes Nepal, Bhutan, Sri Lanka, Pakistan, Tibet. All these are included in India. That we call as undivided India. So before 1947, if any individual is born in Sri Lanka uh, and his grandchildren, okay, his grandchildren will also be considered as person of Indian origin, because grandchildren's grandfather is born in Sri Lanka before 1947. Before 1947, Sri Lanka is part of India. That's why. Are you able to understand? So either individual or his parents or his grandparents, maternal, paternal. If any one of them are born in undivided India, India before 1947, then this individual will be called as person of Indian origin. Are you able to understand? So exception 2 is applicable for Indian citizen or person of Indian origin. So in case of Indian citizen or person of Indian origin, what we are going to check? We are going to check total income minus income from foreign sources. If total income minus income from foreign sources is less than or equal to 15 lakhs. If it is greater than 15 lakhs, two cases will arise. So in case of Indian citizen or person of Indian origin who stays outside India, and comes to India on a temporary basis. For that person, we will check total income minus income from foreign sources. If total income minus income from foreign sources is less than or equal to 15 lakhs, if it is greater than 15 lakhs. If total income minus income from foreign sources is less than or equal to 15 lakhs, then B1 is applicable, B2 is not applicable. Are you able to understand? So if B1 is satisfied, he becomes resident in India. If B1 is not satisfied, you need not check B2, straight away he becomes NR. Are you able to understand? If B1 is satisfied and he becomes resident in India, then we will check additional condition 1 and additional condition 2 to determine whether he is ROR or RNOR. Are you able to understand? Next. If total income minus income from foreign sources is more than 15 lakhs. Sir, what do you mean by income from foreign sources? I will tell you. If total income minus income from foreign sources is more than 15 lakhs. In that case, B1 is applicable. If B1 is satisfied, he becomes resident in India. Once he becomes resident in India, then we will check additional conditions A1 and A2 to determine whether he is ROR or RNOR. But B2 is not applicable. In place of B2, modified B2 is applicable. Sir, what do you mean by modified B2? Do you remember basic condition 2? As per basic condition 2, there are two sub-conditions. Individual must stay in India for greater than or equal to 60 days in current previous year. As per sub-condition 2, individual must stay in India for greater than or equal to 365 days during last 4 previous years. Do you remember? What modified B2 says, in place of 60 days, we need to replace 120 days. Okay. So as per modified B2, individual should stay in India for 120 days or more during current previous year and 365 days or more during last 4 previous years immediately preceding current previous year. If both these sub-conditions are satisfied, then we can tell modified B2 is satisfied. If modified B2 is satisfied, he becomes RNOR. If modified B2 is not satisfied, then he becomes NR, non-resident. Are you able to understand? Now, this is exception 2. Now, what do you mean by income from foreign sources? See, there are two types of income. Indian income, foreign income. Indian income means income that is received in India or accrued in India. We call that income as Indian income. Foreign income means what? Income that is received outside India and also accrued outside India. We call the type of income as foreign income. Are you able to understand? Now, whatever the foreign income is there, from foreign income, if any income is earned because of business controlled or profession set up in India, then that income is to be excluded. Whatever the balance income is there, that income we call as income from foreign sources. Are you able to understand? So we can tell income from foreign sources means income which is accrued, purely outside India. Are you able to understand? That means what? Income from foreign sources means income which accrues purely outside India without any business controlled from India or profession set up in India. Profession set up in India. We call that income as income from foreign source. Okay. Very simple. Exception 2 is applicable for Indian citizen or person of Indian origin. Either Indian citizen or person of Indian origin. For them, basically they are staying outside India and came to India on a temporary basis. For them, we will check total income minus income from foreign sources. If total income minus income from foreign sources is less than or equal to 15 lakhs, then B1 is only applicable. B2 is not applicable. B1 satisfied, resident in India. B1 not satisfied, don't check B2, straight away non-resident. Total income minus income from foreign sources greater than 15 lakhs. In that case, like B1 is applicable, B2 is not applicable. In place of B2, modified B2 is applicable. B1 satisfied, resident in India, and we will check additional conditions to determine ROR or RNOR. B2 not satisfied, then we will check modified B2. Modified B2 means individual must stay in India for greater than or equal to 120 days. In current previous year, he should stay in India for 365 days or more during 4 previous years immediately preceding current previous year. If modified B2 is satisfied, he becomes RNOR. See, modified B2 satisfied, don't check additional conditions. Straight away he becomes RNOR. If modified B2 is not satisfied, then he becomes NR, non-resident. Are you able to understand? Next, there is another concept called deemed resident. So are you clear till here, everybody? Water deva? Ammanadu. Deemed resident, there are 4 conditions. If all these 4 conditions are satisfied, then we call that individual as deemed resident. Okay, what are those 4 conditions? Condition 1, individual must be an Indian citizen. Individual must be an Indian citizen. Condition 2, he should not satisfy basic conditions. He should not satisfy B1 and B2. Basically, if both basic conditions are not satisfied, he becomes non-resident. Even though he is non-resident, still he will be called as deemed resident. Are you able to understand? So condition 2, he should not satisfy B1, B2. Condition 3, his total income minus income from foreign sources should be more than 15 lakhs. Total income minus income from foreign sources should be more than 15 lakhs. Condition 4, he is not taxable in any other country or territory. In any other country or territory. If all the 4 conditions are satisfied, then we can tell that individual as deemed resident. Once individual is deemed resident, he becomes RNOR. Are you able to understand what is the conjunction? And all the 4 conditions are required to be satisfied. If all these 4 conditions are satisfied, individual becomes deemed resident. When he is deemed resident, his residential status will be resident but not ordinarily resident. Are you able to understand? So 4 conditions: Indian citizen, uh, both basic conditions are not to be satisfied. Total income minus income from foreign sources greater than 15 lakhs. He is not taxable in any other country or territory. If all these 4 conditions are satisfied, individual becomes deemed resident. Once he is deemed resident, he becomes RNOR. Are you able to understand? Thank you. Am I audible, everyone? It got struck, it seems. Next, we will discuss residential status of HUF. See, HUF have 3 statuses. HUF can become ROR, HUF can become RNOR, HUF can become NR, non-resident. So, 3 residential statuses are available for HUF. Now, the point is, first we will check control and management affairs of HUF. Control and management affairs of HUF. If control and management affairs are wholly or partly in India, wholly or partly in India, then HUF becomes resident in India. If control and management affairs are wholly outside India, then HUF becomes non-resident. Are you able to understand? So, how do we tell whether HUF is resident or non-resident? We need to check control and management affairs. Sir, what do you mean by control and management affairs? The place from where Karta takes all the decisions. That place is said to be having control and management affairs. Let's say an individual who is Karta, he, like, let's say entire business is running in USA. All employees are working in USA. Entire transactions, sales are done in USA, purchases are done in USA, but all the decisions are taken by Karta sitting in Hyderabad. So we can tell the place of control and management affairs is Hyderabad. Are you able to understand? So the point here is the place where from Karta takes the decisions. That place is said to be having control and management. Business can happen outside India. Sales can happen outside India. Assets can be there outside India. Employees may be working outside India. But what matters to us is the place from where Karta takes all the decisions. That place is said to be having control and management affairs. Are you able to understand? So if control and management affairs are wholly or partly in India, HEF becomes resident in India. If control and management affairs are wholly outside India, HEF becomes non-resident. Next. Once HEF become resident in India, then check additional conditions. Check A1 and A2 of Karta. See, HEF is not natural born person. HEF is a artificial person. So we will check whether Karta is satisfying additional conditions or not. So we need to check A1 and A2 of Karta. If Karta satisfies both A1 and A2, if Karta satisfies both A1 and A2, then HEF becomes ROR. If Karta does not satisfy A1, or if Karta does not satisfy A2, or if Karta does not satisfy A1 and A2, if Karta does not satisfy A1 and A2, then HF becomes RNOR. Are you able to understand? So this is all about residential status of HUF. Simple. Next, residential status of company. Shall I explain? Very, very important. At final level, the concept is in depth. At inter-level, residential status of company, it's not that much depth, but at final level, it is depth. Shall I discuss? Now, residential status of a company. If a company is Indian company, Indian company always resident in India. Indian company always resident in India. But if company is foreign, see, Indian company means what? Any company incorporated in India, Reliance Limited, Adani Limited, Wipro Limited, okay, every company that is incorporated in India is an Indian company. Residential status of Indian company is always resident in India. But the company is foreign company. In case of foreign company, we will check POEM, place of effective management. If POEM is in India, then foreign company becomes resident in India. If POEM is outside India, then foreign company becomes non-resident. Sir, what do you mean by POEM? POEM means place of effective management. Are you able to understand? If place of effective management is in India, foreign company becomes resident in India. If place of effective management is outside India, then foreign company becomes non-resident. Sir, how to determine place of effective management? Are you able to understand? So, to determine place of effective management, there are two conditions. Okay, we will check those conditions. Based on those conditions, we will tell whether that foreign company is whether that foreign company is having POEM in India or outside India. POEM in India becomes resident. POEM outside India becomes non-resident. Now, determination of POEM. For determining poem, we will check two conditions. Condition 1, more than half of board meetings shall be held outside India. That is condition 1. Condition 2, that company should have active business outside India. ABY. If both the conditions are satisfied, then we can tell place of active management is outside India. Are you able to understand? See, majority of the board meetings, more than half means majority. If majority of board meetings are held outside India, and if majority of the board meetings held outside India and foreign company is having active business outside India, if both these conditions are satisfied, then we can tell poem is outside India. If poem is outside India, foreign company becomes non-resident. Are you able to understand? Sir, let's say a company had 4 board meetings. Out of 4 board meetings, 3 board meetings held in USA, 1 board meeting held in India. In this case, more than half of the board meetings are held outside India, right? More than half of board meetings held outside India. Am I correct or not? So we can tell condition 1 is satisfied. Sir, what having active business outside India means? See, if there are 4 conditions, if all these 4 conditions are satisfied, then we can tell the company is having active business outside India. So 4 conditions, if 4 conditions are satisfied, then we can tell company is having active business outside India. Sir, what are those 4 conditions? Condition 1, passive income should be less than or equal to 50% of total income. Passive income should be less than or equal to 50% of total income. Condition 2, assets in India should be less than 50% of total assets. Condition 3, number of employees in India should be less than 50% of total number of employees of company. Condition 4, payroll expense of Indian employees. Payroll expense of Indian employees should be less than 50% of total payroll expenditure. Conjunction and if all the 4 conditions are satisfied, then we can tell active business, company is having active business outside India. First condition, passive income of company should be less than or equal to 50% of total income. Next, whatever the assets in India are there, value of assets in India should be less than 50% of total assets. Condition 3, number of employees in India should be less than 50% of total number of employees of company. Whatever the expenditure paid to Indian employees is there, that should be less than 50% of total payroll expenditure. If all the 4 conditions are satisfied, we can tell company is having active business outside India. Are you able to understand? Now, sir, what do you mean by passive income? Passive income means what? Let's say purchase, sale. You are purchasing goods from associated enterprise and are selling to outsider. Whatever the income that you earn, that will be called as passive income. You are purchasing from outsider and selling to associated enterprise. Whatever the income that you earn, that is called as passive income. Are you able to understand? Hold on. Passive income means purchase and sale both from the associated enterprise. Then we call that income as passive income. Purchased from associated enterprise, sold to associated enterprise. Then we call that income as passive income. Purchased from associated enterprise, sold to outsider. Then we call that income as active income. Purchased from outsider, sold to associated enterprise. Then also we call that income as active income. Are you able to understand? So if there is any passive income means what? You purchase from associated enterprise and you also sell to associated enterprise. Then in that transaction, whatever the income that you earn, that income will be considered as passive income. So passive income means both purchase and sale from associated enterprise, from or to associated enterprise, from and to associate. That means you purchase from associated enterprise, you will sell to associated enterprise. In the transaction, whatever the income that you make, that income we call as passive income. Next, rental income is also considered as passive income. Rental income, capital gains, royalty, dividend, all these are considered as passive income. And if there is any interest income except you are in money lending business. In money lending business, if you earn any interest income, that is active income only, it is not passive income. Other than in money lending business, if any other interest income is received, that will be considered as passive income. So interest income except in money lending business. Okay. So this is the concept. So very simple, active business outside India. When can we tell poem is outside India? Two conditions. Majority of the board meetings should be held outside India. Second condition, that company is having active business outside India. When can we tell a company is having active business outside India? Four conditions. If all these four conditions are satisfied, we can tell company is having active business outside India. Sir, if both these conditions are satisfied, then we can tell company is having active business outside India. Okay. Now the question is, if condition 1 is not satisfied, or if condition 2 is not satisfied, or if both condition 1 and condition 2 is not satisfied, then can we tell company is having active business in India? Then can we tell poem is in India? No. In that case, we should identify persons who take decisions and we will identify place where they are taking decision. Place where they are taking decision. If the place from where they are taking decisions, if that place is in India, then poem will be in India. Once poem is in India, foreign company becomes resident. The place from where they are taking decisions, if it is outside India, then poem is outside India, then they will become non-resident. Are you able to understand? So first we will check both the conditions. More than half of the board meetings, active business outside India. Both are satisfied. Then poem is outside India. If both conditions are not satisfied, then we will identify the people who are taking the decisions. Then and we also identify the place from where they are taking the decision. So if the place where they are taking decisions is in India, poem is in India, resident. Place from where they are taking decisions, if it is outside India, poem is outside India, they becomes. Are you able to understand? Next, another important point. See, in a company, all board meetings are held outside India. Even though all board meetings are held outside India, board of directors are not taking decisions. Board of directors are just puppets. All the decisions are taken by a person in India. In that case, we can tell we will set aside board of directors and as all the decisions are taken by a person situated in India, then we can tell poem is in India and that foreign company becomes resident in India. For example, I started one company, Umasankar Inc. in USA. I appointed 4 board of directors. All board of directors are like conducting board meetings in USA. But whatever I say, board of directors will do that only. I am sitting in Hyderabad, I am taking all the decisions. Now, just because all the board meetings are held outside India, can we tell poem is outside India? No, because board of directors are not taking any decisions without me. So here I am setting aside board of directors. So here we will find out the person who is taking all the decisions. It's me. Where I am located? Hyderabad. So even though all board meetings are held outside India, if board of directors are not taking any major decisions, if there is set aside of board of directors, then we will check the person who is taking all the decisions. If the person who is taking all the decisions is situated in India, then we can tell poem is in India and that person becomes resident. That foreign company will be said to be having poem in India and foreign company becomes resident in India. Are you able to understand? So this is the concept. Next, there are two important sections, section 7, section 9. For these sections, I shared the PDF in our Telegram group. You can download the PDF from the Telegram group. You can see. Have you downloaded this PDF? Section 7, section 9. Now, section 7, income deemed to be received in India. In certain cases, even though income is not received, still we will deem income as received in India and that income becomes taxable in India. For example, employer contribution to recognized provident fund in excess of 12% of salary. In salaries chapter, we will discuss employer contribution up to 12% exempt, in excess of 12%, it is taxable. See, employer is depositing money in my provident fund account. Whether employer is giving money to me, employer is not giving money to me. Employer is depositing money in employee provident fund account. Employee did not receive physically in current previous year. Even the employee did not receive employer contribution in current previous year, still whatever the employer contribution is there in excess of 12%, that will be deemed as received in India and it is taxable in India as per section 7. Okay. Interest credited to recognized provident fund balance at the credit of SSC in excess of 9.5%. In salaries, we will study interest on recognized provident fund up to 9.5% exempt, in excess of 9.5% it is taxable. So whatever the interest is there, it is not credited to our bank account, it is not given to us in cash. Interest on recognized provident fund will be deposited in recognized provident fund account. Even though it is not physically received by employee, still it will be deemed as received in India and as per section 7, it is taxable in India. Whatever the interest received in excess of 9.5% is there, that will become taxable in India. Next, from unrecognized provident fund to recognized provident fund, if any balance is transferred, even that transferred balance is also taxable. Next, deemed income as per section under section 68 to 69C. See, whenever income tax department has done right, okay, if they find any undisclosed income, they will treat it as deemed income. On deemed income, straight away 78% tax is applicable. So whatever the deemed income that is there, even though it is not received in current previous year, even though it is received in earlier years, still entire deemed income will be deemed as received in India in current previous year only as per section 7. Next, Deemed profits under section 41 and 59. Recovery of bad debts. Okay, it is taxable as deemed profits. Okay, that will be considered as deemed to be received in India. Next, contribution made by employer to a pension scheme under section 80 CCD. 80 CCD, National Pension Scheme. Okay, so if whatever the employer contribution to pension scheme under section 80 CCD is there, employer does not giving money to employee. Employer is depositing money in the employee's pension scheme account. So employee not physically receiving that money in current previous year. Even the employee do not receive it in current previous year, still it will be deemed as received in India. Are you able to understand? Next, section 9, income deemed to accrue or arise in India. Salary earned for services rendered in India. Let's say Justin Bieber, he came to India, he participated in Ambani's event, he earned money and he left India. Now, where Justin Bieber provided his services? In Gujarat. So, for providing services in Gujarat, Justin Bieber received income. Even though he is receiving income outside India, still where he provided services? He provided services in India. The moment services are provided in India, like that income will be considered as deemed to be accrued or arised in India. Salary payable by government to Indian citizen for services rendered outside India. See, in salaries we will discuss Indian citizen, government employee, working outside India. If these three conditions are satisfied, even though employee is receiving salary outside India, still that salary will be considered as deemed to be accrued or arised in India. I told, like Indian foreign service people are there. They are Indian citizens, they are government employees, but they are working in embassy office in China. Even though they are working in embassy office in China, still whatever the who will pay salaries? Indian government will pay salaries. Where they are working? China. Where they are receiving salary? China. It is foreign income. Even though it is foreign income, even though it is received outside India, still it will be deemed as accrued or arised in India. Are you able to understand? Dividend paid by an Indian company outside India. So if Indian company pays any dividend, see dividend received from Indian company, even though dividend is received outside India, still it will be considered as deemed to be accrued or arised in India. Are you able to understand? Now, income arising because of business connection. Sir, what business connection means? I will explain little later. Hold on. Income arising from any property, asset or source of income in India. Because of any asset located in India, if any income is received outside India, still that income will be considered as deemed to be accrued or arised in India. Chris Gale is there. He is West Indies player. When he came to India, in Bangalore he purchased one house. From that house, he is receiving rental income in West Indies. Even though rental income is received in West Indies, still that income will be considered as deemed to be accrued or arised in India. So because of any asset, because of any property, because of any source of income in India, even though any income is received outside India, still that income will be considered as deemed to be accrued or arised in India. Are you able to understand? Transfer of capital asset situated in India. If any capital asset, see, Chris Gale is having house in India. He sold that house in West Indies to another cricket player, Bravo. The thing is, the transaction happened outside India. Like Chris Gale selling Bangalore flat to Bravo. Entire transaction happened outside India. Because of that transaction, property situated in India is getting transferred. Whenever capital asset situated in India gets transferred, then automatically, even though income is received outside India, still that income will be considered as deemed to be accrued or arised in India. Are you able to understand? Income arising outside India being any sum of money paid without consideration. Sum of money paid without consideration means gift. Okay. So, like even though gift by resident Indian to a non-corporate or non-resident or foreign company. See, resident is giving gift. gift is given to non-resident, foreign company or non-corporate. If value of gift is more than 50,000, then it is taxable. Taxable to non-resident foreign company. Interest, royalty and fees for technical services as indicated below. Very simple. Yeah, that is similar to Vodafone case. You are correct. With one example, I will explain this clearly. There is Government of India, there is non-resident. From non-resident, Government of India borrowed loan. On this loan, interest will be paid. Na? Interest is expenditure to Government of India. Same interest is income to non-resident. Whatever this income is there, that income will be considered as deemed to be accrued or arised in India to non-resident. Deemed to be accrued or arised in India to non-resident. Next point. Government of India took patents from non-resident. On patents, Government of India will pay royalty. Na? Whatever the royalty paid, royalty is expenditure to Government of India. Same royalty is income to non-resident. That income will be considered as deemed to be accrued or arised in India to non-resident. Next, technical services. Like Government of India received technical services from non-resident. On those technical services, Government of India paid fees for technical services. Whatever fees for technical services is there, it is expenditure to Government of India. Same is considered as income to non-resident. That income to non-resident will be considered as deemed to be accrued or arised in India. Are you able to understand? So did you understand this concept? This is case of Government of India to non-resident. Case 2. There is resident, there is non-resident. Now, whoever resident in India is there, resident in India borrowed loan from non-resident. Resident in India borrowed loan from non-resident. On this loan, resident will pay interest. Na? Interest is expenditure to resident. Same interest is income to non-resident. Whatever this income is there, this income will be considered as deemed to accrue or arise in India. Deemed to accrue or arise in India. Okay. So very simple. This transaction, first transaction is in between Government of India and non-resident. Whatever the transaction that we are discussing, that is in between resident to non-resident. Okay. Same concept. Resident receiving loan from non-resident. On that loan, resident will pay interest. Interest is expenditure to resident, income to non-resident. Such income to non-resident will be considered as deemed to be accrued or arised in India. Next, resident received used patents of non-resident. On patents of non-resident, resident will pay royalty. Royalty is expenditure to resident and income to non-resident. Next, resident will receive technical services. On technical services, resident will pay fees for technical services. If fees for technical services is expenditure to resident and income to non-resident, such income to non-resident will be considered as deemed to be accrued or arised in India. Here, there is one critical point. Whatever the loan, patents, technical services that are received are there, if these are received for business or profession or source of income outside India, source of income outside India, in that case, whatever this income is there na, whatever this is there, this is income to non-resident, but that income to non-resident is not deemed to be accrued or arised in India, not deemed to be accrued or arised in India, not deemed to be accrued or arised in India. Are you able to understand the concept? Simple. Resident is taking loan, resident is using patents, resident is receiving technical services. If all these are received for business in India or profession in India, then whatever the royalty fees for technical services that are paid is there, it is income to non-resident. Such income is deemed to be accrued or arised in India. But whatever the inputs that are received, if they are used for business or profession outside India, then whatever the income to non-resident is there, that income will not be deemed to be accrued or arised in India. Are you able to understand? Non-resident to non-resident. See, non-resident, non-resident. There is one non-resident Trump. There is another non-resident Kim. Transaction is happening in between Trump and Kim. Why the hell will it get taxed in India? It will not be taxed in India. That's what, right? Because the substance of the transaction is entirely outside India. It is not happening in India. Correct? So, one non-resident received loan from another non-resident. On this loan, interest will be paid na. Interest is expenditure to non-resident. Same interest is income to Kim. Whatever this income is there na, this income is not deemed to be accrued or arised in India. Not deemed to be accrued or arised in India. Not deemed to be accrued or arised in India. Similarly, if any patents are received, on those patents, royalty will be paid. That royalty is expenditure to one non-resident, income to another non-resident. That income will not be considered as deemed to be accrued or arised in India. Why the hell will it get taxed in India? Because entire transaction is happening outside India in between Trump and non-resident. So it will not be taxed in India. Same is the case with technical services. For receiving technical services, fees for technical services will be paid. It is expenditure to non-resident, income to another non-resident. That income is not deemed to be accrued or arised in India. Now, if loan, patents, whatever loan, patents, technical services that are received are there, if they are for business or profession carried on in India, then it will be deemed to be accrued or erased in India, because whatever the loan taken, whatever the patents used, whatever the technical services that are received, they are used for business in India na, or they are used for profession in India na. So then in that case, whatever this income is there, this income to non-resident will be considered as deemed to be accrued or erased in India. Are you able to understand? Deemed to be accrued or erased in India. I hope you understood this point. Are you clear? Next, one last concept is there, business connection. Hardly it will take 5 minutes. Then we can wind up the session. Shall I explain business connection, everybody? Next, business connection. Very simple. I will tell with one small example, you will clearly understand. Let's say there is a company called Rolls-Royce. Rolls-Royce appointed one agent in India with the name Monish. So, if anybody wants to buy Rolls-Royce car in India, definitely they should approach Monish. Only through Monish they can purchase Rolls-Royce car. That means if any agent is appointed in India, through that agent, if any business is done and if any income is received by non-resident, then that income will be considered as deemed to be accrued or arised in India and business connection is established. Are you able to understand? So, because of any agent in India or because of any stock that is already there in India, if any income is received, okay, then that income, then business connection is said to be established and that income will be considered as deemed to be accrued or arised in India. So you can see, like, there must have an authority which is habitually exercised in India to conclude contracts on behalf of non-residents or habitually concludes contracts or plays principal role leading to conclusion of contracts by that non-resident. Habitually maintains a stock from which he regularly delivers on behalf of non-resident. Habitually secures order in India mainly or wholly for non-resident. Simply, for a non-resident located outside India, there is one guy in India. Okay, he is the agent in India. From India, whatever the transaction that is not done by non-resident is there, it is done through the help of agent. That means if any contract is to be concluded, agent will conclude the contract. That can be like, and agent will habitually maintain the stock from which he will deliver in India. So through an agent in India, if any transaction is done, then business connection is established and whatever the income that is received is there, that income will be considered as deemed to be accrued or arised in India. Are you able to understand? There are certain exceptions to business connection which you can study. I will explain lightly. For example, there is one person, Kim, or there is one person, his name is Saif. He resides in Bangladesh. Saif came to Kolkata. He purchased 10 Mercedes cars. Then he exported 10 Mercedes cars to Bangladesh. Just because goods are purchased in India for export outside India, then business connection is not established. Are you able to understand? Now Saif is purchasing 10 cars. He is exporting to Bangladesh. In Bangladesh, he is selling cars and he is making income. Then that income is not deemed to be accrued or arised in India. Business connection will not establish. Are you able to understand? Collection of news and views in India for transmission out of India. That means if any news is collected in India, using that news, if any income is earned, then that income is because of India. Actually, it should be taxable in India, but specifically it is excluded so that many people will come to India and cover news in India. Okay, are you able to understand? So that's why if any news is collected in India and any income is received, that income will not be deemed to be accrued or arised in India. Business connection will not establish. Okay, these two are main points. Remaining are nominal only. So that's it. We have discussed section 7, section 9. Okay, that's it for today. Thank you very much. Bye.